Good morning. All right, last trading day of the year. It is 9:21 on the East Coast. This is your host, Cousin Vinny, coming to you from theclosingprint.com. It is a fine morning. It's sunny outside. What's the temp? 48 in Sparta. Interesting. $57 and sunny. It's going to get up to 65 today. All right, so yesterday we finished up the day with 10-1 up volume on the NYSE, 10-1 on the NASDAQ as well, yet we're lower this morning. Put wall has rolled lower to 3,700. The put wall has rolled lower to 3,700 with the S&P Spider put wall remaining at 375. That's just our major support lines lower. 3,800 becomes a pivot line now. So 38.35 is first resistance. We're currently trading 38.46 on the futures. We got resistance at 38.50. We're currently trading just below that level on the futures. We have that JP Morgan collar that everybody's been talking about for the last couple of weeks. We're right around that area, 38.35. All right, if we start to shift down towards 38.35, there's a possibility we stay in that area and pin. All right, so we got resistance 38.50, 38.68, and 3,900. $38.35 being a pin. All right, so Tesla's starting to gap up here. Tesla gapping up. Good morning, Rob. Tesla's starting to move. Tesla's on the move. All right, we had a little pop there on Tesla. Let's see what they're doing. We just popped up about $1. All right, we still show weakness. We're trading right at 380 SPY. We have Less than 4 minutes to go for the opening bell. First 15 minutes, I'm not doing much of anything except taking profits off the table, then reassess the markets, looking for direction, stocks that are in play. Most everything is lower this morning. All the FANG stocks are lower. All right, more weakness coming in right before the open. All right, futures are currently at the lows of the morning. Have a pretty light day as far as news is concerned. Chicago PMI at 945. More downside risk at the moment. All right, less than a minute to go. First 15 minutes, not doing much of anything except taking profits off the table, watching for stocks that are in play. Early. All right, we're open. Okay, SPY maybe catches a bid here. We'll see. It's covering. We're down $2.62 on SPY.
Extreme low tick alert minus 800.
Okay, out of the gate, we've got a few S&P 500 puts, Tesla puts. Okay, Boeing down $1. Looking for a bounce in a lot of these. Short covering for starters. All right, SPY's starting to go a bit more now. More weakness. Give it a few minutes for the markets to settle down. We're continuing to move lower. SPY dropping off.
Extreme low tick alert.
Tesla continues to push higher. Tesla.
Because once you experience thinkorswim by no going back.
All right. Tesla. Nice rally on Tesla for now. Tesla. Looking pretty good so far. Now we're starting to move. Tesla on the move. All right, Tesla pushing a bit higher. All right, I might take some SPXU off here at the low. If we continue to move lower, I'll just add it back, SPXU. Tesla on the move. All right, let's check out Tesla. All right, Tesla. We got 60,000 at 123. Tesla, 60,000 shares at 123. Poly, what are you guys trading here? Poly, Palisade Bio. All right. TGTX starting to move. Mondo posting some news in the trading room earlier. Just search TGTX and that'll pop up. It was around 8:30 or so. Talking about it this week. Tesla's up 0.75%, starting to go. Tesla's going here. Looks good. Tesla. Yeah, I like that idea, Prism. Tesla. Okay, let's take a look. SPY following through. A little bit of short covering, not much more at the moment. We had yesterday at the close, we had 10-to-1 up volume NYSE and NASDAQ. Tesla, nice move through 123, continues higher. Tesla. All right, Chinese stocks, watching for them to bounce. FXI was above the 200-day yesterday, straddling it again today. Look for FXI to follow through, push above 30 in the short term. FXI, let me show you FXI. Looking for these Chinese stocks to continue higher. Looks like Tesla wants to go. FXI, this can get above 29.50. We should be on the way higher. DocuSign looking for follow through. That held up very well despite the drawdown this morning. Looking for DocuSign to head towards 65. The way they keep talking about COVID again and where this is trading near recent lows, if there's any sorts of issues with getting together with your real estate broker to close on sales or whatever, among other things, DocuSign most likely will continue higher. So I'm keeping an eye on it. I got some options. DocuSign, the 55s, going to buy some more going forward. Probably next week, I'll look at it again. Tesla's still going. Or a little selling here. Looking for Tesla to follow through. Chicago PMI out at 9:45. Got 5 minutes to go. All right, so the high yesterday was 123.57. 124, they shifted their offers higher.
Low tick alert -800.
All right, back down to the lows again. Very choppy start to the morning. Boeing trying to hold on to 188, pushing higher 189.37. Boeing's on the move here. Watch Boeing. Tesla, they keep moving the offers higher. It's at 124 now. Got 1 million shares offered at 124.50. All right, seeing a little bit of profit taking on Tesla now as the markets test the low again. The opening dip just got tested again. VIX turning up.
another section where maybe supply chain orientation is going to matter a bit less. Alphabet and really anything connecting to advertising had a tough year. How much of this was unavoidable? How much was self-inflicted?
It is time. Let's take a look at how treasuries are faring on this Friday morning. Largely, last I checked, a bit higher across the board. Yeah, there you go. The 10-year is 3.879%. We're really higher across the board versus a week ago. And just to put this in perspective, the 10-year started 2022 at 1.5%. We'll be right back.
All right, just chopping around. Tesla pushing again. Tesla. All right, more shorts covering. 124.50. There was 1 million shares there. Now it's 1,000,001. We got 72,000 offered at 124. So if we can get through these levels, 124.50, we should see this scoot higher. Probably some shorts covering. Then we got 130. There's lots of sellers overhead. All right, SPY bouncing again. Tesla. Having a good morning so far. Tesla. Morning, everyone. Hey, Jamie. I haven't seen you in a while. Tesla going. All right, so wow, 125. They're shifting their offers fast to the upside. Tesla looking really good here. Following through. All right, 60 minutes shows a nice clear path to 130 and then 140, 150, even numbers. Tesla looking good. SPY still hasn't popped, so we really need to see the indices moving higher too. $125 is a big level. 1 million shares offered there. Order flow is still very green.
Welcome back to Spotlight. Rick Santelli here live at CME HQ with the last breaking news of 2022 in the form of, well, Chicago PMI. It's a December read expected to be around 40. Our last look at 37.2 was the weakest since May of 2020. We jumped to 44.9, 44.9.
Low tick alert -800.
All right, SPY pushing a bit lower, trapping some bulls now. Still early. VIX pushing a bit higher.
As a matter of fact, yesterday's low in 10-year treasuries happened to be the starting point for that CPI about 3 weeks ago. Squawk on the Street will return after a short break.
All right, Tesla's a lot of supply overhead, 125. All right, SPY dropping off more now. 38.35 is that JP Morgan collar. $376 has been the lows, right around the lows, the last few trading sessions that we've come down. We came down to 376. That's
minus 800.
another $3. All right, Tesla coming back from that 124.50 test. SPY's down $4.20. Chicago PMI is out. Didn't like Chicago PMI. Dollar popping. The 10 years at the highs of the morning. So is VIX. Chicago PMI 44.9. It was previously at 37.2. All right. Do we bounce here? Okay. Let's see if we continue to trend lower today or if we reverse this. So I'm not acting yet. Tesla back to even on the day, pulling back. All right, waiting for the opening range, always a good idea. Market's been up and down. Now we're back down again. The important level is that 38.35 JP Morgan collar. We're right in that area, just below it right now on the futures. All right, let's see what's hot today. Northrop Grumman, Lockheed Martin, defense stocks. Okay, bear trap. We'll see. Northrop Grumman, Lockheed Martin. Let's see what the defense stocks look like. DFEN.
Treasuries extend declines after the M&I Chicago PMI tops estimates.
Macy's, it's back down here in the 20s. Tesla looking for more shorts to cover. So far, very quick profit taking this morning. We could just chop around down here. 383 over the last, 4 trading days. Today would be day 5. We haven't been able to get and stay above 383. We headed for 384 yesterday. Ten-year yields at 3.87%. That's the highs. Okay, Tesla's still looking weak here. There's 225,000 shares offered at 125. Tesla trying to bounce. SPY's trying to bounce. It's almost 10 o'clock. Got 5 minutes to go.
German bonds extended to drop. 10-year yield rises 11 basis points to 2.55%.
More weakness. SPY looks like bear flags. VWAP is changing direction quickly, but it looks pretty weak here. Below this level, below 380, we could see 375 pretty quick. 376 was recent lows. Got a gap over here as well. Watch for any moves downside. SPY. All right. A little bit more short covering. Still very bearish look on the markets. Still a very bearish kind of look. Got to get above VWAP and start pushing. All right, nice little pop here. Tesla reversing. Dollar rolling over, VIX rolling over. Most signals are bullish on Tesla. TTM are all bullish. Okay, SPY bouncing a bit better. We're still off 3.3 on the SPY. Futures, 31 handles. All right, we need to see a burst of volume here to show interest. All right, we're still 3-to-1 down volume. Market internals are still neutral to bearish. It's almost 10 o'clock. 10 o'clock on the dot now. All right, we hit VWAP, getting rejected. Be careful. Tesla pushing back up. If you're inclined to take some profits off and reassess. Pally on the move. Halted up again. All right, we're sitting right here at VWAP. SPY sitting at VWAP. Daily. Makes 9 days above this 50% retracement. We got the JP Morgan collar to deal with at 38.35. RSI still below 50. All right, we need to see a burst in the other direction if we're going to see any kind of bullish action.
Futures extend gains as crude rises by $8 a barrel.
SPY getting rejected. We're still 20% off the highs. We'll close the year. If we're down here, we'll close the year off 20%. Could be a lot worse. All right, Tesla. Still got more buy signals on Tesla. Short time frames, 5 minute, 30 minutes, 60 minutes, still on a buy signal for Tesla. SPY just not cooperating, just sitting here. All right, let's look at equal weight. Still at the 50-day. Number of stocks trading above their 50-day have pushed lower again. So we got erratic signals there. Tells me to be cautious. Both growth and value below their 21-day. 21-day is facing lower. We need to get above the 21-day. This still could be viewed as a range in growth, chopping around between 2,300 and 2,650. But the downtrend still there, lower highs, lower lows. Tesla at the top of the list again. Yesterday was another day. We traded, what, 220 million shares traded yesterday? 220 million. The day before as well. So that's a nice thing to see at the lows. Looking for upside in Tesla. All right, we're getting rejected at VWAP. SPY is getting rejected at VWAP.
Just about the record highs ever set above 4,800 in January of this year. What gets us there? I mean, are we going to have everything that pressured the markets this year playing in reverse in 2023?
Michael, yes. In fact, I heard your comments about 20% years, and I think that's spot on. That the question we have to ask in 2023 is, what is the probability the market has an above average year? Number one, I think it has a lot to do with credit markets, which, as you know, spreads have been stabilizing and rallying. A year after high yield has a negative year, which is this year. The average gain, 22%. I think volatility, which was really elevated this year, historically drops more than 20% in a year where it's averaged over 25, and typically the market gains are over 20%. And for those who think the Fed's going to crush the market, one thing to keep in mind is that historically from peak to max drawdown, when the Fed starts a hike cycle and then pauses, the average drawdown is 18%, peak to pause. And then, when the market finally busts, we've already fallen 20%. So we've already discounted a Fed tightening cycle. And that's where I think inflation becomes the big pivot because, for the last 3 months, inflation's annualized around 2.5%. I think that the February FOMC is really the time where
It's Tom Lee, in case you don't recognize the voice.
We're in a dovish trajectory, and I think that would be a huge catalyst for market.
When you say
Need to get above VWAP if you're bullish. Neutral to bearish below VWAP. RSI is making a higher low.
Yeah, you can correct core. You can do core CPI or core PCE.
Thank you, Rick.
Analyzed at roughly 2.5%.
Yeah, gotcha. And I guess the question then is, does that just leave us open to be concerned about what the economy actually is able to offer? The lagged effect of the tightening, all the leading indicators of inflation, of recession that seem to be taking shape.
That's definitely
Polly's trying to go.
Up, because on the one hand, people who pick stocks focus on the earnings decline, but as you know, when we
SPY getting rejected at VWAP.
If 2023 is a year where earnings are declining, but they rebound in 2024, well, one, markets begin to look through that. And in fact, on average, stocks bottom 12 months before earnings estimates bottom. So one of the things we have to wonder is this an extended earnings contraction that isn't already discounted by a 20% decline?
Got all sectors red on the day.
That's an interesting stat.
A flip from yesterday.
Talk about an earnings
Also, yesterday, a big flip. We had 98 stocks green. Today, we have 98 stocks red on the day. Tesla and CrowdStrike are the only green stocks on the NASDAQ.
Tom, given the fact that this is uncertain and given the fact that you personally, last I checked, I think you were street high in terms of where the S&P ends next year.
Yeah, I think it's I think that the least controversial view to make is that cyclicals could begin to work because, as you know, we've already had a pretty big decline in PMIs, and that would be industrials. I think that's going to be a more consensus view. I think one of the less, and I think energy still works. That's been our favorite sector since 2020. But I think one of the groups that could surprise us is technology. And I know investors have just taken a beating this year on tech. But there's really two reasons. Number one, tech is going to benefit from things that potentially happen near a bottom, like the dollar weakening, the Fed pausing and rates falling. That's just simply, has to do with valuation. But more importantly, as we think about the structural problem of labor shortage, which is going to continue, the historical solution has always been for companies to increase their investment in industrial and technology spend to create productivity. So the tech actually might have a tailwind because of a weaker dollar, and the sort of upside as companies begin to try to invest their way out of wage inflation.
Tom, what do you see as the single biggest risk to your thesis next year?
Well, I think the risk remains that the Fed has to stay tighter, and therefore it actually doesn't lead to a soft landing, it leads to an outright recession and maybe even a financial crisis. So I think the thing that remains the biggest risk is if wages actually accelerate, that wage growth, even looking at the sticky Atlanta Fed wage tracker, that's beginning to plateau. Even 3-month annualized is lower than it was 6 months ago. So if that begins to accelerate, then it means the Fed has a lot more wood to chop, and that raises the risk.
Yeah, clearly that is the higher for longer and tighter than we're hoping for the market's hoping for scenario. Good to talk to you. Thanks very much. Happy New Year.
All right, so far looks like maybe we've got a bull trap, maybe a bull trap. We'll see. Very difficult to trade this if we can't get any kind of follow through. We got a flat VWAP.
Homeowners in some states could pay 20 to 30% more for property insurance in the new year. We're going to tell you where and why. Squawk on the Street, second hour is just getting started.
Good to see you, Jamie. All right, so are we adding a few stocks? Baidu popping up on the NASDAQ 100 now. Baidu. Okay, let's see. Market net flow is still red on the day. Market net flow still red. Got to get more bullish indicators. Otherwise, I'm still neutral at the moment. Watching Tesla. Tesla needs to get above 124. There's a lot of supply at 125.
sara.org.
We continue to watch the travel sector. Southwest Airlines says it is planning to return to normal operations today. Seema Modi has a check on the sector. Hi, Seema.
Hey, Mike, that's right. After canceling roughly 13,000 flights in the last week, Southwest saying today's schedule will be back to normal. So far,
All right.
FlightAware shows about 40
Very slow
flights have been canceled
for
on
now.
Friday. In a letter penned by Transportation Secretary Pete Buttigieg to Southwest Airlines CEO Bob Gordon on Thursday, he wrote the department will use the fullest extent of its investigative and enforcement powers to
Baidu, Flat VWAP, CrowdStrike. These are green on the day. Flat VWAP. Tesla, Flat VWAP. EXC, Exelon Corp, Flat VWAP. Looking for a push here. Exelon, EXC. 60 minutes shows a trend. Trading at the highs. All right, SPY, we need to see a blast to the upside. Yesterday, note how we started. We had the 200, the 20 EMA crossing up through the 200 VWAP starting off up and to the right. Right now, we have the VWAP and the 20 EMA extended away from the 200 EMA. Looking for mean reversion back to 382.
Seema Modi, thank you. For more on Southwest's mass cancellations, the future of the company, and airline regulations, let's bring in former Continental Airlines Chairman and CEO and a CNBC contributor, Gordon Bethune. Gordon, great to have you on. I want to start with the regulatory piece of this. When you have the Transportation Secretary basically coming out saying they're going to use the full investigative regulatory powers to investigate Southwest and what went wrong over the past week, more bark than bite? How do you see it?
Good analogy. All bark, no bite. You got to look out the window and see the snowstorm. Take a look at Buffalo and tell me what went wrong there. So it's catastrophic. But winter, tend to be really bad times of the year. That's why companies don't put their picnics in some wintertime. It's a difficult storm, Southwest, and I got behind the technology curve, being able to handle all the growth they've assimilated over the last 2 decades, and it caught them. And it just compounded and started snowballing because of their unique routing system. It affected them more than anybody else.
Yeah, we've been asking this question and debating it all week, but how quickly can Southwest make the investments to update?
Only 4 stocks green on the NASDAQ 100. Sectors still red on the day. Everything is still red. Semiconductors were the highest on the list yesterday. They're on the lowest on the list today. We need to see buying. If you're bullish, you want to see a move above VWAP here. The furthest I would go out is 381. SPY calls.
Especially given the fact that some of the airlines have fared better this past week and maybe provide an example of how things
SPY calls. Starting to work. 381 as far as I would go out. 381.50 is the high. All right, so we got more buyers here. We got some bulls, some bears trapped now.
Same time, it's worked a lot of years for them, so you really can't just throw it out, without some deep thinking going on.
All right, NYMO's at minus 28. It almost got to zero yesterday from below, minus 60. All right, we got a high tick alert. Okay, nice follow through on SPY here. All right, that's exactly what we wanted to see. A push through 381 would be good. Watch for supply here. SPY 381.50 supply.
I don't think so. Demand's really strong, as you noticed over the weekend. Of course, this aberration, this storm, at a time when they overscheduled their resources because they were maximum revenue generating ideas.
Tesla moving back up towards the highs. Tesla about to go on a buy signal again.
But they still will be aggressive in growing. They have to be, given their business model grows so much every year. But I don't think that anybody's going to give up. Now, a letter from the Secretary of Transportation is not going to help anything. It's going to take some hard choices by the CEO and the people at Southwest of how best to proceed, and I think that's on the table.
The other big travel story that is unfolding right now is China reopening. I just want to get your thoughts on what that could potentially
Tesla going here.
as we head into 2023, what it means for
Need to trigger a buy signal on Tesla.
for pricing at a time where the world is so focused on things like inflation.
Well, Morgan, lately the international travel apps in China has pretty much returned to normal. And China's entering, and that's a huge, huge market. So I think that'll continue to grow. The COVID,
All right, VIX rolling over.
Trying to anticipate what our government's going to do in reaction to a country like China opening up.
VIX dropping off here.
But I don't see it. I see it as a boost in revenue, not as a negative.
Final question for you.
Hi, tip alert plus 800.
Since we know that there has been these growing backlogs at the plane manufacturers like Boeing, like Airbus.
Well, everybody's trying to get their hands on things. As you know, the Spirit JetBlue merger is an acquisition of assets. Those airplanes are difficult to come to because the market's there. As you can see from the traffic, the market wants to go. They want to travel. A lot of pent-up demand. It's just getting the airplanes and the crews together to do that reliably.
Tesla looking for a follow through over the next couple of weeks, maybe. Tesla.
Still to come, the impact of severe weather on the energy grid. The CEO of Generac will join us in just a few minutes. Don't go away.
Momentum shifting on Tesla. 50% retracement on SPY noted in the trading room. Okay, do we follow through or do we just chop around here? All right, we got a flat VWAP, so we anticipate when we get a flat VWAP that we'll have price contained in this area. Okay, so if you're looking for a move, the most you're going to get right now, it seems, is right here. The high and the low. That's what it looks like for now. VWAP in the middle. RSI rising. Okay, so that's mostly what we're going to see. We got flat VWAP. That purple line is VWAP, flat. All right, Tesla's at the high right here. All right, Tesla, keep banging against 124. They keep selling up there. We're making higher lows. All right, let me see what the 60-minute looks like on Tesla. 60-minute. Trying to trigger a buy signal follow through. 60-minute. 60 minutes on a buy signal. All right, SPY needs to get above 381.50. Next level would be 382.27. That's the 200 EMA.
Welcome back to Squawk on the Street. We want to get a check on Bitcoin this morning, which is down a little bit again today. It's trading below 17,000. It's lost about 2/3 of its value this year. Keep in mind, it's been trading in this tight range for some time now, between 16 and 17,000. It's now one of the biggest, I should say, now one of its biggest supporters, though, selling for the first time per a filing this week. That's MicroStrategy, which is led.
All right, there goes Tesla on
Who's still chairman.
trying to get above that 124. Keeps getting smacked.
For tax purposes, keep in mind, software companies still a net buyer, but MicroStrategy stock faring even worse than Bitcoin in 2022. It's down 75%. It's trading at its lowest levels since 2020. And
RSI still rising.
news that is in the headlines. We've got former FTX CEO Sam Bankman-Fried expected to enter a plea range before a U.S. district judge in Manhattan next week. Several former associates already pleading guilty.
All right, that RSI is still rising. That's bullish. Okay, we're above 50. Looks like we might take out 381.50. The gap over here is still looming large at 376.50.
Saylor, for example, has basically said it's a dysfunctional relationship between Bitcoin and the rest of the cryptocurrency market. But yeah,
And arbitrage, lending, and all the DeFi stuff.
nonetheless, the entire sector more broadly has come under.
Pally trying to go.
Tremendous. Yeah, we'll see. Seems to get stabilized. Coming up, a look at what the Fed has in store for next year and what's already priced in terms of rate hikes.
All right. Still a slow go this morning. What's DocuSign doing? DocuSign. All right, just sitting there. Boeing. Boeing is trending. Boeing's still trending. Defensive stocks, DFEN. Defense stocks. Flat, ITA. Flat. These looking for a follow through. SPY. The way VWAP is situated at the moment, we need to see a blast higher. RSI is saying that maybe we see a little follow through. Got to get through 381.50. Tesla looking for a follow through. Tesla, no follow through yet. All right, we've got all of that supply that we need to deal with. All right, some of those offers shifted down from 125 down to 124. 60,000 shares offered at 124. Tesla. So that's we keep tagging that 124 area. Everything had shifted up to 125 at one point. We still got 235,000 shares offered at 124.80, 125 Tesla.
Democrats in Congress have released 6 years worth of tax returns from former President Trump, having a multi-year effort to disclose the document. Much of the data has previously been released.
No follow through.
This document, though, includes more than 6,000 pages that members of the public can now examine. More evidence of rising COVID cases putting intense pressure on China's healthcare system. Newly obtained video shows patients being treated on the driveway outside a major hospital in Shanghai. International health officials continue to urge China to share any information about the country's latest surge in COVID infections. China says the U.S. is at fault for a recent incident where military planes from the two nations came within 20 feet of each other.
All right, pulling back into the range. You can see what we're expecting. Flat VWAP, looking for prices just the ping pong between 379 and 381, $2 range. That translates into a doji spinning top on a daily. Okay, we got an inside day. Day number 9 above 50% retracement at 375. 50% retracement from October 13th up to the 408 high is right here at 375. Noted on the S&P 500. 9 days. Just sitting here, all right? It's good that we see wicks along in this area. It looks like buying going on. We're still 20% off the highs. So we'll finish the year, if we don't push higher, we'll finish the year off 20%. Volume has been tapering off as we've been consolidating. That's a good sign. The opposite would be a spike, lots and lots of higher volume here at these lows, and then look for a drop off. That hasn't happened yet. Major resistance overhead at 3,900, that volume by price band, options. So right now we just don't have a lot to go on. Markets are just chopping around here between these levels. Pally's starting to rise some more. Pally rising.
Here's Goldman Sachs writing, we are skeptical that the FOMC will cut the funds rate until the economy is threatening to enter recession, and we do not expect this to happen next year. But then here's Nomura writing, inflation will likely underperform in the second half as labor market conditions weaken considerably with a peak unemployment rate of 6%.
All right, Pally.
And a gradual pace of rate cuts.
Some of you trading Pally, looks like it's going to go here. Lots of volume coming in. Pre-market highs 728.
Next year to around 7.4 trillion, still pretty elevated. I think that process is going to have more impact as the year goes by. So it might be a reason for the Fed to go a little bit slower at the beginning of the year and maybe stop hiking a little bit sooner, guys.
Interesting. Definitely going to be one to watch. I mean, a lot of this comes down to labor and what happens in the labor market, right, Steve? I mean, we saw jobs.
There it goes, Pally. Starting to take off now. Tesla just consolidating underneath that 124 supply. Looking for push higher in Tesla. Nothing yet. Yet.
Morgan, you can answer that question somehow better than I can. Talk to those great.
There we go. Ripping higher now. Pally.
And ask them how quick they're going to be to let the people go who they had so much trouble finding to hire. And my guess is they're going to say not so quickly. I mean, I think that Wall Street is always a little bit quicker to let people go. Some of the tech companies, well, they've run out of funding. They're repositioning. But I think a lot of folks are going to hold on to labor. So I think your use of the word sticky is the right word right there. I think labor is going to remain a problem. The question is whether other inflation aspects can come down around the labor inflation problem we might have. And that includes some of the goods sector. The clearing of supply chain has been an issue. Energy could be helpful depending if we can.
SPY back down to VWAP.
So we could get some help from those sectors and eventually even housing as the year goes by. Some of those lower housing numbers will work in. So an optimistic scenario for 2023 is maybe we don't have a huge gain in unemployment and we see inflation come down without a big gain there.
Yeah, that would be, kind of pretty soft as landings go. Maybe not even much of a landing, Steve. Thanks a lot. We'll catch you soon. We are about an hour into the trading session. Let's bring in our Bob Pisani. A closer look at what's moving on the final trading day of the year. Maybe put a button on this year.
Yeah, there's no gilding the lily on this. We're ending the year like we sort of were in most of the year. Value relatively outperforming growth. So communication, services, discretionary. Weak today, energy tend to be outperforming. The only real suspense left is whether we get a 20% decline or not. And folks, if we're watching that, it's 38.12 on the S&P 500. If we drop below 38.12, that would be a very rare 20% decline. Does it matter 19 or 20%? No, but for the history books, they tend to split that line there, 20%. Below 20% is a very, very rare occurrence here. Take a look at the major indices for the year. And the Dow has been the relative outperformer because of the prevalence that we saw. By the way, there you see the value and the growth sectors, energy, relative outperformance. But you see the Dow outperforming because the Dow has a lot of value stocks in it, the defensive names, consumer staples names, Merck in it, for example. That's why you're getting that outperformance. The S&P, as you see, just on the cusp down 20%. NASDAQ down 33%. 3812, as I said, on the S&P 500. That's what you want to watch. That's below 20%. You go down below that. So the bad news here, Mike, is this is the fourth worst year for stocks since 1945. There's no gilding the lily on this. Look at this. 2008 was worse. We all remember that. That was a 50.
All right, Tesla's starting to turn. Order flow starting to turn. It is red on the day now, Tesla. The order flow needs that to turn back up.
Down years like this tend to be followed by up years. It's very unusual to have two down years in a row. That's an extraordinary rare situation. It only happened 4 times in about 80 years or so. So number of down years is about a quarter since 1945. 21, that's 27%. There's an average gain of 14% the following year. That is above the typical performance of the S&P 500. And it's an up year when it's down 4 out of.
All right, looking for a bounce off of VWAP here.
That's very interesting, Mike. That is a little different about down years the following year is the losers tend to do better in the following year in a down year.
Tick cumulative has turned up. It's 1-to-1 up-down volume now, so anybody's game to win at this point. We're sitting on VWAP.
That's right. So it wasn't always straight up in the new year following it, but and there are very few years. Those 3 other years really sort of distort the picture rather notably. So there are extraordinary events, and really the cusp of the debate is 2022, 2023 one of those really rare events, like a 73, 74, like a 2000, 2002, like a 2008, 2009. We have and like COVID, where you have an extraordinary confluence of events that just create a firestorm. Sure.
All right, Fapasani, thank you. Happy New Year.
Thank you.
We're going to turn to energy across the board. Commodities closing the year strongly. WTI on pace for its second year of gains. Nat gas on pace for its third. But a brutal winter storm fueling millions to lose power, raising questions about whether the country's infrastructure is up to snuff. Joining us now, Generac Chairman and CEO Aaron Jagdfeld. Aaron, it's great to have you back on the show. A lot to get to today, but I do want to start specifically with this storm and what that's meant for your business and demand for it. I would imagine you've been fielding calls this week, given the fact that we did see these power outages in such cold weather in so many parts of the country.
Yeah, thanks, Morgan, for having me on. It was not only the cold weather, but obviously the timing. That's right. I mean, it's over the holiday weekend, which I think that changes your perspective on just how important power is when you lose it on a holiday. You know, you've got your family coming in, you've got you know, a lot of plans, and a lot of those plans were ruined for 2.5 million households here in North America. And I think it just, you know, again, continues to point to the fragility of the nation's power grid. And it's a, you know, continues to be.
All right, I bought some SSO. SSO, that's the ProShares Ultra S&P 500. I filled at 44 even on the dip here. SSO. That's a swing trader alert from yesterday. Just been watching this dip today. Okay, looks good. SSO, looking for a follow through. Got to stop if it takes out the low of the day.
Versus what we saw last year, for example, when you just couldn't make generators quickly enough to get into the hands of the people that were looking to buy them.
Yeah, that's right. I mean, we actually had a great year this year in terms of productivity. Right? Like we ramped our production because we did want to catch that backlog we had coming into the year. And what we ended up doing is we outstripped our installation capacity. So our network, you know, they weren't able to hire enough labor, they weren't able to get the permits pulled. And so we ended up with a higher than expected level of field inventory, which is, you know, obviously going to be something we've got to work through here through the fourth quarter, and then as we've indicated through the first half of next year. I think the good news is, you know, underpinning, you know, the underlying demand for homeowners remains strong. As we said in the third quarter, it was leads for home standby generators. And again, it goes back to what we just talked about, things like the winter storm that just went through, the hurricane season, all of the different reasons why we're seeing people lose power. People are concerned about that. They're concerned about that at a level that they've never been concerned about before. So I think that's just something that, as we think about the long term here for business, we'll return to growth again. We only grew 20% this year, we grew 50% last year. So the market was disappointed in that. We were disappointed in that. We thought we were going to grow more than that. But again, longer term, we feel like we're definitely catching all the mega trends here that are going to be able to propel our business forward.
So just to dig into that a little bit further, housing recession, or even if we were to see in next year more broadly an economic recession, you would continue to grow despite that?
Typically what happens is, people think of us as a discretionary, and that may be fair when your power's on. But when your power goes off, you lose power.
All right, SPY, just flat VWAP, no follow through. Doesn't seem like anybody's interested at the moment.
And it goes from being a discretionary item to a must-have purchase. It goes to the top of the list, if you will, in terms of home improvement projects very quickly. And so, in my time at the company, almost 3 decades, we've witnessed, a decoupling when we do see the economy start to go one direction. Our business can go the other direction with outages. So that's really
Tesla, no follow through, just stuck.
While it might be a discretionary item on an everyday basis when your power is on, as soon as your power goes out, it becomes a necessity.
A lot of focus, Aaron, in terms of how your business has tracked this year on the clean energy component of it, the storage products, and working through some of those issues. Where are you with all of that? I know that there's been some, sort of product issues you've had to kind of make good on. So that seems to me where a lot of the investor focus has been for a while, as opposed to, the core.
Yeah, it's a great thing we should talk about. Right? I mean, exactly.
Boy, this is a very slow day.
From our core markets, which are focused on internal combustion engine gensets, which are great products, by the way, and have a lot of life left in them, but focusing on future technologies like energy storage. So about 3 years ago, we
Back down to the morning lows, it looks like. Tesla.
Areas that we believe are going to be really important areas in the future as the grid changes and evolves, and as homeowners start to take much more control of their self-generation of power, their resiliency around storage, with battery products. And what we found is, frankly, we found a lot of success early on, and then we kind of ran into some stumbles. And so some of the acquired products, one company in particular, we had a product problem that we had to take care of here and do an upgrade. And we had to take a special charge for that.
Boeing starting to go.
A partner of ours that filed for bankruptcy.
Boeing strong.
Negative drag on the third quarter. So we're working through those issues. We're committed to that, those future technologies, because we think it's an important.
Pally, nice trade there, Mondo. Pally.
We need to go as a society in terms of just continuing to focus on the importance of renewable energy as a component of our energy landscape. And so we think Generac has every right to play there with our distribution, with our technical skills, and with our brand. I think we're going to be a big part of that.
Yeah. It doesn't seem like the street's really focused on that in terms of many analysts' take on the company. So what do you think it's going to take for that narrative to actually impact the stock in a positive way? How quickly can you meaningfully grow that business to get to that place?
Yeah, that's the interesting part. Again, it's always a small part of the business starting out, right? This is a long journey that we're on, this evolution. And we got credit almost immediately in terms of the increase in our multiple, at least, to some degree, for that part of the business. And then I think when we had our challenges here in the second half of the year, clearly the multiple compressed, and that was a part of what you've seen in terms of pullback in stock. And then in our core markets, as we talked to, that inventory, the field inventory position was the other part of it. So I think in answering your question, Morgan, I think what we need to do is we need to demonstrate that we can be successful in that clean energy and the energy technology segment that we're going to grow. We do think that it can be up to a third of the total company here in the next 5 years. So that's really what we're focused on. If the technology continues to improve, we think we have every right to play and win in that space. And we think it's going to be a big part of the business long term. That said, our core markets, like the home standby generators, only 6% penetrated in U.S. households. So every 1% of penetration is a $3 billion market. We've got 75% plus share of that market. We basically created it a decade ago. And so a lot of runway left in those core markets as well. So, we need to execute better. And the third quarter was the first time we've missed a quarter in about 20 quarters. So I think we need to show the street that we can get back on an execution strategy.
Okay, Aaron Jagfeld, Generac Chairman and CEO. Thanks for joining us and Happy New Year.
Happy New Year.
As we head to a break, let's take a look at the biggest winners from a sector perspective this year. Energy, of course, topping the list, up 58%. The only S&P sector in the green for 2022. Utilities, consumer staples, also holding up better relative to the broader market. We're back in two.
All right, so Poly halted at 757. Mondo got in around $4 this morning. Nice job. Company offered 2.5 million shares, $2.5 million worth of shares this morning. Private placement. And it continues to squeeze. Look for a little dip now. Look for a dip to buy. Nice job, Frana. Oh. All right, so SPY just sitting here. Tesla, a lot of stocks doing the same thing. All right, watch for a little dip here. All right, it's open again. Poly's open again. Poly opened again after a halt, following through. Huge volume trading today. All right, SPY looking for a follow through.
Nearly 19% in the 5 years ended 2021. That's according to the Labor Department. That as the space economy has blasted off. But the diversity of those strong employee ranks has not kept pace. So an industry initiative is looking to tackle that problem. Christine Cruz is a senior at UC Irvine.
All right, so we need to get above this 381.50 zone. All right, Poly's going. Poly going again.
Here at Aerospace, I think they really have a lot of confidence in the interns, and they will give you work to do on your own. So you do feel like you're not just being with your hand held. You are able to do the work yourself.
Cruz may soon be joined by thousands of additional students across the industry this coming year. As the space economy has blasted off, so too has demand for engineers and other highly skilled workers. But the diversity of that talent pool has not kept pace.
you'll find that the number of women and people of color are about 1/2 to 1/3 of what's represented in our society. And those numbers really have not improved that much for the industry.
So the Aerospace Corporation crafted the Space Workforce 2030 initiative, an industry effort comprised of 4 goals to bring more women and underrepresented groups into the worker fold.
All right, SPY starting to break higher. Looking for a follow through.
It's clear from the research that companies innovate better, the more diverse your workforce is, because you've got people with different perspectives that come in and see things differently. And we are in the innovation business.
The first of its kind pledge quickly swelled to involve more than 30 companies, including
SPY starting to push into the gap. Into the gap.
to students. An early participant, Slingshot Aerospace, a startup co-founded by Melanie Strickland that tracks space debris in orbit.
For me personally, to watch the entire industry come around this Space Workforce 2030.
High tech alert plus 800.
High tech alert.
For 25 plus years, and this is definitely a new start.
Space Workforce 2030 was unveiled in April at a big space conference, what's called the Space Symposium. But as with many things that are space related, it is a mission that is expected to take years to come to fruition. That said, prospective interns, who will be called the National Space Interns,
Poly is up 155%.
is actually February 4th.
Starting to push again. Looking for the next halt.
Because so many different companies, both large and small within the industry, are involved in this now, and you have a growing list of colleges that are participating too.
I can't imagine it's a hard sell to say come work, to put things into space relative to other options. But yeah, I mean, also so much competition for those people.
Yeah, so much growing competition. There was a time where the employees of SpaceX and Blue Origin were sort of seen as the new next gen employees, the new next gen workforce, right? And now those companies, those startups have grown to a place and have been around long enough that you have some of those companies going out, becoming entrepreneurs and starting their own entities as well. So there's an excitement here, and I think
Poly pulling back.
Start to see more and more folks come to the industry. By the way, across different studies from colleges, which I know in the case of Strickland and Slingshot Aerospace, they're not just looking for
SPY getting rejected at the high again. Flat VWAP.
creative in terms of where they're recruiting some of those interns from.
Very interesting. Well, a programming note as we head to break. Don't miss CNBC special tonight at 6 p.m. Brian Sullivan hosts Taking Stock 2023, The Economy. The show will take a closer look at the bond market, the outlook for the Fed, and what's in store for the consumer.
Yeah, Deckers has continued trending. Yeah, Ali, I agree. DDS looks good too. All right, Pally halted on the way down. Still up 121%. Looking for a SPY to break out. Ali talking about Deckers. Yeah, Deckers on the extended watch list down below. Deckers looks good. It's been trending above the 921 50-day. 50-day is almost a straight line higher. Looks good. RSI is above 50. And DDS, I bought a lot of presents at Dillard's over the holiday. Looking for a follow through. All right, SPY still looking for a follow through, but getting rejected at the highs, exactly where you would anticipate with a flat VWAP getting rejected at that high. Tesla, lower highs.
Coming up next hour on Tech Check, Dogs of the Dow. A deeper look at Cisco, Intel, and Verizon. Plus, an important
All right, back down to VWAP. SPY back down to VWAP.
the next hour. Don't go anywhere.
All right, SPXU bouncing. A lot of flat VWAP. Low momentum. All right, Netflix is pushing away from VWAP. That looks good. Netflix. Let's see what Netflix is doing. Netflix. Pulling away from VWAP. About to go green on the day. Netflix. All right, what's First Solar doing? These stocks that are below the 50-day watching. First Solar hanging tough. Added to the S&P 500 last week. Along with Steel Dynamics, both of these added recently. Steel Dynamics pulling back a bit. SPY, flat VWAP, Tesla flat. All right, below VWAP now, chopping around. Expect the test of the low.
Hi there, Mike. Floridians pay nearly 3 times the national average, the most in the nation, according to the Insurance Information Institute, and on track for 33% annual increases. The cost for insurance is so high in Florida, it's so hard to get. The real estate development deals are actually imploding, according to Lockton, a global brokerage. Costs are skyrocketing for insurers, inflation, of course, lawsuits, fraud, and then, of course, monster storms like Hurricane Ian. Factors that forced more than a dozen insurers to fold or flee the state altogether. Another 24 are on a financial watch list. The legislature has just passed a new law to tackle some of these systemic problems. No more one-way attorney fees, where the insurer bears the cost of the plaintiff's lawsuit. APCIA, which represents insurers, says That lines the pockets of billboard lawyers at the expense of consumers, pointing out plaintiffs' attorneys get nearly 3/4 of what the insurers shell out. This new law also bans the assignment of benefits, where a homeowner signs over the right to make a claim to a roofing contractor, for instance, who then in turn can sue the insurer even without the homeowner's consent. That led to both fraudulent claims and more lawsuits. might be actually. They
RSI still drifting lower. SPY drifting lower.
I want to credit Worth Charting. That's where I got some of this research from. And they kind of consider a stock like Verizon and IBM as basically a bond. You know the revenues are going to be stable, but the dividends really separates it from other stocks because you know that's going to come in. I mean, an IBM, a Verizon, some of these other Dow stocks, you are generally pretty sure they're not going to cut that dividend. So it gives you some certainty about return there. But as you mentioned, you know, when it comes to price action and growth in the company, when it comes to an IBM or a lot of these blue chip companies, of course, you're not going to get that rapid growth.
SPY pulling back more.
Or a CrowdStrike or a Datadog or some of these high, really growthy names.
Yeah, and I have to point out, though, just to go back to IBM, because this is such an interesting outlier there and an unexpected winner, that, you know, we talk about IBM as a 111-year-old company, but we have to remember that this is a company that did a major acquisition just a couple of years ago with the 2019 acquisition of Red Hat for $34 billion. So sometimes you have these old companies that transform themselves through acquisition, and I think the question going forward is how much more transformation is there in the works, or is there potential to do for a company that does have such a long history?
And I think there are some questions about that acquisition strategy as well, right? I mean, one of the complaints about IBM for many years has been questions around financial engineering, right? And they just recently split up the company, Kyndryl, and now the new IBM. And how can you read that? I mean, that's always been a question too. How much?
AbbVie pulling back today. AbbVie back below the 21-day. That was on the watch list this week.
I agree with you, Julie. I think that Arvind Krishna has been taking a slightly different strategy, increasing capex. We'll see. We'll see if that turns out for another year. It'll be exciting ahead, or maybe it will be really boring because honestly, these are boring names. That's what the market wants right now.
Yeah, the
Calmaine Foods that had earnings this week, sitting on the 200-day.
The major shutdown of all those Southwest flights. There is a Southwest IBM connection. Southwest operated on IBM mainframe hardware. Yeah. There was some press coverage of that. You have to wonder, Frank, how much that kind of conversation could ding the fact that this is an old tech company.
I mean, you know, I think you guys are making some great points. It's certainly an older tech company. And, you know, Joey, you point out that acquisition of Red Hat, kind of a push into hybrid cloud. But right now, we are seeing what may be considered a stalling of that cloud transition. And so maybe a lot of companies, they want to turn to an IBM, which is a multifaceted player, can offer different services at the same time, as opposed to these specialized cloud names that are really at the top of the stack. They do one particular thing. A lot of them have really struggled because companies more and more are saying, hey, I'd like you to do
Tesla continues to fade like it did yesterday.
Chanos, by the way, game short seller, talking about IBM's potentially outdated mainframe hardware and software that may have a part to play in this whole Southwest.
Calmaine, watching that one. That's from the watch list, sitting on the 200-day.
Back when they still did World of Watson, that they touted, that said was this, you know, big AI driver had so much information, so much data that was going to help air companies, flight companies, sort of read the airways a little bit better. And I don't know, it's a big question mark after the last few weeks of travel.
Trending on GFF, Permian Basin, PBT.
Ring in the new year by joining CNBC Pro. Invest like a pro in 2023 with a special year-end offer. Go to cnbc.com/pro new year or scan this code now.
All right, Permian Basin also strong. That's a real estate REIT specializing in oil and gas leases. Texas. Was it TT? Texas Pacific, TPC? Is it TPC? No, Texas Pacific. TPL. All right, that's been a descending channel. Look for that to push up. That's oil and gas leases in Texas Pacific, TPL. Permian Basin looks better, PBT. Permian Basin. SPY still drifting lower. Meta drifting lower. Meta no follow through. Stocks no follow through. Tesla. All right, SPY still drifting back. Flat VWAP, so range bound between 381 and 379. VIX still pushing higher. Meta failed on that breakout. We hit 121 yesterday, gap down today, making higher lows, but it's breaking this uptrend intraday. A lot of stocks are doing the same. All right, VIX still pushing higher. VIX, SPY pushing lower.
Welcome back to Tech Chat, everybody. I'm Contessa Brewer. Here's what's happening. Tracking site FlightAware says Southwest has only 41 canceled flights today, about 1% of the total. Southwest stock is also rebounding. It's up another percent today, but still down 6% this week. Shares of Shaw Communications are soaring 10%. Canadian regulators approved Shaw's takeover by Rogers Communications. The $15 billion deal will create Canada's second largest telecom firm. Mortgage rates in 2022 posted their biggest annual rise ever. This despite a modest pullback since November. Freddie Mac says 30-year fixed mortgage rates are finishing the year at 6.42%, more than double the 3.11% at this time last year.
All right, looks like we're headed back down towards that 379 zone.
Closing bell at the Tokyo Stock Exchange to finish up the year's trading. Kishida says he faces a lot of policy challenges to make sure Japan's economy thrives in the new year. Japanese markets get a longer New Year's holiday than we do. They don't open again until Wednesday. Frank?
Yeah, they're doing it right over there, Contessa.
We should try to push forward something similar, yes.
All right, Happy New Year, Contessa. Great to see you. All right, we've seen all sorts of new products and ripples across the tech landscape, from AI-powered essays to new VR headsets and even legs in the metaverse. Joining us now with our expectations for 2023, senior personal technology columnist at the Wall Street Journal, Joanna Stern. Happy New Year, Joanna.
Happy New Year.
All right, let's start off with one of your predictions, really focused on the VR, AR space that Meta now has about 90% control of. What's the big prediction? I'm going to use some spooky fingers you can't see. I want you to look in your crystal ball. What are you expecting?
Well, exactly what you said. More of a melding between VR and AR, right? The idea that we can't see anything else around us in our real world with VR, right? We go to a virtual world. With AR, we put things in our real world. And that's something that Meta did last year with the Quest Pro. We expect others to join this space with similar types of headsets this year. First is going to be HTC coming out at CES with a similar type of headset where you'll be able to blend AR and VR. And then the big question mark, and I'm going to put on those spooky fingers and look into the future, is it going to be Apple? Is this going to be the year we see this long rumored headset, which is supposed to do exactly what I've just been talking about, VR and AR, blending the real world with the virtual world. We've been hearing reports, specifically Bloomberg has reported that this headset is coming out later this year, or later in 2023 to clarify there, and that it's going to have 3D immersive versions of FaceTime, Maps, and other types of Apple apps.
All right, let's talk about something else that's spooky in investors. I'm not going to use the spooky fingers. This is serious. Cryptocurrency. We just had our stock survey where 81% of investors say they're not even going to touch it What do you see for the crypto space going into the new year?
I think we're going to continue to see more of some of that spooky stuff, seeing sort of the negative side of things. We talked about in this piece, actually, some of the scams around crypto. Really the idea that this might not be the year anymore where we hear of average people investing into crypto, more people being worried, more people hearing about those scams, more people hearing that their investments have really gone nowhere.
Hey, Joanna, it feels like for next year, the most promising or exciting technology, it isn't hardware, it's software. ChatGPT obviously caused a lot of waves here in the Valley and beyond. How do you think that's going to manifest itself next year?
Yeah, I think next year we go from what these tools have been, are really toys, to tools. The fact that we actually see practical uses of AI in both our personal lives and our professional lives. We're already starting to see companies like Adobe, Microsoft put these types of generative AI tools into their products. I think there's going to be a lot more of that. I think OpenAI is the really key one to watch. How are they going to go from these sort of research projects to actual pieces of technology that we all want to use?
Joanna, I'm so glad that Deirdre asked about.
All right.
We've seen this year. I guess the question is, when we see the excitement there, what happens with social media?
All right, stock's starting to bounce.
TikTok, Twitter, do we see more innovation out of the likes of Meta? What do you expect?
Oh, Joya, you brought down the conversation. I think, look, it's the big question is what happens to Twitter next year? I think that's a big player there. Does it become the real true town square of the world, or does it just get
Kala continuation. Halted again. Holy crap.
Wondering, hey, what's going on here? So that impacts a lot of the other companies. I think it's really sort of the ball's going to go in Meta's court. What can they do to sort of pick up some of those Twitter users? Is it about building up Instagram, other parts of Facebook? We've seen others go to sort of these third, I would say, open source type of social media networks like Mastodon and others that are up and coming. So will those be bigger? But obviously around TikTok, you brought that one up too. Lots of scrutiny there on a total opposite thing, which is really the security there and the China relationship.
Yeah, speaking of regulation around these issues, one thing I'm so curious about is whether we will see a surge of concern around privacy. I mean, obviously we have regulatory issues in this battle between, Facebook, Instagram, and its parent company Meta and Apple over the targeting of ads. But you've talked about a lot of technologies like earphones that are gathering data about you, or in-home devices that are talking to each other. Will there be a moment that comes at any point, let alone in the next year, where American consumers are like, geez, I don't feel safe from a privacy standpoint?
Well, I think that point has happened, right? If you look at some of the data, actual users are concerned about privacy. The big question comes back to regulators. Are we ever going to see a national privacy regulation? That's been happening at the state level, more and more states, California, Maryland, they keep doing more along the states for protections, but will we see that at a national level? I think the question around the hardware, there is going to be some big movement in the smart home space. What's coming in September?
All right, nice little bounce here.
All of the Apples and the Googles and the Amazons, all of their smart home products work better together. There are some strict privacy settings in that don't allow the sharing of data, but of course, each of those companies do want to gather data to make their products better, but also, of course, serve you more of what they want you to buy.
Joanna, I'm going to shift gears a little bit. Typically for the holidays, for Christmas,
RSI rising.
gadgets. I didn't get a single.
All right, we're back to VWAP. It just looks like a flat VWAP day.
Did you get any that you think
Very tough to trade these.
part of your life next year?
I mean, no, I bought my kids are too young, really, but I bought them an iPad, if that's a thing, and an Amazon Kindle Fire tablet. So I wouldn't say those are the most exciting tablets, but that's sort of been the story of gadgets for the last couple of years, right? Commodity type of devices, things people need, smartphones, tablets. I did just mention smart home. I'm very excited about that. I did move into a new house in 2022, and I did buy a bunch of smart home stuff. I did buy myself light switches. Is that a present to myself, I guess? Deirdre, I can buy you some light switches if you'd like that.
I got those. That was like a few years ago, Joanna, the smart light switches for your tree and stuff. But I mean, like in AirPods, right? Those were kind of life-changing. I haven't really seen a product like that for a while.
And I don't think it's going to come this year, right?
Tesla's still making lower highs.
The VR AR headset that we were all wondering if Apple's going to release, and these others from Meta, it has not gone mainstream. And it's funny, always around the holidays, you see the Quest rise up in sales. You also see the app rise up in the App Store. But are people continuing to use that throughout the year? And so I think it's all eyes on Apple to prove to us what's the mainstream use of AR and VR.
Yeah, Joanna, I got one of those. I almost never use it, but I'm not going to make this about me. Before we let you go, of course, we got to talk about Apple and Apple and regulation. A lot of people talking about that shift to the USB-C. Is the government going to step in and do something about that as governments in other places have as well?
Yeah, I think this year.
Pally continues this fade from the high. It's $3 off the high.
And this is because the EU is forcing Apple's hand on a number of issues. The one being the big one that you just mentioned, USB-C. That is by 2024, the EU is requiring most gadgets to have that common port. So that is that USB-C port. And so I think.
All right, SPY pushing back up.
Move to that port. They have already said publicly they will comply with that law. So everyone will freak out about this port change, but I think it's a good thing. We can talk more about it in 2023. I look forward to it.
SPY trying to get back above VWAP.
The phone is another piece of legislation out of the EU about competition, and will that impact Apple's App Store policies? Will they allow third-party app stores? The Journal and others have reported that Apple is looking at putting on third-party app stores onto the phone, but we won't know till we hear from Apple.
Well, Joanna, great to see you. My prediction is that with me and you, Spooky Fingers is going to be a new thing. We're going to be doing the Spooky Fingers. Thanks for your predictions for 2023. Before we go, let's take a look back at the tech that we lost in 2022.
All right, getting a nice little follow through. 381s maximum.
So, should we just do ourselves?
Just tearing up just a little bit, guys. Just over the iPod, though. Just over the rest of them, I barely were aware
They
of.
still make iPods? I mean,
Yeah,
iPods, really?
They all meant so much to me. I mean, I could say so many nice things about all of them.
Really? The Stadia? What would you say?
Well, not that one, but I would say, cloud gaming. Cloud gaming is still a thing and will be a thing. It just won't be Google's thing.
What'll be on next year? That's the question. Yeah. Twitter?
Maybe.
I don't know. All right. I won this year. You were like my senior prom. It was a very special time, but it's over. All right, Joanna, thank you for being here. Really appreciate having you here.
Great to be here. Happy New Year, everybody.
Love those predictions. I missed the Snap Pixie. I thought that was a really, really cool one.
All right, so we're pushing above VWAP. Still a flat range.
Special at 6 p.m. tonight, Taking Stock 2023, the economy, covering the outlook for markets, Fed policy, and more in the new year. We'll be back in a moment.
Okay. RSI rising. All right, Pally back above VWAP. Starting to go now. Kind of a non-eventful sort of day. Fang stocks. Boeing. flat. Netflix is making higher highs and higher lows. That's trending. VIX is trying to bottom here. SPY right at VWAP in the middle of this range. All right, let's see what's working. All sectors are red. Very low volume. Last trading day of the year. All sectors are red. Unless that changes, SPY not expecting much. Las Vegas Sands, we got a follow through. Second day higher. Take two. Ulta.
Women made up more than half the jobs added every single month except for January. They comprised 56% of the 4.3 million jobs that were added over the course of this year. Now, when it comes to the CEOs of the largest companies, women are still vastly underrepresented. There are currently 38 female CEOs at the S&P 500. That's up from 33 in January. But when it comes to wealth, there was even less progress. The number of women on the Forbes 400 wealth list increased by just 2 women over the year to 58 women in total. And this year, the gender pay gap remains flat. Women on average continue to earn 83 cents for every dollar that white men earn. And female founders actually have less access to capital than they did last year. PitchBook reports that through November, female founders raised 2% of venture capital dollars in the U.S. That's down from the 2.4% that they drew in 2021, and an average of about 3% over the prior decade.
Win, trying to turn. Patchy looks good. Tapestry higher. Oxy trying to turn. ConocoPhillips trying to turn over the last week. TJ Maxx. TJ Maxx, excellent looking chart.
Really important stats there, Julia. And you know what's a good read if you're interested in this? When Women Lead by Julia Boorstin. If you haven't got it yet, you should very soon. We'll be right back after this quick break.
Lock in your membership now. Join Jim Cramer and the CNBC Investing Club with the special year-end discount. Go to cnbc.com/club new year or scan this code to sign up.
All right, looks like TJ Maxx might go a bit more. Let's see, the weekly looks good. It's at highs. Looks like it could be distribution too. Yeah, wife just responded to a text about the Idaho murders. Thank you, Beagle. Pally, I might take some with you guys if this starts to lift. All right, if volume picks up, Pally might go again. Kind of a boring day, so I'm just looking at what you guys are watching. Not big on stocks under $5, $10. If this starts to pick up some volume, it could be pushing higher again. Volume tapering off. So right now it's not a play. Volume needs to pick up again, like these big spikes, especially this morning. MACD turning, stochastics down there near the lows. RSI below 50. All right, but stocks that are playing, big cap stocks that are working, Las Vegas Sands, holding this 46 level for 4 weeks. Win, same thing for the last 2 weeks, sideways. S&P 500, the Dow Jones, JP Morgan's been trending higher for the week. Since Thursday last week, JP Morgan, Verizon, CVX, Boeing flat at 190. Merck still trending lower. Okay. NASDAQ. Poly's up 91%. Poly on the NASDAQ. Kala. Is that one halted again? Kala. That's insane. Can't believe that was trading at $2 or $3. Kala looks like it's going to go again. Kala pushing higher again. Looks like it wants to go. That's insane. Can't believe this stock has moved as much as it has this week. There's going to be some really disappointed longs that get stuck up here. I wouldn't chase it up here. I'd take profits and call it a day. All right, Kala's starting to pull back. All right, so we got some longs getting stuck up here. I wouldn't trade this up here. I'd be out. If you got into this when Mondo first mentioned it. All right, these meme stocks, Apple, tons of puts coming through here. Uh, 120 strike. And that is for 0119. A lot more puts. Apple. All right, Pally starting to find bidders. Pally bidders. A volume. Kali, you got volume and bidders coming in. For those of you trading Pally. Palisades Bio. All right, the volume's starting to pick up. There's your volume right there. All right, this could get ready to go. I'll buy some shares if this takes off.
They stepped down, and the Ladders firm finally sold their first Bitcoin holding this week. Of course, all of this has culminated in the collapse of FTX and the arrest of CEO Sam Bankman-Fried, who faces criminal charges and up to 115 years in prison. The industry hasn't entirely collapsed, though, guys. The world's largest, crypto exchange, Binance, it is still in business, though questions are swirling, and some of the biggest stablecoins like Tether have been able to stay tethered to the dollar despite a few hiccups. If the FTC and CFTC do crack down, what does the future look like for the industry as a whole? Guys, it has been such a wild year. There have been crypto winters before, but we've never seen crypto really capture the mainstream like it did this year and then crash so spectacularly. Yeah, such a dramatic end to the year with this FTX implosion. And, it's been fascinating just to talk about it with both of you this week off air. And one thing that, Frank, I know we're very curious about is this question of whether retail investors, consumers are going to want to stay away from
blocks. There's not many block trades today.
the whole scandal around FTX and whether they sort of take that as a sign that they should just stay away from anything crypto related.
I'm not expecting much today.
Like that regulation might be the best thing for the crypto industry. I mean, you look at what regulation did for banking. Obviously, I'm going back 100 years to the Great Depression. But once people knew the deposits were safe, they felt more comfortable putting their
More volume coming in, Polly.
It's a very similar situation with cryptocurrency. Now, obviously, it can't be covered by the FDIC that insures all of our bank accounts at a traditional bank. But there certainly has to be something else that the CFTC can do or someone else can do to make it so if you put your money in a Binance, if you put your money in a Coinbase, or in this case, an FTX, you can at least get that back.
Well, or you just take up the exchanges altogether, right? As some Bitcoin evangelists would argue, just keep it in cold storage, which is maybe what we see in the year ahead. As we mentioned, Sam Bankman-Fried is expected to enter a plea next week in New York courthouse. Two of his former associates, Alameda CEO Caroline Ellison and former FTX CTO Gary Wang, have already pleaded guilty and agreed to work with prosecutors. Bankman-Fried is being charged with multiple charges of wire fraud and conspiracy, and if he is convicted, he could face more than 100 years in prison. And joining us now with what he expects next week, former federal prosecutor Renato Mariotti. Renato, given all of that, what exactly does Sam Bankman-Fried have to offer here in any kind of plea deal?
Not a lot. That's the problem for Mr. Bankman-Fried at this point. The feds already have as you mentioned, two of his closest associates agreeing to cooperate against him. As a practical matter, they have him dead to rights. They feel very confident about their case. So he's going to have to do essentially what prosecutors try to cooperate down.
Caterpillar, yeah.
Cooperate against people.
Caterpillar's on the watch list. It's been looking like
associates, people he did business with, people who invested. That's possible.
it's been looking like
He certainly could get some credit, but he's going to get a lot less credit than
distribution.
Ellison got because she was cooperating up against him. So I expect him to serve a substantial prison sentence, really no matter what he does, unless through some sort of miracle he's able to beat all of these charges, which I think is highly unlikely.
Yeah, that does seem highly unlikely just looking at all the data. But I'm curious, looking at the situation, what other shoes you think are left to drop? I mean, we just saw
Caterpillar.
And Gemini.
All right, pulling back in.
Action lawsuit earlier this week. Do you think we'll see more lawsuits come as part of the sort of the dam that broke as a result of this?
Absolutely. So first of all, everyone who's done business with FTX has to get a lawyer and figure out their own potential liability.
Yeah, if it does pull back.
If they're, for example, a publicly traded company or they have their own investors or customers, they have to be concerned about that. You can imagine lenders and those who extended credit to FTX are going to be potentially considering suits. So there's going to be a whole slew of lawsuits that are going to be kind of reverberating out from the FTX debacle. And then, as I think your guest mentioned a moment ago, there's going to be a regulatory response here. I actually think, yes, there are some in the industry who want more regulation. I think that is likely whether it is invited or not. There's definitely increasing regulatory interest in the crypto space.
I have a question about restitution for the people that were negatively impacted by all of this. When Sam Bankman-Fried was down in a very Tony villa in the Bahamas, he claimed that he wanted to help out all the people and do what he could to get people back their money.
All right.
Can prosecutors actually enable?
That's +1 on Pally from that bounce.
Amazing. Fraudsters always have, at the end, they always want everyone to get their money back, but they usually spend a good portion of it, and so there's not 100% of that money remaining, which is how they got themselves into this
Capali looking good.
A restitution order entered if and when he is convicted that will require him to pay 100% restitution to everyone. But as a practical matter, it's hard for me to see how he possibly has the ability to get 100% of the funds to everyone who's been impacted here. You can expect there to be some expiration of clawbacks. In other words, people who got
Pally, nice reversal, pushing higher.
You could see some argument that there might be some
SPY's flat. Yeah, Caterpillar looks like distribution up here.
Mario, looking back at Sam Bankman-Fried's, let's call it a media tour, right after everything sort of collapsed. He was on Twitter Spaces, it felt like every day or multiple times a day. He was giving a ton of interviews, all with the sort of intention to say that what he did was unintentional. Does that hurt him now as he heads to court?
Yeah, I have to say, if you were trying to think, what is the absolute dumbest thing I could do?
Tesla, looking for follow through and a pop on Tesla.
Every day for hours and give recorded interviews answering very difficult, hard-hitting questions.
Thank you, Stephen.
Everybody possible.
Tesla turning ABCD pattern. Tesla.
I was incredibly foolish. He's totally boxed in. If I was representing a client,
SPY going.
I would basically tell him that as a practical matter, he has no room to go in his testimony because he has essentially locked himself in by all of his prior statements.
Well, he admitted that he was not following his lawyer's advice.
Polly, watching Polly.
We'll talk to you again soon. Happy holidays. Have you missed part of the show? Don't forget to
Here goes Apple.
subscribe to our podcast. Listen anytime, anywhere, wherever you download podcasts.
Hi, took a
There goes Apple.
800.
Apple going there. Back up to 129.25. Tesla, lots of calls. Tesla call flows, the 125s, 140s. 0106. Pally pulling back now. SPY trying to push higher. Flat range bound action. Until it's not. All right, SPY pushing a bit higher. Apple looks like it wants to go a little bit more. Meta bouncing off of VWAP. NVIDIA going. Apple looks like it's going to take out 129.25 here. Apple. Got volume coming in. Apple. A lot of calls. 128 calls on Apple. Lulu going. Lulu on the move. Lulu pushing higher. Let's see if Lulu can get anything going here. Lulu. Lulu. Up $1.78 on the day. Still looking for this to break above the 200-day. If it does, that would be a sign that the only way that's going to happen is if institutions are buying. Volume tapering off. MACD's turning. Stochastic. And that looks good.
new trailer for the new horror movie Megan coming out soon. It's not just to scare you. It's a Universal property from our parent company. Also, you might have caught it, our own Julia Borston making an appearance. Trading Tech Check for Tech Talk. Rather horrifying, actually, Julia. I haven't seen it yet, but it looks scary. But it's about an AI robot. Look, we've talked to so many executives, such as Elon Musk, who are very scared about the negative implications of what happens if AI.
All right, Pally pulling back below VWAP now.
Here's my prediction. You're going to be this generation's Courtney Cox. Remember, she was the news reporter in the Spirit franchise? When the Megan franchise kicks off, that's you.
Happy New Year, everyone. That'll do it for Tech Check in 22. Let's get to Squat Wapner in the half.
Hi, G. Thank you very much. Welcome, everybody, to the halftime report. Hi, 2022. Hello, new year. But will it be a better year for your money? We'll discuss and debate that with the investment committee. Joining me for the hour today, Jason Snipe, and right here at Post 9 at the New York Stock Exchange, Joe Terranova and Jenny Harrington. Taking to the markets, we'll show you what we're doing just past 12 noon in the East on this final trading day of the year. Dow's down about 200 points, S&P 2/3, 0.75% approaching that decline there. NASDAQ down about the same amount. We always check the 10-year note yield at 3.88, so we'll keep our eyes there as we work on what would be the fourth worst year since 1945. Joe, the worst since 2008. The good news is that the market tends to not have another down year after an already dismal year. For whatever that is worth.
Well, I think the best news is it won't be 2022 anymore because we want to just say goodbye to it completely. But I think the beginning of the year is where the highest probability exists for there to be a little bit of a recovery rally. I would be surprised if in the first 2 weeks of January you did not see a return of capital into the equity market, into the fixed income market. Tax loss harvesting, you'll see a return of capital from there. I think generally right now the expectation is that the CPI print on January 12th is going to be a benign one. So I think the setup is a favorable one to get a recovery rally heading into earnings. I'm not going to go beyond what happens.
I mean, Edgar Denny is out with a new note today. Not necessarily looking for, a huge thing in the stock market to start the year, but a favorable CPI. Inflation may be falling faster than widely expected as part of his note today. The problem, Jenny, is based on our CNBC stock survey results, people aren't looking for much next year. I mean, a third say we're going to have below average returns for next year. You've got 27% of those we asked say 1 to 5%, and 9% who say negative. So that gives you an idea where sentiment is, where positioning probably is. What do you make of that?
Well, when you say the problem is that people aren't looking for much next year, I actually don't see that as a problem. I think it's terrific because I think one of the most important things that's happening this year is that expectations are being reset to reasonable. And if we have reasonable expectations and behave rationally, we can actually set ourselves up for a decent investment environment for the next 3, 5, 10 years. So we cannot lose sight of the fact that over the past 10 years, prior to 2021, the market returned 16.5%. And everyone's so miserable about this year, like, oh, it's the worst, it's awful, I'm down 20%. Well, you know what? If you're down 20% this year, you're probably up 30% the year before that, you're probably up 18% the year before that. The annualized return on the market over the past 3 years is right where it should be. It's about 7%. Over the past 5 years, it's about 9%. And I think that if we collectively as investors have rational expectations and behave rationally, we will make the returns that will get us to functional places in our retirement. So when the expectations for next year are not much, what is that, 6, 7, 8%? Sure, the market historically returned 8 to 10, but 6, 7, 8% next year after a year like this, to me, that's just fine.
The question is, Jason, do we have the capability of even doing that, given all that we know that what we think lies ahead?
Yeah, I think it's an important question to ask, and I think Jenny makes a great point in just what the last 3 years have been. This is the first negative year in the last 4, right? So when I look to turning the calendar, which I know we're all excited to do that for 2023, the first thing that comes to mind is obviously the Fed. We're closer to the end of this tightening cycle. I mean, 400 plus basis points in 1 year. these are historic numbers. We might see another 50 to 75. And as we've been talking about all year, and the Fed has talked about in their commentary, and then they'll likely hold. Right. And I think some of the concern as well is what are the lag effects of all that has happened already this year with labor, with owner equivalent rents, housing, all these things will take shape in 2023. But I think once we can get beyond that, there is some opportunity. And I think the market, again, 20+%, in the S&P, 30+% in the NASDAQ, history has told us that we don't see a lot of negative years 2 years in a row. So I think those also can play well going into the new year. And let's see, how the next quarters, couple quarters, and what presents itself here.
Undoubtedly, Joe, the biggest question is going to be around earnings and what the right multiple is for stocks with the recession lurking. If you look at what happened in the market this year, so at the beginning of the year, the S&P had a forward PE of 21.5. Okay, it's down to 16.7. The Dow was at 19. Now it's north of 16. NASDAQ was just 32. It's down to 22.5 there. Maybe that's the biggest point of contention, is that 22 times, and whether the NASDAQ has had a re-rating enough. And some would suggest that it has not. And maybe that's the most open-ended question. While we've seen, obviously the market come in from a more dramatic perspective from technology and the NASDAQ.
If you remove the valuation for mega caps, the valuation for the S&P is lower.
Way lower.
Way lower. So I've said all along, it began in December of 2020. The Russell 1000 Hypergrowth Index had a PE at that time in the mid-40s. The PE on that index now is below 20. This has been a valuation recession for risk assets and for equities. And it's touching the last place, the last line of defense was the mega cap equities. So when you ask the question, when I look at the 2023, what is the right valuation going to be for, in particular, NASDAQ stocks?
For anything. And the problem with the issue is you can't answer it yet. You just don't know, because we really don't know what earnings are going to be, if there's going to be a recession, how much of a re-rating across the whole market has to take place. Not even getting to tech yet.
I think that's fair, but I think, Scott, you could assign a good degree of volatility to the type, the equity size class, the NASDAQ, the S&P, the blue chip stocks. I think the volatility remains high. You still have the suspicion that there has to be more valuation contraction in a lot of the growth and the hyper growth stocks that are represented in the NASDAQ. So I think that's important to keep in mind. And that's why, from the risk management perspective, you're still more inclined right now to look away from those names until a better environment presents itself.
So, Jenny, earnings are the biggest question. According to our survey, the biggest concern, and which, by the way, all of you participated in the survey, is the Fed. Overwhelmingly so, 73% say the Fed is the biggest market concern right now. Next is a Chinese invasion of Taiwan, and that's at 12%. So it's 73% by a mile. The Fed is and will continue to be pretty much the whole game. It is 73%. I mean, you can figure out wrap yourself like a pretzel trying to, give me some other answer here, but
I know. And this is where
I see where you're going. I see the wheels are turning as I was saying that, as if you were in disagreement. But how could you be in any disagreement that the Fed is the whole game in town for stocks right now?
Well, it's not for me. And so when I see that survey and I see 73% of people who I have huge respect for, they're all worried about the Fed. I'm like, what are you worried about?
What'd you answer? You answered the question. What'd you answer?
I think if there was an other, I put other, or I might have done China and Taiwan. And it's funny because I didn't remember exactly what I did, because all of those to me are highly anticipated, right? Now, China, Taiwan, that's really scary. I put incredibly low odds on that. But if that happens, that would scare the bejesus out of me. And then I think we have a real problem. But it's the lowest odds of what's on the list. With respect to the Fed, who doesn't already know what's going to happen next year?
Everybody.
Everybody knows.
How about that?
Everybody doesn't know?
Everybody.
I'm going to say everybody does know.
With the Fed?
With the Fed, you don't think so? They're pulling $95 billion out a month. They're going to raise
$3 this year? They haven't.
They have.
They have not.
decreased the balance sheet by $95 billion a month.
They have not.
They're going to continue to do that for the next 4.5 years. That's what they've said they're going to do. They're going to raise by 25 basis points. We know that we're in a tighter environment. We know that Fed funds is probably going to end up in the 3.5% to 4.5% range. Like, these are all things to me that are known. So I was actually really surprised.
3.5 to 4. You mean 4.5 to 5? It's not higher.
Okay, I'm going to guess that it settles out a little bit lower in the long run, but you're right. Right now, that's where the top.
But that's what I'm saying. We just don't know. We collectively don't know what exactly they're going to do and for how long they're really going to do it, or for how long they leave it to where the peak ultimately gets to. That's a problem too.
Maybe this is the way I see it, which is it's so directionally. Maybe we don't know the exact, but to me it's so directionally predictable. I hear you. I'm just saying, like, to me, the Fed isn't what I worry about the most next year. What I worry about the most next year, in a realistic way, is earnings coming up much shorter and much worse than what we're really expecting. And I worry about people freaking out about valuation, because right now the only way you get back to 4,100 on the S&P, which is up 6.5–7% from here, the only way you get there is $203 earnings 18 times. I don't want to pay 18 times for the market. You know, and this was the conversation you and I were having last week, is the demand side of the equation. What are people willing to pay? What if people say, hey, I don't want to pay that anymore because I don't feel great and there's not that much liquidity. I only want to pay 16 times.
I think part of our issue, though, is before you can say that, you don't really have the answers of to how to even formulate what you think is a fair valuation for the market, Joe. So I think about the forecast for 23. I think about the risk. I think one risk that resides itself, and I would include myself in this, is that consensus is so defensively positioned. They are so pessimistic that the actual risk that they're incurring is they're not invested in the type of way that they should be if everything falls into place. Conversely, though, the concern with the Federal Reserve for me resides itself in the balance sheet, and you don't know the answer to what they are going to do, what the path is going to be there, because they are behind. They're 30% behind in their intended target for the balance sheet. They have not been able to roll off the amount of securities that they told us they were going to. Let's not forget the makeup of the they changes a bit in terms of who votes and who doesn't. Senior economics reporter Steve Leisman joins us now with more on that, right? Steve, it's not just who does what, it's, in part of who the who is.
I don't know, Scott, what do you need me for? You guys got it all figured out there.
We wish we don't. That's why we're
kind of interesting. No, I know. It's, I think the personnel issue is interesting. It's a little unclear to me where it all lays out. We have Lori Logan coming on from from the New York Fed, who ran the open market desk there, to the Dallas Fed. I think she's going to be a person more concerned about systemic risk in the banking system and in the financial system in general. It's why I think the Fed ought to do a little bit less than it's advertising because of that, because I think rolling off the balance sheet is probably the most important. I got a chart on that, guys, in the back. Look at the balance sheet. And we talk a lot about rates, and you guys are talking about rates. Not that chart, guys. If you would go to the one that says balance sheet, it would be great. And you'll see it there. Not that one either. It's the next one. I'm going for it. Thank you very much. You don't have it. Okay, never mind. There's a balance sheet chart.
We'll just have to trust
I'm sorry,
that's Steve.
It's probably my fault. All right, then I'm going to call up the numbers, and the numbers are that you're going to go down from where are we starting the year? We're starting the year at at $8.5 trillion, down from 8.9. Joe's right; they didn't do as much as advertised. They should get down to 7.4 trillion. $1 trillion here, $1 trillion there. Pretty soon it starts to add up. At some point, the roll off of the balance sheet is going to be binding. It's going to start to have an effect on the market. And I'll tell you one of the things that you guys say, you don't know what the Fed's going to do. Let me guarantee you, I don't think the Fed knows what it's going to do. And while you say the Fed is a source of volatility and uncertainty, I think that volatility and uncertainty flows directly from the outlook for the economy. And we just don't know what inflation is going to do. There's some optimistic outlooks out there, and we don't know what inflation is going to do. And those are really the unknowns. I will show you, if we go back now to the other charts, guys, what the rate outlook is. And there's two things to watch here. The first is this idea that there's a 5% peak funds rate in June. And then you see the Jenny Harrington idea, I guess, that the Fed kind of rolls off a bit of it. Now, Let's go to where the fun begins next year, Scotty, which is in May. And now I'll show you the distribution right now of the outlook for May. Now, this could be like, 7% of the folks think that, there we go, think that they're going to cut 25 in May. 40% or so think they're going to remain at that 490 or 488 range. And then, 41% think they're going to hike. And then by 25 and 12% they can go by 50. This is where the possibilities start to fan out and the band becomes wider of unknown. And then you can kind of project that forward. If they start cutting, do they keep cutting? Do they just maintain this level? And it's all going to depend upon what do we get? 3 or 4 more inflation reports between now and then, 3 or 4 more unemployment reports, but pretty steady through the first quarter, I think, is the outlook in terms of the Fed. So Jenny, I think has that part right. I think the other part, though, what happens beyond May and into June, that's where it gets to be unknown, and it's going to be entirely dependent upon the unknown inflation and growth outlooks and unemployment outlooks.
Do you think, Steve, that, obviously we don't have another Fed meeting until early February. Are we leaning at this point towards 25 over 50, or does it really hinge? Yeah. So it doesn't so much hinge, obviously, I guess to some degree it always will, on the CPI, which gets released on January 12th.
I build in that 25, Scott, for February, and I build in the 25 for March. I think that's pretty good odds right there. I got 60+% in the market. I think they want to get up towards 5% and let it sit there for a bit. What I don't want them to do, Scott, what I worry about is if they go too far on the funds rate and don't let the balance sheet have an effect. Esther George from Kansas City, the retiring Kansas City Fed president, had this idea, don't endanger the balance sheet runoff. I've got a lot of reasons why I think this balance sheet needs to run off. Get the Fed out of the mortgage business, create some capacity in the balance sheet, and also get the Fed as much as possible out of the market so that the market is able to do its own thing. So I think there are reasons for the Fed to get out.
Kind of a slow day. As you can see, flat VWAP once again, telling you what to expect. Unless we see a move above 381.50, that's the 200 EMA as well as the high of the day. Or a move below 379. It just looks like we're going to be captivated between 379 and 381, a 2-point range on SPY.
Steve, your insights have helped us greatly this year. I'm so appreciative of your time. I look forward to many more appearances from you on this program in the new year. You be well, all right?
Super kind of you, Scott, and really it's an honor to be on with the great people you have on this show and with you, Scott. Have a great new year.
You're nice to say that. We appreciate it so much, Steve. Thank you. That's Steve Leisman. Let's pivot back before we go to this idea of, okay, given what Steve said, given of where all you believe that we may be, and Jason Snipe, I'll turn to you. This idea of value over growth, the market seems to be voting, right? It seems clear at this moment. It's also seemed clear at other moments that haven't really had the staying power that some have thought. Will it be different this time?
Absolutely, and I guess when I think about the value versus growth debate, obviously, in recent past, value has not, the staying power hasn't been there, and growth has obviously superseded that. But what I will say, we've been in a low interest rate environment, virtually no interest rate environment for almost a decade now. So when I think about value going forward and earnings and profitable stocks that are obviously producing earnings today, I'd like value going forward. And also with the Fed, to Steve's point, with a Fed that is more engaged and higher for longer, I think value can continue to work here. And I think growth will likely take a backseat going into 23. So that's pretty much where I stand here, just in that critical debate, which I think is important to have.
Joe, it's going to be a rough year. I just can't imagine how it's going to be a really positive or successful year for stocks if the mega caps have another terrible year. Some would suggest, well, the market's not so reliant on them like people think. It just seems hard to believe that you could have a good year in the market if you're going to have a bad year again in mega cap tech.
Well, I think you have to quantify a bad year. 2022, I would say, was an abysmal year for a lot of these mega cap names. Most have had the worst year for them since '08. Statistically down beyond the S&P, in some cases down, like Amazon, almost nearly double. So is a bad year where the mega caps maybe underperform the overall market by maybe 5% or so. Let me ask you this. What if the mega caps are flat for 2023? What if they rebound, but they're flat? I think the market could be okay in that situation.
I agree.
As long as you pick up, Jenny, a lot of slack from other areas. Some cyclicals, which, there's a fair amount of focus on right now as being a place that you may want to be.
Right. One of the things that I was just scrambling to pull up was the valuation disparities. And it's interesting because growth stocks are still trading at 20 times earnings. This is a smidge stale, but roughly accurate. I think like a month stale. So their historical multiple was 18.6 times. Value, on the other hand, is trading at 12 times. It's still below their historical multiple. So what we can see, Scott, is more of that re-rating that we've been talking about all week. And so I think the mega cap growth stocks, they can re-rate.
Watch Pally here. Got more volume coming in. Pally, P-A-L-I, Pally.
450 stocks in the S&P 500.
Palisades Bio.
Low valuations. And as those re-rate, many of those are going to move from that closer to 12 times multiple, maybe back to their 13 times, maybe 14 times. And so we see a mean reversion. And I think this is going to be the year.
Things have to work well, though, for that. Right? You can't have a recession and have valuations and the multiples of those more sensitive stocks to the economy go up.
Well, this is where we're going to argue again on how much of the idea of a recession is already priced in. Because to Joe's point, it wasn't a bad year. It was an abysmal year for many of these stocks. I mean, literally, Amazon down 50%.
No, I'm talking about like industrials and more cyclical stocks, the kinds that you're actually talking about that can have an increase in their multiple.
Yes, but many of those are down also 30, 40, 50% this year. And what they
All right, I'm going to make a sandwich. I'll be right back. Look for a move back up to 381.50. If it gets above that, look for a run into the close. I don't see that happening. I see ping pong back and forth between 379 and 381 with VWAP flat and volume not that pronounced. Volume is very minimal.
For more on the economy in 2023, tune in tonight, 6 o'clock Eastern, for a CNBC special report, Taking Stock. It's hosted by Brian Sullivan. Coming up, the investment committee's making some moves in the market as well. Jenny Harrington has a new stock buy to tell you about. Jason Snipe has 2 stock sells to tell you about. They will next.
Grade my trade. Send us your latest stock move, and the investment committee will debate it and grade it. Email us at askhalftime@cnbc.com or tweet us, #GradeMyTrade.
some moves to tell you about from the committee today. Jenny Harrington has a new buy, Advanced Auto Parts. When did you buy it?
Yesterday.
Okay. Tell me why.
Okay, so this is kind of exactly what we were just talking about. The stock is down 40% year to date. In 2021, they started a new program where they were returning huge amounts of cash to shareholders, and they jacked the dividend up. So right now you've got a 4.1% yield, trades at 11.6 times. It's to peers AutoZone and O'Reilly, which are better managed and historically always have been. They trade at 20 and 26 times earnings. So you've got AutoZone, which is, you might think this is a silly thing to say, but it's very real, and you can look at the earnings and the revenues going way, way, way back on this. They have a huge amount of economic resilience because in a tough economy, you might put off buying a car, but you cannot put off fixing up the car that you've got. And so even with the argument of electrification of vehicles, you know, there's still huge demand for auto parts. There will be for a long time. And so you've got economic resilience. I think you've got a stable consumer. This is not saying a super strong consumer. And you've got a business that's trading dirt cheap. Historically, they traded in the 16 to 18 times range. So this is one where I think it overshot the worst case expectations. By the way, earnings for next year, analysts are expecting a little growth over this year. It's at $12.50 of earnings this year with a $6 dividend. We think that the analysts are being overly optimistic. So let's say earnings stay flat, or even if they're down a little bit, when a stock's trading at 11.5 times earnings, you have a huge margin of safety. So it's not a glossy story. It's just really solid, better than a bond. I think the right kind of thing to own to actually make money in a tricky year like 2020.
And the dividend yield is?
4.1%.
4.1%. Free cash flow yield 11%. I mean, you did mention AutoZone. The performance has been striking in terms of the outperformance of AutoZone this year.
Oh, yeah.
Plus 17 versus down 40.
Right. I mean, there's always been pressure on Advanced Auto Parts because it is a constant kind of like integration, merger, you know, messy story. One of the things that was interesting, and anyone who might want to buy it, I do advise you to watch the Analyst Day that they have recorded from April of this year. One of the things they talked about is that their systems were like 21 years old, and just that systems integration has taken years and years and years longer. So they have a huge discount. The stock's got no love, but it's kind of just fine.
All right, well, it's getting some love right now as we speak. Jason Snipe, you have a couple of moves too that'll be, I think, interesting to our viewers, and they're sells. Twilio, you sold Twilio and you sold Shopify. Can you take me through those, please? Start with Twilio for us.
All right. Yeah, absolutely. So Twilio, both Twilio and Shopify, as Joe and a lot of the panelists have described all year, you know, price of sales stocks, you know, very high beta names with no profits, right? So these are names that have been tough. So I right-sized Twilio, you know, early on this year in February. A very innovative communications platform, but the guide in the last quarter is really difficult, you know, in terms of long-term organic growth slowing in 2023. So we decided to unload it actually yesterday. And then on Shopify's side, I think, you know, thinking about cyclicals and thinking about the retail, I mean, they'll be very sensitive to retail sales going forward. They had a very strong, you know, holiday weekend. You know, Cyber Monday was really strong for them, record numbers. You know, but for me, as we go forward into potentially a slowdown and sensitivity to retail sales, we felt that it was time to unload the rest of our position. And again, they were micro positions for us at this stage, but they're names that I feel are very innovative, have a long growth period ahead. But we'll probably relook at them sometime in the summer of next year.
Okay. Twilio was a Joe Terranova name at one point. I can't remember, to be honest, if it was in 21 or 22.
Oh, no, it was well beyond that. We're talking about early 2019.
Okay. Good old days.
When did you finally get rid of it?
I got rid of Twilio kind of going into the pandemic, bought it again on the other side, and quickly scrambled out of it. I did well with Twilio, one of the few stocks I've done well with in the last 5 years. But it's a great company. And the only thing that comes to mind when I think of Twilio is I say to myself, here's a company that we know the business model is one that's additive for a technology company. Is it now cheap enough, Scott? I think this is where you know the market begins to bottom. If we begin to see some M&A in technology itself, that's when you can feel comfortable that you're at a bottom. And this company, it wouldn't take very much. It's got a market cap of $8.9 billion. You tell me, I don't know, 12 billion, 13 billion to buy the company. That's a pretty additive company for a large cap technology company that's trying to add some growth.
You know what's interesting about that, Joe, is I was thinking, and I don't think this is not part of my investment thesis, but it was actually similar with the Advanced Auto, where I'm thinking this is a huge free cash flow company. And what are the private equity guys going to look for? They're going to look for certainty, free cash flow. The market cap is $8 billion. Now, again, that's not the investment thesis, but when you start to think of these things from a private market value perspective, you can see a lot of value in them.
Well, speaking of picks, next week on Halftime, we're going to kick off our annual stock summit. We'll debate the stocks and sectors the committee has the most conviction in for 2023. So don't miss that. It's going to be throughout next week. We look forward to that. Coming up, our chart of the day. It's a big energy stock having its best year on record, surging more than 100%. Tell you how to play energy just ahead on Halftime.
I'm here with you. I'm just eating lunch. Looking for a test of 381.55. If we get above the 200 EMA and the 20 EMA keeps rising, watch for VWAP to follow. Not expecting a move above 381. I'd be selling into strength if you have some calls from the low.
Welcome back to the Halftime Report. I'm Contessa Brewer. NBC News has learned an arrest has been made in connection with last month's brutal killing of 4 Idaho college students. Brian Christopher Koberger was taken into custody in Pennsylvania, more than 2,500 miles away from the crime. Police in Moscow, Idaho said they would provide more information at a news conference later today. It's scheduled for 4 p.m. Eastern Time. They did not confirm that arrest. Cambodian authorities are continuing their search today for victims from a massive fire earlier this week. The death toll at a casino and hotel complex is now 25, but authorities worry that number will grow. An initial investigation found the fire may have been caused by faulty holiday decorations using too much electricity. President Biden announced 6 new pardons today, including former members of the military. None of the individuals currently are serving a sentence. And the White House said Biden is committed to providing second chances to those who've demonstrated their rehabilitation. Scott, I'll send it back to you.
All right, Contessa, thank you. Contessa Brewer. Let's get to our chart of the day now. It's Occidental Petroleum. Shares up 115% this year, having their best year on record. It is the top performing stock in the S&P 500 this year. It has the Berkshire Hathaway seal of approval. I could go on and on and on. I could also say that the Joe T holds Occidental, so you've done well with that.
Heavy short interest in Occidental. Let's keep that in mind. That's been unwound significantly. We're closing out a year in which energy equities are up well over 50%, significantly outpacing the spot commodity itself. I think oil is basically up somewhere around 5 or 6% for the year. Natural gas is up somewhere around 20%. So it's really been about these energy companies having the discipline from a management perspective and really focusing on how it is exactly they can improve the balance sheet, return capital to shareholders in an environment where they've also benefited from an early price spike at the beginning of the year.
Stock survey, which area will you be concentrating on to start 2023? 41% say energy stocks. That led the way. Do we, Jenny, who also has exposure significantly in this space, think that energy stocks are going to continue that leadership role into the new year?
Leadership, but not at the same pace. Right? I mean, these are crazy numbers that we've seen. Do we think that they're going to lead by 50 plus? Well, actually, if you think about it, they're 70% ahead of the market. Do I think energy stocks are going to be 70% ahead of the broader market next year? No way on earth. Now, I'll be happy if I'm wrong on that strong statement. But no, I think that they have largely re-rated already. And you know, that's, Joe says, you know, it's the cash flow and it's the capital discipline, and that's all true. But mostly it's just people saying, hey, these are really high quality, well-run companies. They produce a lot of cash flow. I have certainty of earnings ahead. And that's what I want for this kind of environment. So they took them from 2 and 3 times earnings multiples to 6, 7, 8 times earnings multiples. I don't think those multiples go into the teens next year. Maybe they go to 8, 9, 10 times.
Let me ask you this, Joe. If you're, well, I'll ask both of you. I'll ask both of you for the answer because the answers may be different. You're both sitting on Chevron, okay? Chevron year to date is up 52%. Now, if you have Exxon? Yeah, Joe, you have Exxon.
Yes.
Exxon was up almost 80%. Why not sell those? If you have that, you're up 80% this year. Why not sell that?
Because the environment, the supply to demand environment is still demanding that investors maintain positioning there, okay, and allow the environment to tell you when to get out. What do I mean when I say the environment? Number one, supply relative to surging demand, and number two, earnings. I need to see the deterioration in earnings for me to become an active seller of the energy names. I'm going to use a quick analogy if I could, okay? What's up the last 5 years, every year, farm commodities, whether it's corn, whether it's soybean, whether it's wheat, and they all have exactly what I'm speaking towards, the right supply demand and balance that tells you to invest there, and also the earnings growth. So using that analogy, okay, I could say to myself, well, it's happened for farm commodities. We could have that type of multi-year run for energy equities.
Can I tell you exactly what I've done? So
Yeah.
I actually did sell Chevron for my accounts where they don't have a big capital gain. Now, I've owned Chevron for so long that I have huge capital gains. I have huge capital gains that I'm dealing with this year, and I've tried to offset them. So for the non-taxable accounts, I sold Chevron. At the time, it was about a 4% position, and I replaced it with about a 2.5% position in Pioneer. So I see, and this is, again, I manage a dividend income strategy. So I significantly increased the dividend that I was getting by that trade. As soon as we turn the calendar corner, then I'll sell Chevron for the rest of the taxable accounts that own it. And again, take 4% energy off the table, put 2.5% back in, increase the dividend yield, put 1.5% in my pocket. And to me, that's good portfolio management.
Okay, interesting. Jason Snipe, you have Chevron too.
I do, and you know, I still remain overweight, you know, on the company and the whole sector as a whole. I just think everything that Joe and Jenny said. I mean, we always talk about the supply and demand dynamics, and that's true. But I think when I really focus on energy, it's about the earnings power. It's all about the fundamentals. I mean, free cash flow, dividend yields, very strong balance sheets. I think energy can still do well. And to Jenny's point, I don't think if the outsized returns you'll see this year that we saw this year, we'll see next year, but I still think it'll be a relative strength sector, you know, in the overall market.
Okay. All right, coming up next, one of our new segments in 2022, Grade Your Trade. We're going to do it next. You can keep sending them in You can find us on Twitter. You can email us, askhalftime@cnbc.com. We are right back. Let's grade some trades now. Jason Snipe, you got the first one. It's from Chris C. It says, a few weeks ago, I bought 300 shares of Amazon at $89. The RSI was at 29, so I went for it. I'm holding for now, given the dip in price. My time horizon is to hold for 10 years. It's a long time. What do you think of this trade?
Yeah, so I would give it a B here. I think, obviously an RSI below 30 is reflective of oversold conditions. So for me, Amazon has been a disappointment for almost 2 years now, right? Its stock is down 50% year to date. There's been a deceleration, in AWS advertising and a shift from goods to services. But with a 10-year time horizon, I could almost guarantee, 10 years from now, Amazon won't be where it is today. So they're a very innovative company. I think the advertising business will continue to grow. I think we're still in the early stages of that development. AWS will do well. So I like this trade here, and I recommend holding it, especially over a long-term horizon.
All right. Joe, for you, from one of our viewers, Rita, I sold Cadence Design yesterday at $162.50. It's in the Joe T. It is. So we'll have you grade it. What's your grade?
I'm going to give Rita an A on this. And obviously, Rita pays attention to technicals. There was a significant technical breakdown yesterday. Keep in mind, the stock was as high as 194 back in August, but yesterday it breached below all of its major moving averages. Fundamentally, you do also have the wild card. That's the exposure to China. 13% of its revenue comes from there. So, Rita, nice job. That's an A.
All right, good stuff. Well done, Rita. Jenny, get the last one. Bob V. in Virginia Beach. I'm a retired stockbroker. I bought Uber at 47, 34, and then at 29. What do I do now?
I thought he was going to say, what do I get on that trade?
Well, you
So,
give that
sorry,
grade first and
but
then give the advice.
All right, so here I averaged it out. I figure you probably paid 36 on average, which makes you down 46%, which is double the market. So sadly, you get a D. But we bought Uber a couple dollars ago. I actually think there's tremendous upside from here. They've got 15 to 20% revenue growth ahead. They're going to start to make tons of free cash in the next couple of years. I think they're going to make 2.2 billion in 23. They're going to crack 4 billion in 24. So from here, I think there's a lot of upside. And I think what you should do is, unless your position size is already enormous, I would add to it here. I think it's a great stock to own.
So what was a D can be turned around with a little extra work, a little extra credit. You're a tough grader.
I am. That was a really bad trade, though. Yeah.
You know what? I appreciate the fact that you keep it real.
Thank you.
All right, we'll take a break. Keep your trades coming in, by the way. Send an email to askhalftime@cnbc.com. You can tweet us, use the hashtag #GradeMyTrade. All right, coming up, Mike Santoli has his midday word. We're back after this.
Still flat. No follow through. 381.50. That's the high of the day. Chop, chop, chop. No follow through.
We're back on the halftime report. Senior markets commentator Mike Santoli joins us right here. Post 9 for his midday word. I mean, my midday word would be good riddance, not for you, but for the year. Well, what would yours be?
No, it's been kind of a grind. I mean, even if it hasn't been straight down, we were just saying it's been range bound since May. Dismiss the holiday week, and we can't really say that there's a quorum out going quietly. You're seeing a little bit of an upswing in Treasury yields. The 30-year threatening 4%. They're well below the highs. It doesn't look like it's really a stress level for equities yet. But keep an eye on it as we try to figure out what inflation expectations are. And wholesale gasoline prices bouncing. So all these things that we feel like we've kind of already able to shove to the side and say, okay, been there. We figured that out. You have to figure they're going to be somewhat factors next year, even if I think valuations are in a better spot, even if they're not great, and we're benefiting from a low hurdle of diminished expectations.
Seems like yields went up a little bit, stocks went down a little bit on the Chicago number.
Yeah,
a little hotter than expected. Just raises that good news for the economy is bad news for the market environment with the Fed.
And also perhaps suggest that we continue to over-anticipate the real breakdown in the economy when it's not really there across the board. I mean, housing's in the tank. I mean, we can point at all these things that say worse is coming, but the data are not quite there, at least in a wholesale way.
All right, I'll see you in a few.
Yeah.
For your real last word.
That's right.
For 2022, that's Mike Santoli. All right, semi stocks on pace for their worst year since 08. One big player in the group getting a good downgrade today. We'll discuss that next in our call of the day.
All right, markets are just grinding away. Looks like we're going to get stuck below 381.50 unless something happens in the next 3 hours. There's not much to look at. Markets are just moving sideways. If you aren't trading and you're waiting for a trade, maybe keep the stream open and listen, but I don't see much happening between now and the end of the day, end of the year, unless we start to rally forcefully right now. There's not a lot of volume either.
Welcome back. Our call of the day is Micron, the largest U.S. memory stock, downgraded to hold today from buy at Argus. They note the challenging environment. No big shock there. They say the cut reflects prospects for deep operating losses at that company over the next few quarters. Nobody on the desk owned it, but let's do it this way, Joe. Is this a take this ticker symbol and substitute almost any in the chip space right now, given what is an expected quote unquote challenging environment for many? I'll just steal from their words from this note. But how about that?
I think it's correct to say it's a challenging environment, but no. I think that first in, first out is the case for the semis. I think the semis, without question, were the first to experience the valuation contraction and the valuation recession. I think there are places within the semis where you have seen the bottom. KLA Corp, On Semi, Microchip, Texas Instruments, which I own personally. So I do believe that you can find tactically opportunities in the semi space. And yes, I acknowledge the overall environment still remains a challenged one.
Worst performing Dow stock this year, Jenny. You know what that one is? I mean, it is what it is. I didn't just pull this out because I wanted to, bring it up on purpose, but it's Intel, right? So again, it just goes to my, take the ticker of Micron out. Can you sub almost any in the group in and think that, let's say, for the next, handful of months, it's going to be challenging?
I don't think you should do that. I think you really should, be a real investor on these and say, my starting place is today. Let's look at each one of its own individual merits, and what does it have going for it from here? What's the valuation? What are the earnings opportunities? And I know we sold we sold AMAT, when was that, like a month and a half ago? And the idea there was we didn't think that there was earnings growth ahead, and it was trading at its historical multiple. So we didn't see either earnings growth or multiple expansion, but we still own Teradyne. Teradyne has 43% earnings expected growth in 2024. That's really promising. And while it's more expensive than others, they're all different. So I think you can't lump them all together. I think you're doing yourself a disservice. So like even on Intel, look at it today and say, hey, what might earnings actually be? It's different than NVIDIA. It's different than Micron.
Well, let's talk about NVIDIA, because that's where I want to go with you, Jason. Maybe no chip name is in the crosshairs or, under as much pressure than NVIDIA for where it once was, where it is now, and the belief that people still have in it.
There's no doubt about it, Scott. I mean, obviously, all the chips, the SMH is down 34%. NVIDIA has had some challenges with the chip. Some of the chips that they could send to China, obviously the multiple is high. NVIDIA is a long-term holding for us. I mean, gaming data center is obviously all slowed. I mean, this name has done great over the last decade, but it has been challenged recently. And even I don't own Micron, but when I think about inventory has been the issue, with the semis. And Steph has always talked about this double ordering that they've experienced throughout the year is now coming to roost, and that's been the problem.
Yeah, you go from a shortage to a glut, and that's going to be an issue that we're going to be talking a lot about as we go into 23. We'll take a quick break. We'll do final trades next.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
I'm here. I'm just running some scans. All right, SPY back down below VWAP. More chop back and forth. We're in a $2 range. All right, SPY trying to bounce.
.com. We're going out with a bang tonight in overtime. Why? Because Jeremy Siegel of the Wharton School will be with us.
There goes Meta.
Sum up this year, and more importantly, what he thinks lies ahead for your money in 2023. He's been with us almost every step of the way through a turbulent year. Cannot wait to catch up with him as we close it out. Let's do final trades. Jason Snipe, what do you have for us?
I like Avantor here. It's a chemical company that provides medical equipment to healthcare companies. It's got a 6% free cash flow yield, and it also trades about 15 times earnings. So I like it here with the tailwinds in healthcare that we see going forward.
All right, good stuff. Happy New Year to you. And great having you part of the team this year.
Same to you.
We'll see you soon. Jenny Harrington.
Okay. Kohl Stores, down 40% on the year, 8% dividend yield, $4 of earnings, $2 dividend. As Mike Santoli said earlier, this is a stock that he said over-anticipated the economic breakdown.
All right, finally.
Feels so good to give a final trade in 2022. I'll go out saying Charles Schwab, and most importantly, be long health and happiness in 2023 for all viewers.
Yeah, for real. And Happy New Year to you guys.
Happy New Year
Jenny,
to you too.
Joe, and your families, of course, as well. All of you too. We look forward to spending 2023 with all of you. I'll see you in the OT. The exchange is now.
Thank you, Scott. Hi, everybody. I'm Kelly Evans, and here's what's ahead today on the exchange. Stocks unable to keep the rally going in this final trading day of the year. We'll take a look at how we started versus how it's going and get the one thing that could have the bulls charging next year. Speaking of bulls, energy is the only sector finishing the year higher, and not just a little bit. It's up by 58%. But 2023 could be the year the run ends, and we'll tell you why. Plus, Snap proved to be the canary in the advertising coal mine back in October. Everyone from Meta to the New York Times to Paramount now reporting a spending slowdown. So what does next year hold? We'll get to that. But first, today's market action. Let's get to Bob Bassani over at the New York Stock Exchange. Bob?
Hello, Kelly. Happy New Year, everybody. Well, we're ending the year kind of where we've been for a good part of the year, which is on a modest down note with the growth sectors underperforming. So let's look at the major indices. We're down about 200 points in the Dow Jones Industrial Average. That's been an outperformer all throughout the year, relative outperformer. S&P 500, the only real suspense here is whether we end the year down 20% or not. 3812 would be down 20% for the year. The only reason that's important, that's kind of an extraordinary number. When you get down 20, that just doesn't happen very often. NASDAQ's down more than 30%. In fact, let's take a look at the major indices for 2022. The Dow has been a relative outperformer because it's only down 9% because it's got a lot of those consumer names, value names that are in it. The S&P just on the cusp of down 20%. The Russell, and you see the NASDAQ, the big loser, down 33%. Why is the Dow done so well? Because of those value names. You have energy stocks, a huge outperformer. That's not a typo. Chevron up 50%. Merck was at a new high just a little while ago. And Travelers and Amgen, Caterpillar rallied big at the end of the year on hopes for a better 2023. Coke, Johnson & Johnson, all the consumer names all outperforming. That's why the Dow did so much better. I don't want to gild the lily. It's just been a terrible year. In fact, if we end down 20%, this is going to be the fourth worst year for the S&P since World War II. That is not a typo either. So 2008, if you take a look, that was the worst year we've had in a long time, down 38%. 74 was down almost 30. 2002, 23%. And 2022, we don't know, but you can see it would be the fourth worst year if we end right where we are right now. So what makes this difficult to figure out is what's going to happen next year. In a year where the market is down big, it does tend to happen that the worst sectors tend to outperform in the next year. So if that's the case, you would look at the big losers, which are, as you can see, tech-oriented, consumer services, technology, including real estate, and consumer discretionary. The problem with making this prediction is that there's confluences of three big events that are occurring that are making 2023 really hard. We've got the continuing effects of COVID, we've got the Russian invasion of Ukraine, and Fed higher for longer, and what kind of recession are we going to have? And when you have this kind of confluence of big events, it makes it really difficult, and this is why the analysts and strategists are kind of clueless right now on what's going to happen in 2023. But who cares, Kelly, because guess who's here? We have Art Cashin. He is on the floor for the first time this year. We've got 100 retired and current members of New York Stock Exchange. They're going to sing Wait Till the Sunshine Nelly, just like they did years ago, right here, 1:30 Eastern Time. You, me, Kelly, and Art Cashin right here.
I can't wait for that. Again, 1:30 p.m. people, Eastern Time, coming up in about half an hour. You don't want to miss it. And Bob, thank you. Now, Bob talked about how this has been one of the worst years for the markets ever. How did we get here? Let's look back at where we were starting in January. We kicked off 2022 with the Fed funds rate near zero, a 10-year yield at 1.6%, basically unmoved for the entire previous year, and yet a very hot economy with 500,000 jobs added in the month, an inflation rate of 7.5%. Everyone thought transitory was the way to describe inflation. Not so much. As we started heading into the year, we got the strong jobs rate in February, jobs report in February, I should say. By June, things really started to hit a peak, a fever pitch, if you will. The Fed started hiking. The Fed funds rate moved up to 1.6%. The 10-year yield was up at 3%. The CPI shot up to 9.1%. The average gasoline price, we all remember it, rocketed over $5 a gallon. The Russia-Ukraine war, of course, didn't really help. Transitory at this point was becoming a running joke. Now, fast forward to today, and it's almost kind of back to where we started. The Fed funds rate way up at 4.3%, no joke. A huge jump from January. The 10-year yield near 4% now. The CPI back to 7%. It's starting to recede a little bit to the levels that we started the year with as that gasoline price collapsed. The labor market's slowing, but still strong. 263,000 jobs added. And with everything the Fed's done, $12 trillion erased from the equity and crypto markets. So where does this set us up for 2023? Let's ask Mark Avalon. He's president of Potomac Wealth Advisors. Mark, welcome to you. The only thing we know about this year is no one saw it coming.
Well, that's right, Kelly. And we all had an anticipation of a correction, especially after the robust 2021 that we had. But the severity of the drop and the rapidity of it, how quickly it happened, if you look at those charts, things have been relatively mild the second half of the year, but the first half was a devastating drop. We hope that this recent trend we had of choppy, directionless, certainly not a robust positive bull market, but at this point, we'll settle for choppy, finding a bottom, settling out, and then hoping mid-2023 offers a little more optimism.
You think, and I feel like you're right in this, you think the key is going to be wage growth. So kind of what I hinted before, the job market's still quite strong. Look at jobless claims. They're still basically fine by historical standards. What does that tell you? How does that illustrate the quandary we're in?
It's a quandary for Jerome Powell because oil prices have leveled off, commodity prices have come down, the supply chain is working out, you're getting discounts at furniture stores and all those goods that we had driven up in price. But what's not coming down are wages. And he has said as much, that they are not going to relent on their anti-inflation push until he gets indications that wages have been suppressed, or at least at a normal run rate. I know that sounds cruel, and it's unfortunate for workers who are finally enjoying wage gains, but wage gains are bad for inflation, bad for corporate profits, and not good for stocks.
Yeah, so where does that leave you in the market then? Bob highlighted some of the sectors that about everyone wishes their whole portfolio was just marked this year. Where are you for 2023?
Well, we like financials, but I think people need to slow down and ask, well, there's a lot of different types of financials. And when I look at the risk of a recession, I don't think it's going to be a deep recession, but if there's a risk of recession, I don't like banks as much as insurers. Both benefit from higher rates, but insurers don't have revolving lines of credit. They don't have consumer loans. Their debt is long assets in real estate, well thought out, we hope, but well thought out real estate that can navigate the office glut. And they're anchored in long-term assets, not subject to short-term economic cycles. So higher rates benefiting their huge bond portfolios, finally giving them a rate of return, and they can avoid the recession shock that consumers feel, that banks may feel.
And we'll talk about this next hour, and they're raising prices, and that could, again, flow through to the bottom line. So you like insurers, where else would you be? I mean, and are there areas, obviously we've seen the correction in high valuation tech stocks. Are there areas in particular you'd stay away from? What would you do with energy, for example?
Well, energy is, I think, mostly a rear view mirror. I don't think it's a bad trade. I think it's going to normalize and be more of a market player. It's interesting, the breakout between oil prices and oil stock prices is at a relatively high range. So with oil stocks higher than the commodity, we wouldn't dive into that.
Yeah.
I think other areas we like, it's interesting, this is one of the few times in my memory that Democrats and Republicans are agreeing on increasing defense budgets. The Democrats have hitched their wagon to supporting Ukraine, and Republicans traditionally are supporting aerospace and defense. And that's an area that, given the massive spending we have in this budget for those areas and what we see happening, and countries getting really nervous about drone warfare, we think the aerospace and defense sector is poised to benefit.
That's a really interesting point. One the chatbot didn't come up with, that's for sure. Mark, thank you so much for your time today. And again, just to underline it, you said the one factor that will move you out of neutral and into the bullish camp would be if that wage growth slows. That's the most important point.
That's what we're watching.
All right, Mark, appreciate your time today. Happy New Year.
Happy New Year.
Mark Avalon, Potomac Wealth Advisors. For more on the markets, don't miss tonight's CNBC special, Taking Stock, focused on the economy in 2023. They'll talk about wage growth. It all starts at 6 p.m. Eastern Time. Now, it's no secret energy is the best sector since January. It'll likely be the only group to end the year in the green. But in this case, a rising tide did not lift all boats. Pippa Stevens here to explain. Pippa.
Hello, Kelly. And that is right. Energy is the top sector this year. But we do need to distinguish between so-called new and old energy because 2022 saw a big divergence between the two. And we've actually seen this before. Going back to 2020, the XLE lost 37%, while the PBW gained a whopping 200%. Then in 2021, oil and gas stocks gained 46%, while clean energy shed 31%. And that brings us to this year. The XLE is up another 56%, while the PBW has lost more than 40%. Oil and gas has now been the top S&P sector for the last 2 years, and that's notable because no sector has ever led for 3 years, according to data from E-Trade. Now, looking forward, there are bullish and bearish factors for both groups. Starting with old energy, a global economic slowdown could cut oil and petroleum product demand. Companies' free cash flow will also likely be lower than this year due to sliding commodity prices. With such wide outperformance, investors could also simply take profits. On the flip side, earnings still look pretty good at $80 WTI. The sector also offers earnings visibility, and management teams are focused on shareholder returns. For clean energy, bearish forces have been rising rates, a rotation out of growth, production delays, and uncertainty around key policies. Tailwinds include the Inflation Reduction Act, still elevated commodity prices, and record demand. But Kelly, this was supposed to be a big year for clean energy, and it just wasn't.
Yeah, and it started to be when we were talking with the Blake chart.
I'm here, folks. It's just very choppy, flat price action. Unless something breaks, unless we break above bullish or break down bearish, not anything to do. I'm not going to overtrade the last day of the year. I like energy. Energy looks good. Some of the healthcare stocks look okay, but nothing really jumps out at me at the moment.
Even though we saw a big resurgence in coal, even though we saw all these devastating, catastrophic, really extreme weather events, we also saw progress. In the European Union, they're doubling down on their renewable goals. And then here in the U.S., we had the climate bill, which at this point, it kind of feels like people have forgotten about it, but it provides hundreds of billions of dollars of support for decades to come. And that was really something that was an overhang for the industry, because with flip-flopping, governments, you could never make these long-term policies. But now, with assurance that there will be support, that could drive the industry. However, as we know from prior booms, just because there's all this support and there's so much growth, it doesn't necessarily translate to stock performance.
And a reminder again that the Fed is such an important factor. Even while one part of Washington is fighting so hard to try to move this industry forward, that liquidity tide seems to just tell the fortune of which way it'll go, at least in the very short term. But like you said, longer term, maybe some goalposts will help out. I thought that was very clear. Pippa, thank you very much. We appreciate it. Coming up, retail, like the rest of the market, wrapping up its worst year since 2008. So which names and brands are best positioned for a bounce back? We'll get Wells Fargo's top picks next. Plus, Art Cashin is back on the floor of the New York Stock Exchange, his first appearance since last year. We'll get his thoughts on a turbulent 2022 for stocks and a look ahead at how next year is shaping up. And as we head to break, here's a quick look at the markets. It's red across the board. The Dow's down 201, the Nasdaq down 0.9%. The 10-year yield around 385. It was almost 390 this morning. We're back after this.
This is The Exchange on CNBC.
Welcome back to the exchange. Investors came into the holiday shopping season worried about the consumer because of inflation. Would they be too squeezed? Well, they proved somewhat resilient, but in the process took on more debt and cut down their savings. What does that tell us about the retail landscape for next year? Joining us now, Ike Borchow, is senior analyst at Wells Fargo Securities. Welcome, Ike. And CNBC.com's retail and consumer reporter, Melissa Repko, is here as well. We've already talked, Melissa, a lot about this holiday season and the restaurant spend. Ike, have you given us your top picks for 2023 yet?
Yeah, we haven't officially come out with those, Kelly. But look, what I would say is that a couple months ago, we became much more compelled by the off-price sector. We kind of saw the tailwinds developing. Trade down was beginning. The middle-income consumers starting to get a little squeezed. Burlington became a top pick. We upgraded Ross stores. We would still kind of echo that. A lot of what we saw this holiday season was value, was really core to the consumer. There's a lot of price promotion. It really plays right into the off-price thesis. So what I would say is Ross and Burlington are still two of the names that we really like right now heading into next year.
Why does TJX not make the list?
It's a different business. I know we all kind of quantify them all in the same basket as off-price, so they're all the same, but they're not all the same. TJX is a much more affluent end market demographic. If you look at Ross and Burlington, their margins are much lower. Their productivity is much lower versus pre-COVID. They've struggled with the low end becoming under pressure in 2022. That's all inflecting now. So they're more of an inflection story versus TJ is just kind of steady as she goes, less excited.
That's really interesting. And Melissa, how did we get here? This is a little bit of back to the future feel because companies like TJX were some of the best executors of last decade. Then they kind of went haywire during the pandemic.
Yes, we really saw a change in who was the winners and losers in some ways, or an intensifying dynamic during the pandemic. I even heard this from a lot of real estate folks as they think about 2023. They're talking about how retailers want to be close to these off-price names. I mentioned they're seeing a lot of growth. They also want to be close to grocers. Both of those categories, which are value-oriented and necessity-oriented, have seen a surge, and that's intensifying as people think a little bit more carefully about their spending.
That's interesting. Am I wrong in thinking that we had a big luxury deceleration at the end of the year? Why aren't, normally I think of that category as like pretty resilient no matter what, but how would you describe, I know you cover some of these companies, how do you feel about their momentum going into 2023?
Yeah, we haven't seen a lot of pressure there. Honestly, I kind of view it a little bit differently. I kind of barbell it a bit. Yeah. I think the low end, which was under real pressure in 2022.
Low tick alert minus 800.
Winds dissipate, maybe even become tailwinds. You've got cost of living adjustments. Gas prices will be down pretty meaningfully year over year in the first half. So actually low end's improving, high end's resilient. Middle income, like I said earlier, that's really the consumer where we're starting to see the pressure build. And I think you can see that across companies like Walmart or Kohl's or other companies that have kind of called out trade down activity. That's the thing that we kind of look for. So I'd kind of call that middle as being the soft spot.
Would you avoid, I know you probably don't cover the likes of Walmart, Target, and the rest of it, but would that, do you think, be an argument for shying away from what others would view as these kind of stalwart consumer chains?
Yeah, so I can't comment on those specifically because we don't cover them, but look, I would say.
All right, we're on the move back towards the lows of the day, inside of this range. SPY testing the low.
Extreme low tick alert.
De-emphasizing the general merchandise and apparel categories into the first half of next year. So that's kind of how, from a soft lines perspective, that's kind of how I would look at that.
Fair enough. Melissa, as we head into, kind of the January period, there are some people going, okay, well, if it was a bad holiday season, maybe I can pick up a deal. Where are we on inventory levels, on markdowns, on profitability? How do you think the sector is going to come out of this time of year looking?
So we haven't heard the latest inventory numbers, so it's hard to say, but we are seeing intense urgency among retailers to clear through their stuff. I was looking at some retailers' websites today, and Anthropologie, which is owned by...
All right, we just took out the low from 1130, pushing a bit lower.
To me, and the interesting catch there was that you had to spend that $50 before the end of the month, which conveniently is the end of their fourth quarter. So again, there's this push to sell through apparel, and a lot of those...
We're dropping pretty fast here, SPY. Last trading day of the year. Wow. SPY dropping off pretty fast.
Shift from goods to services spending, which seems to be happening kind of post-pandemic. Is that a big factor here as you look into next year?
Yeah, look, I think for our space, it's all about demand versus margins. Demand, very uncertain. A lot of these companies are still over-earning on sales, in our opinion. If you kind of look at the run rate of where they should be. So I think that's a problem right now. I think we're going into a macro, slower macro with revenue bases that are too high. On the margin front, I think you guys mentioned it, inventory. It's the number one bull case for any retail investor. We end clean. We're going to come into 2023 with a ton of markdown opportunity because margins were hit so bad last year. So
All right, SPY coming down to 379.
All right. We'll wait with bated breath. Ike, thanks for your time today. We appreciate Ike Borcho and our Melissa Repko. Appreciate it. Coming up, Tesla and Meta are battling it out to see which of the mega caps will have the worst 2022. A closer look at the losses next. Plus, is the ad market ready for a spending slowdown next year? We'll look at the players who are most at risk with the CEO of a top ad tech firm. And as we head to break, here's the Dow heat map. I don't see two brands.
Extreme low, take alert.
JP Morgan and Chevron eking out gains. Home Depot and Disney among the worst performers. And there's your year-to-date leaders. Chevron at 52%, Merck 44%, Travelers, Amgen, and even
Extreme low tick.
things out. We're back after this.
Market's selling off here. We just took out the low of the day. A lot of puts down here. All right, they just took out some stops at the low. Looks like stops taken out at the low of the day. I continue to drop off here. Market's trading lower. All right, at the low of the day. All right, 375 target.
Welcome back to the exchange. We are ending the year much like we started it, with markets lower. The Dow's down 329 points. This is definitely session low.
Extreme low, take alert.
1.25%. And today's going to have such a big impact on those stats, like Bob mentions. Is the S&P going to be down 20% or not this year? Well, we're going to find out based on how we trade in the next couple of hours. In fact, according to Bespoke, this December is tied for the third most.
SPXU shooting higher.
At least 70 years. There were 8 1% drops this year, 7 in 18, 7 in 08, and we've had 6 this month, marking the 5th time that's happened since the 1970s. So again, it's been a very ugly end to the year. As for today, big tech in the red. Apple shares holding up slightly better, down about 1%. Big tech Apple also outperforming this year. You can see it only down 28%. Microsoft a similar decline. Alphabet down 40%. Amazon has lost half its value. Meta down 65%. And of course, in tech, we have to talk semiconductors. In the red again today with Micron, one of the biggest laggards. You can see the SMH down 1.7% there. Micron getting a downgrade to hold over at Argus, citing the potential for deep operating losses in coming quarters. And the SMH ETF, like the rest of the market, is poised for its worst year since 2008. It is down 35% since January, just over that 200 level, trying to hang on there. Let's get to Seema Modi now for a CNBC News.
Our low bounce so far.
Afternoon, here's what's happening at this hour. So far, there are few notable takeaways from this morning's release of former President Trump's tax returns. However, there are warnings from Republicans about a precedent being set. Kevin Brady, the ranking Republican on the committee that released the Trump returns, says the move will make American politics even more divisive and disheartening. Russian President Putin and Chinese leader Xi pledging to deepen ties between their two nations, neither directly mentioning Russia's war in Ukraine. Even as Russian missile and drone strikes hit Ukrainian cities today, Putin says he expects Xi will make a state visit to Russia in the spring. And an internet personality known for his misogynistic stances has been arrested on suspicion of rape and human trafficking. Romanian prosecutors say they have evidence that 6 women had been sexually exploited by Andrew Tate. His brother, Tristan, and 2 others, a lawyer for the Tate brothers, declined to comment. Kelly, I'll send it back to you.
All right, Seema, thank you. Coming up, we are moments away from continuing one of the longest standing traditions at the New York Stock Exchange. The traders are setting up, and Bob Pisani is in the middle of it all. Robert?
And it's been a tradition for 160 years. Barbershop quartet singing on the floor of the New York Stock Exchange. And when we come back, he's here, the man himself. Art Cashin is here. He's going to lead us in this traditional singing of Wait Till the Sun Shines Nelly. When we come back.
All right, a little bounce there after a drop, taking out some stops at the low. Looks like we could see a bear flag. That was a pretty decent drop on a lot of volume. All right. All right, nice little rally here in SPY. Off the low of the day. Be careful for reversal. Just as fast as it dropped, they're popping in the other direction. Jeez. All right, back into the range again.
Welcome back to the exchange. It's the final trading day of the year, which means it's time for a New York Stock Exchange tradition dating back to the early 1900s. Let's get back to Bob Pisani, who is joined by the man, the myth, the legend himself, Mr. Art Cashin. Hi, everybody. Hi, Bob.
Hello there, Kelly. This song was written in 1905, and it immediately became a sentimental favorite on the floor of the New York Stock Exchange. When its essential message, look to the future, it's going to be better, had particular resonance. And I think it's a message that will have particular resonance for everybody. Lead the floor in the traditional singing of Wait Till the Sun Shines Nelly. Arthur. Till the sun shines, Nelly, and the clouds go drifting by. We will be happy, Nelly, by and by. Down Lover's Lane we'll wander, sweethearts, you and I. Wait till the sun shines, Nelly, by and by.
Everybody, Happy New Year. Happy New Year. How you doing, Peter? Happy New Year. Happy New Year, everybody. Happy New Year. Happy New Year, honey. Happy New Year. How are you? Good to see you. How you doing, David? Happy New Year. Doing Nicholas. Happy New Year. Great to see you, as always. Arthur, come on over here. Come on up here front. Center here. First off, it's so great to see you back down here. We didn't show it, but the floor erupted when Arthur came on the floor. You haven't been down here in a year. Your thoughts on coming back on the floor?
I didn't realize I owed that many people money.
and they're collecting today.
Yeah, no, it's great to be here. It's one of the most wonderful places in the entire world. I've spent 60 some odd years here. My children tell me I'm almost getting it down pat now, but we're working. But to everybody out there, all the viewers, have a very happy new year. Maybe a little bumpy at first, but we're going to make it through, and you'll be happy at the end when we sing Nelly again.
And your Christmas poem, of course, went out, was a big hit. And your New Year's poem just came out today, and also a big hit. It's been a tough year, a difficult year to get your head around. When you look back on the year, what sticks out to you most, and what is most important to you?
I think it's the Fed. I mean, we've had everything from COVID problems in China to the invasion of Ukraine. They've all been very serious. But for now, for the investors, it is what the Fed is doing. And not to be too boring on a celebratory moment, but keep your eye on the money supply, folks. It just fell off a cliff.
Yep. Kelly's got some questions too as well. Kelly?
Yeah, I think you just answered them. Art, it's great to see you again. I hope you can hear me all right. And it's great to see everybody else down there. You said watch the money supply, Art, but what does your instinct tell you about the year we're going to have after the kind of year we just had?
Well, I would love to tell you that it's going to be like the Wizard of Oz and everything will be in glorious color in a moment or two. I think we may have a bumpy first quarter, and depending on the Fed, it may last a little longer than that. But I think I've seen this movie before, and there's a happy ending, so I hope the viewers wait and enjoy it.
I think the important thing is you have lived through some of the worst years ever at the New York Stock Exchange. This will go down as the fourth worst year since 1945. You would live through 72, 3, and 4, a down year then.
Hi, took alert plus 800.
More than 20% down year. 2008 also. All three of those had very special big events around them. We've had big events this year. COVID, Russian invasion, and of course the Fed higher for longer. Is this one of these rare occasions where you get something that's going to continue into next year? I'm asking for a prognostication. Is 2023 going to be a down year or up year? It's extraordinarily unusual to have two down years. Could this be one of them?
Well, there's a very narrow universe to look through it. But as I said before, I think it may be a little rough in the first quarter or first half, but I think we're going to come out of it. And I think both the economy and the country will be better for it. And I hope you all enjoy it. God bless you all.
One of the things, I have a book out, and you're the only person who has an entire chapter devoted to just him alone. And what you have taught me over the 25 years you and I have been together about not just the stock market, but more importantly, about the art of storytelling and how to tell a story, how to take arcane information about the stock market and actually weave it into a story that's interesting for people. This natural storytelling gift that you have, which has had such an impact on me and my life that I devoted a whole chapter of my book just to you and your thoughts alone. Where did you acquire that? And what advice do you give future people who want to explain the world to people?
Well, it goes back thousands of years. People have been talking in parables and other ways to convey knowledge and stories. And it's always been important to me. You know, one of the classics was around the Cuban Missile Crisis, I thought there were rumors around that the Russians had pressed the button. I was trying to buy a put or something to sell. I went down to the local pub, which was my university, and Professor Jack was there. And I said, Jack, I heard that missiles were flying, and I tried to buy some put, and he said, "Kid, sit down, buy me a drink, and listen carefully. When you hear the missiles are flying, you buy them, you don't sell them." And I said, "You buy them, you don't sell them?" He said, "Of course, because if you're wrong, the trade will never clear. We'll all be dead."
And that's a lesson for next time the end of the world happens. Art Cashin, so many people owe so much to you. Thank you, everyone, for coming. Many of these are retired members of the Buttonwood Club from the New York Stock Exchange. They've been here 50, 60 years ago, along with Arthur, and they came down here to pay tribute to Arthur, and of course, to continue that wonderful tradition. Wait till the sun shines out. Thank you for your leadership and your friendship from me personally, Arthur, and we'll be here next year with Art Cashin and the Buttonwood Club and everyone from the NYSE. Kelly, thank you. Merry Christmas and Happy New Year to everybody.
And to you guys as well. One of a kind, Art, and a wonderful interview by Bob Beside. It's great to see everybody back on the floor down there. Our best to you all. Still ahead here on the Exchange. It's been about 3 months since Hurricane Ian wreaked havoc across western Florida, but its effects will extend far past just the cleanup. The eye-popping impact a single storm will have on insurance next year. Details ahead on the Exchange.
Ring in the new year by joining CNBC Pro. Invest like a pro in 2023 with a special year-end offer. Go to cnbc.com/pro new year or scan this code now.
All right, market acting very erratic. A big drop there from 381 down to 378, about a 2-point move. We bounced back in the opposite direction, all within about 30 minutes. Now I'm looking for a resolution to the upside, or do we roll over here and drop off again? Tesla trying to push higher. Tesla's still off 47 cents on the day. Momentum indicators on the daily suggest maybe we see a follow through in the new year, the last trading day of this year, 2022. Been happy to be here with you. For those of you who have been here for the whole year, it's been a dismal year. We've had some 3 or 4 counter trend rallies that we've traded. We've reduced our risk. I'm down to 20% equity exposure. I have SPXU, QID, and leading into year end, really don't have much to say other than the fact that we are trading off $3.73 on the SPY at present. And volume was very low until that drop just now. There was a huge amount of volume came in to the markets on the downside, a little bounce. Looks like they might be selling again here. So watch for any more downside. If you're thinking about puts, this is the place to take them. Not at the low of the day.
Welcome back. 2023 will likely mean sticker shock for American businesses and homeowners paying property insurance. Florida especially getting hit by high premiums and hard to get coverage. Contessa Brewer joins us now. Contessa?
Hi there, Kelly. You know, Floridians already pay nearly 3 times the national average, the most in the nation, according to the Insurance Information Institute, and on track for 33% annual increases. The cost for insurance is so high in Florida, so hard to get, that real estate development deals are just imploding, according to Lockton, a global brokerage. Costs are skyrocketing for insurers, too. Inflation, of course, partly to blame, but lawsuits and fraud in Florida, and then on top of it, the monster storms like Hurricane Ian. All these factors that force more than
All right, rolling over here.
to fold or flee the state, another 24 on the financial watch list. The legislature in Florida has just passed a new law to tackle some of those systemic problems. No more one-way attorney fees, where the insurer bears the costs of the plaintiff's lawsuit. APCIA, which represents insurers, says that lines the pockets of billboard lawyers at the expense of consumers, pointing out that plaintiffs' attorneys get nearly 3/4 of what insurers shelled out. This new law bans the assignment of benefits where a homeowner signs over the right to make a claim to, for instance, a roofing contractor, who then in turn can sue the insurer even without the homeowner's consent. That led to both fraudulent claims.
All right, looks like a higher low trying to build now.
Legislature created a kind of
Very tricky price action. I wouldn't try to trade it
it requires customers
unless you're quick.
flood insurance if they can find it and only pay 20% more than what Citizens charges. That's the state-backed insurer of last resort, Kelly. They're really trying to move people off of Citizens. The CEO of Slide Insurance told me he thinks that the reforms largely will fix Florida's insurance market, but people are going to have to wait.
If we start to drop off here, this is the place where I would buy puts. I wouldn't buy them at the low of the day. All right, there's still more than 2 hours left in the trading day, and we're showing a lot of weakness right now.
You know, in every state, insurance is a regulated industry. So the regulators go in and they look at what the insurers are paying out for claims and what they're taking in for premiums. And part of the reason why premiums are going up is because the price of everything has gone up. If you look at if you get into a car crash, what it costs an insurer to repair or replace your car has gone way, way up. And so that's part of the reason you're seeing sticker shock. But when you're looking at the stock, say the Allstate and Progressive, those stocks have had an extraordinary year, even though
SPY rolling over.
Themselves have been strapped for cash. Why? Investors now see state regulators coming to the table, approving hikes in rates, and they think Allstate and Progressive will be able to charge enough now to improve their margins.
Yeah, it's such a weird business where the worse they do, the more excited investors get for the future. Contessa, thank you. We appreciate it. Contessa Brewer. Still ahead, it wasn't just consumers who reduced spending this year. Advertisers cut back too, kicking up concerns across the media landscape. What will happen come 2023? We'll dive in next. And as we head to break, check out the sector heat map for 2022. Energy in the green, up 58%, the only sector higher, while communication services and discretionary in the rear, 30 to 40% declines. Now, here's the S&P, by the way, everybody, 38.12. If we close below that, that's a 20% drop on the year. We're 3 points below that level right now. The exchange will be right back.
All right, so we're rolling over from that little bounce. Tesla holding up, showing some relative strength for now. Tesla's pretty oversold. We start off next year, we're looking for some follow through if you're bullish. Some people are bearish. I'd like to see more put volume if they were betting on more downside in Tesla. Energy, XLE, trying to bounce with the markets. Okay, real quick, let me go check the sectors real quick. Everything was lower earlier. Okay, if you're bearish on the markets, you want to see these lines moving lower, not higher. That's a good sign. All right. SPY is still looking very weak here. Last day of the trading year. Everything is lower. Energies, the only thing that's green and it's flat for the most part. SPY rolling over now. SPY rolling over. Okay. SPY rolling over. All right, more downside. All right, so the S&P, you heard, S&P, if it closes down here, it'll be down 20% on the year. Close enough.
Welcome back to the exchange. From social to streaming to traditional, across the board, the ad spending slowdown hit media of all kinds this year. Twitter and Snap all reporting a huge pullback in advertising in the second half. Netflix and Disney Plus launching ad-supported tiers shortly thereafter to try to target customers cutting back on their spending as well. What does the competition all mean for 2023? Let's ask Mark Douglas, the founder and CEO of ad tech firm Mountain, and CNBC's very own Julia Boorstin. Welcome to both of you. Mark, I'll start with you. I haven't gotten to check in with you since we've had these juicy predictions about Netflix possibly being merged with another company or taken over, the drama with Warner Brothers Discovery. What are your big, bold predictions?
Well, I think the whole ad industry is obviously in a lot of turmoil. The biggest thing that's occurring is with all this new content coming into the market from Netflix, from Disney Plus, that's going to cause a price war. And so you're going to start to see prices for ad inventory come down. They're already coming down in Q1, and that's going to last for
More downside.
And so 2023 is going to start out a bit rocky, but I also think you're going to start to see the way to combat a price war. If there's more supply than demand, you got to get more demand into the market. And that's going to come from direct response advertisers, which ironically, in a lot of cases, are spending less with Meta, less with Google. And so there's a lot of change in this market. That's the biggest prediction. And especially for the television market, they're going to see a lot of turmoil in the first half of the year.
Julia, is it all just a consequence of companies cutting back on their budgets, or does it reflect a change in power of where the eyeballs are? I would say there's definitely a notable change in power. There's so many different factors at play right now and so many transformations over the past year. One fact that I would point out that I think is really important to note is the fact that this is the first time that Google and Meta have not had over 50% of digital ad market share since 2014. Wow. This is according to Insider Intelligence. So we've talked a lot about the digital duopoly in recent years, but the reality is that digital duopoly is losing.
All right, high or low printing.
Of Amazon to the likes of Apple. And I think it's really going to be interesting to see what happens in this Apple versus Meta battle. And because we really have seen Meta and other of these players really curtailed in their ability to target ads. Luckily for them, they're going to be coming up against some better comparisons when it comes to dealing with those issues. But I think look for what we call the rise of the rest, the other players, as Meta and Google face more challengers. Got to get Steve Case to front that. Mark, so Julia mentions Amazon. How big of a player are they becoming? Apple as well. When we start looking further to 2023.
Well, I think in the case of Amazon, they're essentially selling their search results, which used to be free. You used to go to Amazon, search for the products you were interested in, and you got the results. And then Amazon figured out they could start monetizing those search results for when you search for products. And so their ad business is very unique in that they just took an asset.
Bear flags, building on SPY.
Essentially taxing their sellers on Amazon in order to get the best search results. So that's very unique. I think in the case of Apple, one thing that's really interesting, actually pivoting a little from Apple to Meta, is there's a number of people that think the metaverse is as much play for Facebook.
Meme stock, Cala, driving higher, making higher lows right now. Cala.
Facebook, Meta, I should say, is playing a very long game in terms of the metaverse to essentially get beyond Apple in the future. I think in terms of
More downside in SPY, apparently.
TV market that's more supply is going to put more downward pressure on prices. But honestly, I don't see them having the heart for it. They just have never really truly been advertising.
Well, or they'll develop the heart for it too late, I guess, and then come in with big bucks, ready to spend it around. Julie, what would you add to that? Yeah, I think he's absolutely right. I've heard that as well. If nobody wants to be playing a game with rules that another platform has created, and that's exactly what happens when Meta is operating Instagram and Facebook on Apple's devices. So I think that's key. 10 years down the line, they want to make sure that they're serving you ads in the metaverse on their devices and playing by their own rules there. So
So I think that's a key thing to know. But I would also just say that, this is the year that we've seen at the end of the year, the launch of more ad-supported streaming services with Netflix, with Disney Plus. Next year, we're going to see the combination of the Discovery Warner Media assets into a single streaming app. I think it's going to be a new phase for the streaming wars.
Got a little bit more than 2 hours to go. Markets are not showing any headway, just pushing a bit lower now.
And Mark, as you respond to that, let me just throw this in here as well, because I know one of the things you think we're not focusing enough on is the regulatory risk coming from the administration. So even as I keep asking, well, what about Netflix, or what about this merger or that merger, is there a sense that no merger gets done and that that's what's creating this state of suspension where ad prices keep falling because there's just so many options out there and consolidation is tough?
Yeah, I mean, in terms of the media companies, I actually think you're going to see a lot of consolidation. Essentially, some of the because I keep referencing there's a price war coming. With all this new supply coming in the market, it's going to trigger the prices for ads to go down. And I just think there's a lot of TV networks, a lot of content suppliers that are going to struggle to survive that as standalone companies. So I think you're potentially looking at a lot of media mergers and acquisitions over the course of next year. What's really interesting is that Google, Amazon, Meta, these companies can't get an acquisition past the FTC. I mean, Amazon can't acquire a vacuum cleaner company right now without the FTC trying to block the deal.
All right, SPY drifting lower.
Just because everyone knows Roomba, maybe they got to go something more obscure. We'll leave it there. Guys, thank you both today, Mark Douglas and our Julia Morstan. Before we head to break, I just wanted to take a quick moment to thank our executive producer, Maria Bowden, on her final day here at the helm of both the Exchange and Power Lunch. I'm trying not to tear up while I say this. Maria was integral. There she is back in the control room. She was integral in the formation and launch of this show nearly 4 years ago. Now she's moving on up to start and end her day a little earlier here at CNBC. Her energy, creativity, her enthusiasm for obscure market stats and ability to work.
Trying to make a higher low. SPY.
We're so happy for you.
Not really interested in trading this market. Next year, we'll have a new start. See if we can't get some sort of direction. Right now, the direction is down. Weekly.
But the future isn't looking so sparkling thanks to climate change. That's next.
Tesla managing to hold on to higher lows for now. Looking like a lower high now on spiders. All right, what is silver doing? All right, we're just moving a bit lower. Silver, gold, safety assets, safety trades, those are still trending. GLD, all right, still trending. US dollar pushing lower. US dollar. The 10-year moving higher. Going into year end, 10-year is making new highs, headed towards 4.33%.
Welcome back. I want to get to one more thing before we go, and just in time for New Year's Eve. It's champagne. But bubbly, they say, is at serious risk due to climate change. Diana Olick has the story. Diana?
Well, Kelly, it's not just for New Year's Eve anymore. Champagne sales have been soaring all after year, a record $6 billion in 2021. Exports to the U.S. last year jumped 64% from the year before, and this year may be even stronger. But
All right, so we'll continue to move, grinding a bit lower.
risk due to climate change. France's Champagne wine region's exposure to physical risk caused by drought will nearly triple by the 2050s. That according to S&P Global Sustainable 1. It will then more than double again by the 2090s. Now, we already saw record drought and heat last summer cause the Champagne grape harvest to move up a month to August. The same thing happened last year, but it was thought to be an anomaly. The grapes have been maturing faster due to heat and drought. While drought is the primary challenge, Champagne's risk of extreme heat and fire will double from now to the 2050s, according to the report. Last summer, France's famous wine regions saw so-called unprecedented wildfires. Now, LVMH is the name with the greatest exposure, with brands like Moet and Chandon, Krug, and my personal favorite, the Clicquot. No surprise, champagne prices are rising along with the bubbles. So drink up, Kelly. Happy New Year.
So is it just a timing issue, or, in a way you wonder, could the champagne producing region end up migrating or something like that?
Well, it can't migrate far because champagne is called champagne because it comes from the Champagne region of France. Now, you can get sparkling wine anywhere, really. In fact, they make it in England. I just learned that yesterday. And of course, there's Prosecco in Italy and there's sparkling wines in California. But champagne has to come from Champagne. So they're really stuck with whatever the climate is. And it's not just the climate, but again, that wildfire risk. And we saw so much of that in California over the last couple of years as well.
It's a good point that it's become much more common. I have been thinking about, at home, there's Prosecco, there's sparkling wine. It's almost becoming a commodity. Now, I know people want champagne itself for the high quality and making a statement and all the rest of it, but could those other categories come to supplant champagne and eat into its market share, especially with these existential risks?
Well, of course it could, but again, you go back to all the snobs out there who say it has to come from Champagne. That is the true champagne. Can you, of course, have sparkling wines? Sure you can. It just, it goes to the market of, are you going to buy that ultra luxury that comes from the original place where it was created, or do you buy, I don't know, it's not a knockoff to say, but you can certainly get it somewhere else.
No, I learned a lot about that region watching the Tour de France this summer, by the way. Kind of a bonus highlight. Diana, thank you very much. We appreciate it. Diana Olick. And that does it for The Exchange, everybody. Power Lunch begins right now.
And happy New Year's Eve, and welcome to Power Lunch, everybody. I am Brian Sullivan, in for Tyler. Maybe you're sipping a mimosa or whatever. Here's what's ahead. From the Fed to emerging markets to maybe a generational opportunity in fixed income, we have got your ultimate 2023 playbook. Plus, YouTube gets in on the NFL. Apple gets into soccer.
All right, we're just drifting a bit lower. We got 2 hours to go for 2022. 2 hours to go. Counting down to the last trades of this new year.
Let's do it. We're getting ready for New Year's Eve, everybody. Welcome to Power Lunch. I have a lot of the bad news to run through, so bear with me. First of all, it's a down day. The Dow's down 300 points The S&P is down 1%, could be one of the highest number of 1% drops we've ever had in December. The Nasdaq's at 1.1%, and the S&P at this level below 3812 will post a 20% drop for the whole year. The worst year since 2008 for all the major averages, snapping a 3-year win streak. The Dow, by the way, off less than 10%, so it's the outperformer. The Nasdaq down by 33%. Energy, the outperformer, the only happy thing we can talk about, up 58% this year, on pace for its best year ever. Communication services, which is boring but has the exciting
SPXU hedges moving higher.
down 41% and breaking its 3-year win streak, Brian.
All right. Well, just a couple of hours left in the trading year, and we have tried to work hard this year to get you prepared for next year. But now it is time to kick it up a notch with the ultimate power playbook, what to expect from the year ahead. The key macro market fronts, we got Steve Leisman on the Fed, Seema Modi tracking emerging markets, and Christina Plexinevelos taking a look at what some may think is the generational opportunity in fixed income. But let us start with Steve and the Federal Reserve. Steve.
Hey, Brian, thanks. The Fed is going to be hiking and holding next year while it cuts its balance sheet deeply. But with the question of how much rates eventually rise a matter of strong debate, the only certainty is the Fed's going to be a source of ongoing volatility for the stock and bond markets in 2023. The market has the Fed pressed to hit its peak rate in June at just under 5%. Then gradually, the price in an easing over the year towards 460.
All right, we're heading towards that 378.43 low. Tesla's holding up fairly well.
They start in May where it gets interesting. The market trades with a 7% chance of a 25 basis point cut, a 40% chance of
Poly, a big drop off on Poly there.
chance of a 25 basis point hike, and a small probability of a 50 basis point hike. That pricing reflects the broader debate for 2023 on growth, recession, and the outlook for inflation. What's less debated, the Fed's plan to reduce its balance sheet. That's supposed to come down by about 1.1 trillion next year to around 7.4 trillion. That should have more of an impact on stocks and bonds as the year goes by. Kelly?
Wow. Steve, thank you. Emerging markets, meanwhile, set to end their worst year since 08. Do investors see a path forward there? Seema Modi has more. Seema?
Well, Kelly, with the exception of Europe, international stocks didn't fare any better than the S&P 500. For next year, there is growing consensus, though, around a China rebound. Citi turning more bullish. Evercore ISI's Neil Wang saying he does not see Beijing backpedaling on its reopening plans despite rising COVID cases. JP Morgan expecting
More downside.
Fuel emerging markets, projecting a 14% gain next year. Now, the outperformance of China and the emerging world could hinge really on the direction of the dollar. Investor Jeffrey Dunlop telling CNBC earlier this month that the USD has already peaked and that it should continue to weaken going into next year. Commodity-linked markets like in Latin America faring better than the rest of the world this year. Hedge fund investor Will Landers at BTG Pactual telling me he's less constructive, though, on Brazil, citing the uncertainty around the new president Lula's leadership. But he still is a buyer of names like Brazilian bank Itaú and car rental company Localiza. He's also overweight iShares Mexico ETF EWD on this bet that more companies will diversify their supply chain and sort of nearshore operations to Mexico and other countries like India, right?
Yeah, it's going to be crazy looking around the world with everything that is going on, particularly with energy prices. Seema Modi, very quickly, is that kind of the focus? Is energy going to be the thing? Not that I care about energy or anything.
No, I think you're exactly right. It's clearly played a role in driving a number of markets, including Mexico, Peru, and Brazil this year. That's why those three markets are outperforming emerging markets in general. So it really hinges on oil and other energy prices, whether they move higher or lower. That could play a big role in whether these countries outperform next year.
Seema, thank you very much. All right, so as the third part of the trifecta, for the last decade, bonds have been anything but sexy for most fund managers. But some are expecting a big resurgence in the year.
All right, big drop off here again.
Fixed income yield has been so low, and it's been so
Market's dropping off.
But a new Bank of America fund manager survey shows investors are actually overweight bonds relative to any other asset class for the first time since 2009. So why is this happening? Well, yields mean higher interest payments, and those yields, like we saw Steve talk about, are expected to stay high as the Fed has signaled no immediate pivot until inflation falls and the labor market weakens.
And you got many experts right now. They're suggesting some bonds in the first half of next year. Some suggesting short duration, given the Fed uncertainty, like the iShares short Treasury bond ETF that you're seeing on your screen. While Citi analysts say don't miss out in the explosion of corporate bond ETF options like IG and LQD. Also seeing that on your screen. How about munis? Listen.
We still think the fundamentals are pretty solid for most municipalities. I mean, we think that the incomes are good at the state and local level still. So we think that there's strong fundamentals. We do like municipal bonds here.
Bonds and ETFs that track bonds may not be as exciting as crypto or big tech, but they could offer stability as we head into an uncertain 2023.
No, it's I was gonna say they're sexy. I don't know if we can say
boring.
I don't know what a choice of words.
Bonds are sexy again. Yeah.
But I mean, you guys, Steve, you know what I'm talking about. We just got the stats in, Steve, for the bond market. The biggest increase in, I think, the 10-year yield. Let's see, 13% increase there. 10-year Treasury yield closes, up by the biggest annual increase since at least 1953.
Yeah, it was a rough year, and you remember there was a moment there. I guess it was in November when the 10-year was falling, and then it turned around. And I think a big sort of somewhat underweighted story, I'd say, was the turnaround in Europe and the turnaround in Japan. And I think that's a new factor for the Fed. I wonder how they're going to be factoring that into their monetary policy, in that they are now getting serious help on the inflation fighting front from overseas. And I think that's going to play a factor. I also think, as I said earlier, that you're going to get to a place where reducing this balance sheet is going to be having a more profound effect than it's had so far. So all of that may mean the Fed can do a little bit less here. Maybe it should do a little bit less because of that. But the question is when the Fed recognizes that's the case.
Maybe we'll call it the Justin Timberlake market. We're bringing sexy back. No, don't shake your head. Look at Seema smile. Christina, come on. I mean, you know what I'm getting at. Hey, 5% return with some tax benefits if you're buying direct from the Treasury on your state tech. Like that, 5%, maybe the new 25%.
All right. Markets to continue to slide lower on this whole JP Morgan roll.
Even less than a year, the returns are anywhere between 3 and 5%, like you mentioned. But the point is that a lot of the bond experts I spoke to are still suggesting that you should stick to short duration, shorter term lengths as well, just for the first half of the year. Bank of America, one report, they were actually suggesting bonds over equities for the entire first half of the year, and then pivoting to that regular, 60-40 ratio that we're supposed to have in our portfolio, but has seemed to have failed for many just over the last year.
And the only fly in the ointment here is we're all sort of gushing over bonds is if rates do go higher. I mean, listen, we're all reminded this year, just what they print on the yield is not exactly going to be what you pocket in returns. And China is a factor here as well. It's not just all about the Fed. I'm really curious to see as that reopening proceeds if that boosts global GDP and helps send yields higher and all the rest of it.
And if it's inflationary, and if it sends oil prices higher, how does that impact what the Fed does next? So sure, a lot of different factors to be considered. I would point out, still on average, emerging market debt yielding 5 to 7%. So still getting a better rate overseas than you are here in the U.S., despite the run-up we've seen in yields this year. So that's something to consider as well.
Steve, what's the biggest thing on the Leisman rate?
Brian, I want to make one point real quick, which is that these corporate bonds are interesting. Emerging market debt is interesting, but you have to make a case that these bonds are mispriced relative to the market and the risk that's out there. If what Kelly suggested comes true and the rates go higher, there's going to be risk. Next year, I think, is a year of reckoning. It's a year of reckoning of businesses and countries that have lived and prospered at very low rates. To next year, they're not going to have those low rates with which to prosper. And we're going to see separate the women from the girls and the men from the boys when it comes to financial foundation and basics here. And it's going to be an interesting year. It's not everybody.
All right, we continue to grind lower here.
I do worry about commercial real estate, Steve, to your point, right? Some of these big, giant empty buildings in New York and San Francisco is a lot of debt that was issued to pay for these buildings, which are now sitting empty.
Yeah.
May I just chime in for that? That's why the prediction for a lot of default rates are expected to double. I think it was just Moody's on Wednesday. I was reporting about that, and they are thinking that it's going to go from 2.9% to 4.9% for global default rates around the globe. So that's to your point. And another cautionary point for everyone salivating over bond yields. Maybe, hopefully, we don't have to worry about for treasuries this year, but for a lot of other places, tread carefully. Thank you all. We appreciate it today. Steve Policeman, Seema Modi, Christina Parks, and MLS. Let's stick with the question, though. Our next guest says bonds should be part of your portfolio. David Spica is president of Guidestone Capital Management. All right, David, make your pitch.
Well, let's think about it. For 13 years, we were told don't fight the Fed. And that meant the Fed was lowering interest rates, flooding the market with liquidity. So to get a decent yield, we had to go out on the risk curve and buy equities. And that worked. Now, the Fed is raising interest rates. They're draining liquidity out of the market. Why are we fighting the Fed? Let's go to the part of the market that the Fed is favoring today, short-term, high-quality bonds. You can get 4% in money market. You can get 4.5% to 5% in high-quality, short-duration bonds. We absolutely think that's an excellent place to be, especially when you consider that the market probably has another 10 to 15% downside from here.
Wow. So let's go back to, it sounds kind of easy to say, but high quality short-term corporate bonds. I mean, this is not something, someone sitting at home who could otherwise, be in and out of ETFs or whatever. This is not as easy to execute.
No, I think that the average investor should be buying bond funds. There's lots and lots of really good quality bond funds out there where you can get the yield. You'll benefit when rates eventually start to fall, which will happen once we go into recession. However, this higher for longer posture of the Fed could keep rates elevated for a while. And what Steve Leisman said made a lot of sense. This higher interest rate environment is going to have a dramatic impact on sovereigns, on corporates, on equities across the world. And if I can sit in a high-quality bond fund earning 5% while the rest of the financial markets continue to suffer volatility, that's a pretty good place to be.
Let's talk about some stock picks and some opportunity heading into the new year. One of the names you like is Stryker, not Ted Stryker, but Stryker, the medical device company.
Yeah, the companies that we like, Ryan, are companies that have good earnings visibility and have somewhat of a recession-proof business model. Stryker's a good example of that, trading at a rich valuation, but of course, right now you're going to pay a premium for safety. But Stryker produces reconstructive joint and spine products, great opportunity with the growing aging population in the world, and the fact that people are needing more and more of these sorts of treatments. A great place to be, a consistent double-digit grower that's going to fare well in a volatile environment.
You like Humana as well. David, healthcare, obviously names like Merck and the Dow, these were a standout this year. Does that continue? Is that a safe place to be?
Well, you call them healthcare, but let's think about this. These aren't companies that have exposure to dampening drug prices or regulations on drug prices. Humana is a very, very high-quality insurer. They have the opportunity in 23 to raise their premiums while keeping costs down, which is positive for their margins. They're one of the leaders in Medicare Advantage, and again, a very consistent double-digit earnings grower. When earnings are scarce, investors pay up for earnings visibility, and that's where you get in a company like Humana.
I'll play the Justin Timberlake music because we're bringing boring back. Healthcare,
Amen.
bonds.
Justin Timberlake market. Point it.
Thank you,
Amen.
David Spica. We appreciate it. Happy New Year.
All right, coming up, as China and Macau reopen their doors to millions of Chinese gamblers, 2023, the year to place a bet on the casino stocks. Plus, the Tower City Index is about back. Our big reveal for the top 3 cities in America for the stock market, and the mayor of that Tower City will join us. And by the way, here's maybe a hint. As we head to break, a look at the big S&P winners and losers this year. Your winners, notice a trend?
All right, we'll continue to move lower.
Marathon, Exxon. Your losers for the year, Generac, Match Group, Align Tech, SVB Financial, and Tesla at 65%. We're back after this.
All right, I'm looking at. I've been looking at the strikes that J.P. Morgan has been trading. Okay, those strikes that Terry listed above in the trading room, I'm looking at those. I'll do some analysis this weekend on that situation. Out of the money puts. The idea is participate in upside while being protected on the downside.
Welcome back. In this overall lousy year for the stock market, you're probably wondering what American cities did the best and the worst in the stock market. Well, we know through what's called our Power City Indexes. Now, we haven't done them in a while, so if they're new to you, here's a quick recap. We built stock indexes with the 11 or 12 biggest market cap companies across 37 different cities and metro areas. Chicago, New York, LA, Houston, Philly, etc. But also places like Silicon Valley and San Francisco. They're close, but they're distinct areas for business. Now, we equal weight all 11 or 12 stocks, and then we simply follow them and average them up for the year. And quick 2 notes before anybody gets all jumpy. Number one, some companies may be headquartered just outside an actual city, but still in the metro area, like Downers Grove versus Chicago. We get it, that's in Chicago.
All right, we're back down to that 378 level.
Friendly competition. They're not actual investable indexes or ETFs, although, hey, you never know. All right, so let's go. Now, this year, obviously, a really bizarre year for the markets and for the Power City indexes as well. Only 2 cities actually had a positive year, and one just barely. Now, we're going to walk you through the top 3 cities for the stock market this year. But before we do that, we're going to start the year with the Razzie of the year, if you will. The worst city for the stock market. City we talked a lot about.
Tesla's still hanging out up here at the highs.
And the Womp Womp Award goes to San Francisco. All 12 of its stocks and its PCI, they fell. Look at that. The average return was a decline of 54%. Every stock dropped. You had huge drops in Twilio, Okta, DoorDash, etc. By the way, this is only San Francisco. Silicon Valley is a separate index, and they actually came in the second worst. Sorry, San Fran. All right, enough bad news. Now to the good news. All right, let's count them down. The top cities for the stock market this year, coming in at number 3, the capital of car racing, Indianapolis. Power City Index posted a loss of just over 6%, but even with a loss of 6%, that made it the 3rd best performer. Eli Lilly had a big year, followed by Calumet Specialty Products, Kelly's favorite company, and Allison Transmissions. The 2nd best city for the stock market this year, my mom's hometown, gateway to the West, St. Louis. Double-digit gains by Reinsurance Group of America, Amdocs, and Post Holdings, helping mitigate losses in stocks like Perficient and Core in Maine. Look at that. Reinsurance Group, St. Louis, squeaking out a 0.2% gain, but a gain nonetheless. You go, St. Louis. And now it's time for the big winner. This should not be hard. Houston. Kelly, present it. Come on.
Show them the hat, everybody. Houston gets the draft hat coming down. That's right. Now, I thought Brian just rigged this so he could talk to Tillman Fertitta about it, but it turns out they've done that all on their own merits.
There we go. Houston is the top city. I mean, this wasn't hard.
No, it was obvious, guys.
But we're blocking the returns here.
All right.
Because we're both, like, tall and...
Back to you.
No. Look at this. Average gain of 12%. Almost every stock in Houston was up. A big energy story. Huge gains in Occidental, ExxonMobil, Schlumberger, Danaos, SLB, and more. Had a couple losses. Crown Castle, what are you doing? Down 34%. Lyondell Basel, down 10%. But overall, Kelly, Houston.
Applause to them.
H-Town. There we go. Let's bring in the mayor of Houston, Sylvester Turner, who we can also see as applauding. Mayor Turner,
Yes.
Yeah, I'm frequently in your spine city for all the right reasons. Congratulations. But on a serious note, I mean, listen, it's an uncertain economy. This has got to matter for the economy. How do you see Houston doing right now?
Well, I'm very proud of where the city is, but I'm even prouder of where the city is going. We have diversified our economy over the last 20 years. And quite frankly, you all know, we're known as the energy capital of the world, but now we're focused on leading an energy transition. So that area is really growing. But at the same time, when it comes to life sciences, healthcare, you all have been talking about it on your program. The Texas Medical Center, the largest in the world, right here in the city of Houston, they're looking at expanding by 20 to 25%. And the focus is now not just on medical services, but entering into that commercial sector as well. I'm very excited about that. The port trade, we have the largest port in the United States in terms of foreign tonnage. And in almost every category, the Port of Houston has been exceeding previous expectations. So proud of what's happening on that front. So a lot of good things. More Fortune 500 companies are moving into the city of Houston. NRG, Axion, Hewlett Packard are all here. And then what's happening at the spaceport in the energy in the city of Houston is just growing by leaps and bounds. So Intuitive Machine, Axion, Collin Aeronautics, they are building, creating jobs.
Yeah.
So when you look at jobs, capital, all of those things are looking good in the
Because
city.
Mayor Turner, I have to imagine that, a lot of people think this is a difficult award, right? It's fossil fuels are supposed to be going away and all the rest of it. Now, I think the energy crisis here has reminded us how much we need and are grateful for this industry to kind of get us through the energy crunch. But you have to be thinking long term about what happens if people really start to push this stuff to the sidelines.
Well, and we are. And we put forth what we call
All right, another bear flag.
and even our climate action plan. But we're not demonizing our energy sector. We're working in collaboration with them. So the focus right now is to build clean tech, climate tech companies in the city, working with Greentown Labs that has expanded to Houston from the East Coast. And they have exceeded their expectations on the construction of these companies. We're focusing on clean hydrogen. We're focusing on carbon capture, utilization, and storage, thermal energy, all working in collaboration with the energy sector.
Yeah.
And if I can,
Well, Mayor, let me just ask you one more question. Yesterday we were talking about a lot of the social issues cities like San Francisco face. And I'm curious what you are trying to do to make sure that, and again, I haven't been to Houston. Brian can speak more to this than I can.
You've what? You've never been to Houston?
I've been at some.
Mayor Turner, we got to remedy this.
I've been to Houston, I've been to San Antonio, I've been to Dallas. But listen, I was just going to say quality of life issues. We here in New York, we're dealing with some of the same stuff. Quality of life issues. Is there a clear plan for Houston to make sure that it's not just, when your fortunes turn the other way, much like happened with tech in San Francisco, how do you keep the city safe and clean and resilient for everybody?
well, let me just say, even in terms of public safety, our numbers in terms of crime in almost every violent crime category is down in comparison to last year. When you talk about homelessness in the city of Houston, I know there's a lot of conversation about the East Coast and the West Coast, but the city of Houston is leading the way nationally on the reduction of homelessness in our city. We have less than 3,000 people who are homeless, not just in Houston, but in the region. And we're working on reducing that even more. When it comes to green space, our focus is on parks and green space, quality of life. So we are laser focused and not just focusing on energy and life science, but on the things that also matter to people. The arts, that represents the soul of our city.
And that's first off, Mayor, that's why we got to get Kelly. Next time Tyler Mathis is on vacation, we're taking power lunch on the road. I know a guy that owns a nice hotel called the Post Oak and about 700 restaurants. And it's got amazing museums. It's got amazing restaurants. It's got a world-class zoo. I took my 7-year-old last year to the zoo. It's not people think it's like these.
All right, another bear flag on Spy with an hour and a half to go. if you're concerned about the potential for more downside, that JP Morgan collar is telling you what they're looking for. They're short the calls and long the puts.
Back in 1836, we were built on the bayou city. But now it's how do we live with the water, and how do we do it in such a way that we don't sacrifice the quality of life of people who live in our city, businesses that are doing business in our city, and how do we continue to attract folks? So when you look at what's happening, that's why the action plan has come into existence.
Very quickly before we go, Mayor Turner, from a business perspective, in a given month, roughly, not hold you to it, but roughly, how many CEOs do you hear from that say they might like to move from somewhere else to Houston?
I hear from them on a regular basis, and I'm on conference calls, Microsoft Teams calls, Zoom calls all the time, and we have been very successful in encouraging companies to come to the city to change their principal headquarters, like NRG, Hewlett Packard, Axiom. All of these companies have decided that Houston is the best place for them.
Okay, getting a little bounce now, a little short covering.
A little sore spot. They're stealing them from central New Jersey, near where I live. They're leaving New Jersey and coming to Houston, but they're already naming half the things there anyway. Mayor Sylvester Turner, really appreciate your time. Congratulations, top city for the stock market. Happy New Year. It's going to be Happy New Year for Houston.
Happy New Year, Brian. Happy New Year.
Thank you, Mayor. We really, really appreciate it. Where's the online? Do you have online the whole list of people want to?
Houston has the internet.
No. You have the list online if they want to know where in my city, but Baltimore, Denver.
No, but that's it. I think you just gave me a homework assignment, Evans. I know your dad's a college professor, but come on. Okay. Yeah, I should do that, though. We should rank the whole Power City Index.
Yes, absolutely.
San Francisco, terrible. Silicon Valley, second worst. Baltimore was third worst. I can't tell you that. Under Armour.
Right, exactly.
Right. Only 11 stocks.
We can probably guess the extremes, but the ones in the middle are rather interesting.
Okay. Tesla's doing okay.
We got to get you to Houston. It's ridiculous.
I've been to a lot of parts of Texas. I just, for some reason, haven't been to Houston.
Big state, by the way.
Still to come. For 2023, the cards are dealt, and it's time to inspect your hand. Casinos have some good news, some bad news. Good news is China's lockdown easing could be a boom for Macau. Bad news, recession risks could hurt Vegas. Is now the time to up the ante or fold? Plus, our three-stock New Year, our trader lays out two buys and a sell for 2023 in a special edition of Three-Stock Lunch. And here's a look at this year's Dow winners. Chevron, Merck, Travelers, and Amgen. By the way, Caterpillar was number 5. That's interesting. But Chevron leading the way up 52%. Go Houston. Well, California. Anyway, we'll be right back.
All right, so going into the close. We have an hour and a half to go. Or with the lows of the day starting to turn now. I wouldn't be surprised to see some mean reversion now. All right, a little bounce there, still producing lower highs into the last hour and a half of the trading day.
Add Britain and France to the growing list of nations requiring COVID testing for travelers from China. Visitors arriving from China must provide. Has set a start date for the new testing rules. Meantime, the world continues to wait for news on the health of a 95-year-old retired Pope Benedict. The Vatican says he remains in stable condition and was able to rest comfortably overnight and participate in a private mass in his room. And in Kiev, volunteers have been preparing a Soviet-era holiday salad for Ukrainian troops on the front lines. It's a New Year's treat that is not meant for vegetarians. This particular batch includes 2,200 pounds of sausage and gallons of mayonnaise. The volunteers are trying to beat their production from last year, and when they were able to send 7 tons of the festive salad to hungry soldiers. Brian?
Love it. Volunteers, what do they say? Not paid, not because they're worthless, because they're priceless.
Yeah,
Exactly.
I'd never heard that, but that's a great way to put it.
There we go. And you've never been to Houston.
And I was just hoping you were going to say anything about the mayonnaise in that.
I don't want to get back in that Miracle Whip fight like it's set Twitter ablaze. All right, head on Power Lunch. The game is afoot. It was a big year for the sports business world. Billions spent buying teams, selling teams, and streaming rights. But is the sports spree just getting started? Bruin Capital founder and CEO George Pine will join us next. We'll be right back.
Knows healthy life. Welcome back to Power Lunch. One lesson we learned from the financial crisis was that sports valuations rarely fall, even in the worst of economic times. 2023 could put that to the test. A tech giant has spent billions to get into the sports streaming business. We just had an NBA team sold for a record $4 billion. And one of the few companies to have raised money lately, billions of it, was a sports licensing company, Fanatics. So can it keep going, or will this time be different? George Pine is founder and CEO of Bruin Capital, a global sports and entertainment company. George, it is great to see you. And do you think the industry can hold up this time around as well?
Oh, great to see you, Kelly, and Happy New Year's. But absolutely, sports for 30 years has grown at double-digit CAGR. So it's been a very resilient class. And if you look at last year, recently the Phoenix Suns at a $4 billion valuation. Chelsea, $3.1 billion is amazing. The Denver Broncos, sounds crazy as it sounds, probably at $4.65 billion was a steal. And as you mentioned,
Sorry. No, but it's true. George, this is I guess the point. And we have seen in the UK, they saw things wobble a little bit with that kind of disastrous auction for Premier League rights in 2018. But now that we're reaching a point of max saturation and we're starting to see different big tech devices, streaming platforms get out of this game, the audiences aren't going to be what they once were. I don't know. Do you think that these valuations will be justified? If legacy cable goes away, like Alex Sherman, sources have been reporting, in 5 to 7 years' time, could we actually see the value of these sports rights start to fall? And what would that mean for all of these big acquisitions?
I don't think so. One, you have a scarcity. There's only a limited number of these premium brands. And two, I think the lifetime value of the consumer and data is going to unlock a whole new category of value. And sports are still the only things that grab big audiences and engage people in a very passionate way. So I don't think there's any evidence to suggest that that's going to happen. It's possible because there will be a change in the way media is consumed, but we don't see any evidence of it. And of course, you just saw the NFL with YouTube break a new record in terms of what the value of those rights are. So we haven't seen any evidence, and this is a question we've been answering for 15 or 20 years.
Yeah, and by the way, George, randomly, I sat next to a guy on a plane. He was a fan of yours, fan of CNBC's, Charlie Besser. So he says hello, by the way. I'm like Chicago-based. You guys know each other. So
in a sports, yeah, good man.
That's it, yes. And he was talking to me about how great pickleball is.
Oh, no.
No, seriously, it's a pro league. So I asked that for a reason. It wasn't just random, which is a lot of sports on the ascension, George. Do you see some sports that are on the decline? Where is there work to be done? Not everything can boom.
Yeah, it's a good question. Obviously, in the major sports, baseball is probably the most challenged with 162 games and an older demographic. One of the sports on the rise is women's sports, particularly in the European Women's Championships was an amazing success story. I kind of like the National Women's Soccer League here in the United States. So I'd say women's soccer globally is on the upside. Baseball probably has the most headwinds, but are still strong.
In baseball, is there any fix for baseball? The purists will tell you we got to have 162 games, otherwise all the records don't matter. But at some point, do you just say that was the old baseball? The new baseball is going to be 85 games in a season and no game longer than 3 hours unless it goes to extra innings. What's the fix?
I think you got to look at those things: shortening the season, bringing in new elements to the game, maybe shorter games, maybe 7 innings versus 9. We saw them experiment with that in COVID. It went quite well. So you definitely have that pull between the purists and the reality on the ground that young people today sitting in one place for 4 hours watching something is unlikely. So you have to adapt your game for the future. And I'm sure those are the things, you look at the things baseball is putting in for pace of play, they're looking at shortening the game and other innovations. And
kind of implicit in what you said about baseball makes me wonder about your view of Apple. They've signed the MLB deal. They've signed, I think, the MLS deal. And I don't see people exactly trying to rush into men's soccer right now. Maybe I'm wrong. Maybe that will change and pay off. Are they making the right moves? And should they decide, pickleball? Well, that's what we're going to be the platform of pickleball. It's the future.
It's booming.
I know it is.
I think for Apple is a good move, and for Major League Soccer. Look, the young generation, the growth move is in streaming. The problem is the money is in the old media. So MLS was able to find a partner that checked the box financially. That depending on how you look at it, they doubled or tripled their rights fee, and they've got a partner now that can take them places that they couldn't otherwise go through streaming and the younger demographic. And the demographic of the MLS really matches Apple. And so what's new in sports, you have YouTube and Google coming in the NFL. You have Amazon entrenched in the NFL, and now Apple with MLS. So you're seeing new players coming in that bring a new demographic to the sports properties.
George Pine, Real pleasure, by the way. And a shout out. We've talked about it before to your brother, Jim. Went to Hokie, Virginia Tech at the same time. One of the best centers in college football history. His brother, Jim Pye.
Dynastic family over here.
Unbelievable. Yeah.
Go Hokies. Go Hokies. Frank Vapor and the Virginia Tech Hokies. Love them.
See, he's going to be back on the show every week now.
Yes, he is.
Except Tyler's a Cavalier.
Oh, don't start some drama.
That's a problem.
Oh,
all right.
Problem.
Is Macau bracing for a boom? COVID restrictions in China finally lifting, but there could be some bad cards hidden in the deck. We'll talk about it coming up.
All right, by now you know that JP Morgan around 145 rolled. Was it 1245? Anyway, they rolled out. They are long puts below 3600. They have long puts open 3600, and I think what was the other one? 3040 puts. So we got wings down there at the low. And 4030 on the upside. So 3600 put, they're looking for 3600 in the short term. And they have wings at 3040 put and short the 4030 call. All right, so SPY is just sitting here not doing anything. McDonald's looks ugly, dropping off below 265. McDonald's. All right, SPY still producing lower highs. We're down 45 handles on the futures and continue to see selling. JP Morgan rolled lower.
Welcome back. Kind of a mixed year for the casino sector. You got to grapple with all kinds of things like big restrictions in China against just a wide open and booming Las Vegas. So what's going to happen next year? Contessa Brewer is here with that. Contessa.
Hi there, Brian. Casino companies are getting ready for a new year with big changes. Macau, the world's gaming capital, borders have reopened, concessions have been renewed, and billions in new investment have been promised. All this should be the fuel for the mother of all pandemic rebounds, but the COVID surge across China is reining in expectations for an immediate boost in tourism. So patience still is a virtue for Las Vegas Sands, Wynn Resorts, Melco, and MGM Resorts. Secondly, what recession? Casino companies across the United States are doing a booming business in spite of inflation that seems to have affected other areas of consumer spending. Boyd, Bally's, Penn, and Red Rock are watching their regional and local casinos for cracks in the business. Third, Las Vegas on steroids. This has been a record-setting year for profits on the Strip. 2023 could propel Sin City to new highs. A packed convention calendar, entertainment, Adele, hello, and sports. The highlight, of course, F1 in the fall. MGM and Caesars are the biggest operators on the Strip.
All right, we got an hour and 12 minutes to go. This last trading day of the year.
Texas is very seriously considering considering legalizing sports gambling. But concerns over problem gambling pose new hurdles for the likes of FanDuel, owned by Flutter in the UK, DraftKings, and BetMGM. 2023 will be an exciting year in gaming. You can bet on that.
All right, Spy dropping off some more. Me either, Freno.
Are you serious? 100%. There used to be a Vegas. There was 1 year. I think it was 1980, 79. I think KK Rosberg won the race. I think. Big fan.
You weren't even born then. So.
Even Kelly's or even Contessa's dog like that segment.
Contessa, thank you, Contessa Brewer. Coming up, New Year's stock resolutions. What to buy, what to sell, and a special edition of 3 Stock Lunch. And as we head to break, here's a look at this year's biggest Dow losers. Intel, Salesforce, Disney, and 3M. It's the worst year for Disney. Here you go, speaking of that era. Worst year since 1974.
Low ticker at -800.
All right, Spy dropping off here.
Welcome back. It's time for today's 3 Stock Lunch. So let's take a look at 2 potential buys and 1 to sell investors should consider staying away from in the new year. Craig Johnson is with us today. He's the Chief Market Technician at Piper Sandler. There he is. And look at our 3 fun champagne bottles today, now that we know whether or not they are actual champagne. Anyway, Craig, let's start with Rockwell Automation. You think it's a buy. Why?
Yeah, Kelly, thanks. So if you look at the theme that's happening across the world at this point in time, it's a reshoring theme. And if you look at a stock like Rockwell Automation, you can clearly see on the chart that we're making a pretty nice bottoming setup here. Now, the stock is down 27% year to date, but you're up 35% off the lows. And I think this stock is only just starting to work as you're starting to see a move back above your 50 and 200-day moving average and a potential breakout back to the old highs. So that was one that I'd be a buyer in here.
All right, next up is energy name EOG Resources. Craig, love having you on, by the way. Happy New Year, my man. What do you see in EOG?
Happy New Year, Brian, and I'm glad you're talking about the energy names. You did a great job covering them. So if you look at EOG, it's been a very consistent, steady performer in here. You're back above your 200-day moving average. You can see from the chart you're back above a nice trend line support in here. And from our perspective, any short-term pullback should be opportunities to be buying the shares of EOG.
All right. There you go. The final name, semiconductor stock, Micron, been a tough one lately. What do you do?
So, Kelly, I think 2023 is all going to be about talking about this market X the technology sector. And certainly if you compare the two other stocks we've got to Micron in here at this point, you can see that Micron is still making a series of lower lows and lower highs, and it looks like it's very close to be breaking below those September lows. So from our perspective, I don't think the bottom is made here yet, and this is a stock that I think you got to continue to reduce, and, well, frankly, you have a little bit more time to take any tax losses at this point in time, too.
Yeah, and if you're right about that, then it doesn't make me feel that great about the rest of the market. What do you think? What are you thinking in terms of positioning?
Well, I think at this point in time, when I look at our relative strength, where clearly technology, consumer cyclicals are both in total return declines at this point in time in our work. I would tell you that I think this is going
All right, Spot, just sitting down here at 379. Would imagine we'd see some short covering in the next hour or so.
So it's going to be a market that's going to be X-Fang, X-Tech, but certainly there is good opportunities. It's always 5 o'clock somewhere when you look at the chart.
Frankly, I'm very surprised that Tesla held up as well as it did.
We'll leave it there. Thanks so much. Happy New Year. We appreciate it.
Happy New Year.
Craig Johnson.
All right, all ahead from artificial intelligence writing for you to transitory, proving to be the most locked word of the year. Our top stories of the year. It's next.
All right, looks like we're going to test the low instead. All right, rolling over now.
All right, we want to end the show and the year for this show with a look at what we thought was the story of the year, minus basic. I mean, it's not the energy crisis in Europe. I think that's big enough. It's going to continue. This year's story, I think, was inflation. It's coming down. That's the good news. but still inflation has been sticky. It was proven to not be transitory. I know people are talking about it coming down. It's coming down a little bit, but for a lot of families, food costs are out of control, housing costs are out of control, energy costs are out
All
of
right.
control. So inflation.
Not a whole lot going on here. I'm watching option flow. Last trading day of the year. Looking for a little bounce and some short covering now.
My word of the year in that bucket would be demand-driven inflation. Can we all finally agree that this wasn't a supply chain-driven story?
Okay, probably going to see some short covering now, I would think.
Nominal GDP grew 10% last year. Inflation surging, asset prices up, price of
We got an hour and 1 minute to go.
big time. And now that is the biggest.
And we have a poll. We asked on Twitter, by the way, it's still up and live. Check it out. What is the main cause of inflation? A lot of people, and I had 4 options. We're going to unveil the results coming up tonight. A lot of people said, why didn't you put in corporate greed? Corporations have always been greedy.
Yeah. That's not going to get you to 9% CPI.
No.
They'll be greedy when they have the liquidity environment to take advantage of, sure, in the same way that anybody would, but no. And yeah, I feel
it's part of a reason perhaps, but like most companies, mostly are increasing profits by shrinking sizes.
Mm-hmm.
By the way, speaking of that, I went to a fast food restaurant. I will not name a chain. I got a chicken sandwich. I thought it was a joke. Like I got a slider.
Yeah.
It was like they must have shrunk
You
it
gotta
by.
tell us.
I can't. They must have because I can't prove that it was smaller. It was like
Popeyes.
literally a little bigger than a silver dollar.
What did it start with?
I can't say it.
Okay, we'll leave that alone. But we take it. Listen, we have all experienced it. The shrinkflation,
Because I don't know if they shrunk it or maybe they just put mine in the dryer before I ate it. And by the way, it tasted like that too.
All right, let's talk about my story of the year, and it actually wasn't even demand-driven inflation. Okay, I'm calling it the Chat GPT phenomenon. Brian, you know about Chat GPT?
Oh yeah.
Yeah. I mean, listen, we're all kind of sick of hearing about it, but this came on the scene in such a quiet way just the last couple of months. And we had the image AI generators earlier this year. Now you have these text generators that are so easy to use. You have people saying we shouldn't even release these into the wild because they're going to pollute the internet in the future. This only reflects the internet up through the year 2021. Yeah. People watching, if you don't know what I'm talking about, Google it, ChatGPT, Google Playground, sign up for an account, use it. It'll blow your mind. You have to know this is what your kids will be doing.
Yeah, and how to write their papers.
Write their papers, absolutely.
Yep. Very quickly, a bunch of interviews, Goldman Sachs Energy Conference. I have to go to Miami next week, twist my arm. We got Chesapeake, Sunrun, Cheniere, and Pioneer all coming up next week in Miami. We got the 6 p.m. show tonight with Tillman Fertitta.
Are we?
Oh, watch out. That's the way to end. Water down.
Thank you for watching Power Lunch, everybody.
Closing bell. A soggy one starts right now.
It is the final trading session of 2022 and a pretty fitting end as it happens. Stocks close out a rough year with more losses. This is the make or break hour for your money. Welcome to Closing Bell. I'm Mike Santoli in for Sarah Eisen. Here is where things stand in the market. See the S&P 500 down a little bit over 1% at the moment. The Dow slightly outperforming NASDAQ. Small caps still pressure to the downside, underperforming on the day. The 10-year note yield is higher, could have something to do with equities being on their back foot as well. And here is the scorecard for the year on the major averages. The S&P 500 has been bumping along that down 20% area. We're actually just under that right now. We'll see how it actually closes up. The Dow's been a big outperformer with a lot of those defensive names as well as some energy. Coming up on today's show, we'll talk to former Spotify executive turned venture capitalist Michael Mignano about the brutal year for IPOs and the biggest opportunities and technologies that he's watching in 2023. Plus, what's New Year's without a countdown? All hour, we're revealing the top 5 most searched tickers on CNBC.com this year. And some of the names may surprise you. We will kick off with number 5 in just a few minutes. First, though, let's take a look at what this year has looked like in the S&P 500 chart. The 3,800 level, that's right where we are right now. The low for the day over every trading session in the last 2 weeks has been within 1% of 3,800. Every single day, it seems as if we at least test or drop below 3,800. Does that mean it's a support level? It's unclear. It's also exactly halfway between the September through December trading range. It's exactly 300 points up to the high, 300 points down to the mid-October lows. So clearly not really getting any upside momentum. There hasn't been any breakout. We haven't capitalized on the traditional late December seasonal strength, but also kind of holding in there. A lot of the kind of non-technology, non-growth areas of the market are kind of hanging in at the moment. We'll see what that sets up for next year. But bond market really, if anything, has been a bigger driver of what's gone on in equities than it's been for years. This is the volatility of the treasury markets, the MOVE index, it's called. It's essentially the VIX of treasuries. And you'll see it was really stable down here when the Fed was not in the game and when bond yields were subdued. Here you had this surge, and really it was the source of a lot of the unease in equity markets along the way. Now we're down off the highs in this index as yields have settled a little bit, and obviously the Fed maybe is pulling.
I bought more shares of DocuSign. Bought more shares of DocuSign and sold the 55 call for January for $3.20 per contract.
He's a portfolio manager focusing on global bonds. And Bill, maybe talk just in general. There's obviously a lot more yield out there right now than there was a year ago in the world. Is it worthwhile to try and capture it here, or is it more risky? Do you think yields could go higher still?
Well, Mike, thank you for having me. And what a year it has been, especially in the bond markets. As you mentioned, central banks have really been the big story as they've been chasing inflation mostly throughout the year. As you know, inflation has really been the pace car for where yields have gone, which has been straight up. So 2022 is now behind us, and we're taking a look at 2023 at DoubleLine, and what we're seeing is a much more interesting bond market outlook as far as potential returns. And we always start with the carry. And I think there's no question that the yields that we're getting at the beginning of 2023 are much more attractive than they've been for the better part of a decade. The aggressive hiking that we've seen and the backup in yields across all international markets, I think bonds are, needing to be reconsidered as potential place both that not only hang out, but even make some money in 2023. Now, we think that near term, markets, especially, all markets, bond markets, equity markets are going to remain volatile. And that's because the growth outlook is now challenged. What we saw in November is potentially what was the peak in CPI across developed markets and, globally, including international and emerging markets. Potentially we've seen, the near-term peak in CPI, which may allow for a pivot of central banks in the near, over the course of 2023. But at least the stance of central banks going into this year, or this coming year, is much more aggressive and much more hawkish. We saw the ECB, hike and announce their QT plans for the coming year. Starting in March, they're going to be looking for active reduction of the balance sheet by $15 billion, and that's on top of increased issuance. So near term, really the pace setter of yields going higher over the past month actually has been coming out of Europe. Now, if you take a step back and look out across the year as a whole, we do think that the higher yield and the potential for banks eventually pivoting on slower growth and slower inflation is going to present a very attractive outlook for investors. Not just in U.S. markets, but looking at international markets and emerging markets. As far as their bond allocations for 2023.
Bill, you mentioned that inflation, should it continue to decline, would create the opportunity for the Fed and other central banks to pivot to a more dovish stance. But are the markets correctly priced right now for the likely outcome? I ask because many people are focusing on things like, the 2-year Treasury yield is above, the upper end of the Fed funds rate range. That is typically implied that the Fed was due to pause. In other words, that they're in danger of going too far. We actually have, an investor survey Delivering Alpha did that said essentially a plurality of investors say Fed should stop right now. Maybe that's not a plausible option with CPI still at high levels. But do you think there is a risk that they're over tightening already?
I think that, that risk is front and center. And, the biggest risk obviously is to growth. Central banks not only are raising interest rates, but they're reducing their balance sheets, and that's tightening global liquidity. We're seeing M2 actually flat on a year-over-year basis when it's been positive for, much of the past 3 decades. And all of this is a risk to growth. And it's been, actually, I don't think in the US we've seen a hiking Fed into a falling, growth outlook scenario when we take a look at the leading economic indicators, which puts together a lot of the economic indicators, for the US. That's actually turned negative on a year-over-year basis. And when we look internationally, not only in the US, but across the globe, the majority of manufacturing PMIs are below 50 or in contractionary territory. And most central banks are still on a hiking path. So I think the bond markets are correctly interpreting that, this tightening of central bank policy to address high inflation is going to have a growth impact. And that's why we see yield curves inverted, not only in the United States, but, in many developed and even emerging market countries with the 10-year below the 2-year, suggesting that central bank policy has gone, a little too far and is risking a bigger growth correction, which, by the way, if you get a bigger growth correction, that's not only going to help pull CPI lower, it's also going to help yields rally as well. So on top of the attractive yield that you get, you can get a nice yield rally, across bond markets. And then also one item to consider is when central banks pivot, we have started to see a little bit of correction in the dollar, but currencies will likely rally against the dollar in the second half of the year, on a more aggressive central bank pivot that, first, in the beginning of the year, if you're, a little bit more aggressive investor, we do think currency volatility is likely to stay due to challenged growth picture. But the second half of the year, I think there could be a second very interesting trade for an international allocation that if you're a long-term investor, these, are fairly attractive, currency rates to get in at.
Mm-hmm. Yeah, for the first time in a while, potentially, Bill. Appreciate it. Thanks a lot for running through all that with us, and Happy New Year.
Happy New Year. Thank you, Mike.
All right. Appreciate it. Most days on this show, we give you a rundown of the top search tickers on CNBC.com. And today, for the last trading day of 2022, we're counting down the top 5 most searched tickers of the year based on total page views. So let's kick it off with number 5. It is Amazon. And it was, of course, an ugly year for that stock. Amazon shed around half its value this year, pacing for its worst performance since the 2000 dot-com bubble and falling out of the trillion-dollar market cap club along the way as well in CEO Andy Jassy's first full year on the job. We will reveal number 4 on the list after a quick break. Also ahead, our unicorn.
High took alert plus 800.
The Wall Street Journal out with a piece warning some billion-dollar startups are at risk of slipping below that benchmark. We'll discuss with a top venture capitalist next. You're watching Closing Bell on CNBC.
All right, Tesla's going, SPY's going. So some mean reversion after those JP Morgan collars rolled. We're now starting to see some upside. VIX is dropping off. Nice move in SPY.
Extreme high took alert.
Nice follow through. Tesla pushing higher. There goes Tesla, 122.40. Tesla on the move. Big move on Tesla. Nice follow through. Short covering. Happy New Year, Vantair.
Extreme high tick alert.
Crocs going. Okay, pause. All right, we got 46 minutes to go. 46 minutes to go for this last trading day of the year. Can we get back up to the high of the day? And then some?
On this final trading day of the year, we're counting down the top 5 most searched was Amazon, and number 4, the 10-year Treasury yield, which started the year below 2%, but has been on a mostly upward path all year as the Fed raised rates for the first time since 2018, actually at a historic pace as well. The yield peaked in October above 4%. Mortgage rates have followed that move as well, touching the highest level since 2001.
High tick alert plus 800.
Number 3 on that list in just a bit. Turning now to tech valuations, the Wall Street Journal out with an article, some billion-dollar startups risk losing unicorn status. We asked Reddit co-founder and venture capitalist Alexis Ohanian earlier this week if he's expecting a rough year in 2020.
Extreme high tick alert.
We've been telling founders really since the start of this year to plan for a scenario where they're encountering probably some of the hardest economic times many of them as CEOs have ever built businesses through or grew businesses through, and to have at least multiple years of runways. This is with the early stage companies, and in any case to really find paths toward profitability and to take the cues from the publicly traded tech companies that have been really seen a new sort of renewed appreciation for efficiency, for finding profit, and I think look, the good news is these tougher times that I do think we'll see ahead are going to help create much better companies.
Joining us now, Michael Mignano. He's of Lightspeed Venture Partners. Before joining Lightspeed this year, he was the head of talk for Spotify. And Mike, I assume that sounds
extreme high tick alert.
Look for potential investments, talk to portfolio companies. Has the environment changed the approach of what's going to make a successful startup, or maybe created a little bit, maybe a higher hurdle rate for when you expect companies to actually get to critical mass?
Absolutely, and thanks for having me, Mike. Look, it's no secret that valuations at all stages are down, be it at the early stages or the growth stages, but deals are getting done because there will always be opportunities for great companies, especially when you take a long-term view, which is what venture capital is all about, right? So venture is a long-term business. At Lightspeed, we take a 10-year view on companies we invest in. And so whether you're investing in 2008 or 2016 or 2022, there's always a great opportunity for a really, really fantastic company. In fact, historically, lots of our best investments have been made during the 2009 downturn when we invested in companies like Nutanix or MuleSoft or AppDynamics. So the space is still absolutely ripe for creative founders and problem solvers right now, and we're still bullish in every economic climate.
You know, if you look at the way the public markets have behaved and the areas of the market that seem like they had this very dramatic boom bust cycle, whether it's some fintech or some cloud software applications, things like that, that would send a message that says, okay, there was overinvestment in those areas. Maybe the amount of capital thrown at these opportunities exceeded what could really be realized in the short term. Is that the case in the private markets as well? What areas do you think look still ripe and not yet overplayed?
I think all these areas, especially when you take a 10-year view, are still going to be attractive investment opportunities like cloud computing or even consumer technology. I think it comes back to, like Alexis said, that if you're a founder building in any of these spaces right now, you need to be mindful of your core business and capital.
All right, we're just pausing here, not able to get back up to 381.
For say 18 months.
Need to see at least 381.
I think that somewhere between 2 to 3 years of runway is more appropriate. And you know, we've actually been telling our companies this since last year and even before to prepare for this exact moment, because obviously market cycles like this are normal and they do happen. But look, I think in general, we're looking for founders who can execute right now, who can not simply whiteboard, founders that can be lean and do a lot with a little. We know this is possible. I know this is possible from personal experience. Like you said, I ran the talk division of Spotify before founding Anchor, the world's biggest podcasting platform. We went from 0% market share to being the global market leader in 3 years with a team of less than 20 people and under $15 million capital total raised. So there are countless examples of companies in all sectors that change the world if they operate in a very, very lean way. And I think this next stage of tech investing is going to be the same.
Probably the area that's created the most recent excitement, I suppose, is AI applications. Everyone's been talking about the ChatGPT and what it means and whether, in fact, this is a business or just kind of a trick and what potentially might be the threat to some established big companies. I know that you sort of play in that area. Where is it headed most immediately from here?
Look, I think possibly it's the most exciting breakthrough in consumer technology since maybe the iPhone. If you just look at the history of the internet over, say, the past 20, 30 years, one area in particular where we see a tremendous amount of opportunity through AI is in creativity. If you look at creativity online, and there's massive, massive value created in the democratization of creativity. And I think you can look no further than Adobe's recent acquisition of Figma for $20 billion. AI stands to greatly accelerate this trend by enabling virtually anyone to be creative. And that's what led us at Lightspeed to invest in Stability AI. They are the leading open source software technology for AI-driven image generation. And so we see a massive, massive opportunity ahead by unlocking and democratizing more creativity on the internet.
All right. Well, that would certainly be welcome on a number of fronts. Mike, I appreciate the time today. Thanks so much. Good luck next year.
Thanks, Mike. Happy New Year.
All right, you as well. Let's check the markets now. Firmed up just a little bit in the last several minutes. The S&P 500 is down about 0.75% at the moment. The Dow down just a bit less, and all the indexes are sitting on losses of less than 1%. Natural gas prices are sinking again today, still tracking for gains on the year, but down sharply in the past few months. We'll tell you what's behind the latest slide when Closing Bell comes back.
Can't believe this year has passed so fast. Really enjoy being here with all of you through the ups and downs, the trials and tribulations, the exhilaration, and the and the down days as well. It's been a good year, even though we've traded lower, 20% off for the year. So, yeah, Happy New Year, everyone. If you're still listening, if you haven't cut out for the rest of the day, enjoy the weekend. Make sure you use an Uber if you get too shit-faced. Sorry for the French, but you know the expression. If you are out of control, not only for yourself, but for other drivers, other people. There's young people like my daughter, your daughters and sons on the road this weekend. So think of them too, and think of the family here at the Closing Print. Really appreciate everyone being here. even though we might not always agree or take the same trades, I think we're all looking for the same thing: make profits and to share, to help educate new traders and help others in this endeavor that we call trading and investing. All right, SPY's pulling back a little bit.
Time to reveal the third top search ticker on CNBC.com in 2022. Now remember, Amazon number 5, the 10-year yield was number 4, and number 3, the Dow Jones Industrial Average. It is by far the best performer of the major equity averages, down less than 10% for the year. The S&P, for its part, on track to be down close to 20% for the year, and the NASDAQ will likely close more than 30% lower. The top winners on the year in the Dow are Chevron, Merck, and Travelers, while the biggest decliners, Intel, Salesforce, and Walt Disney. We'll reveal the runner-up on this list in just a moment. Let's now turn to energy, which will close out as the only positive sector this year. Natural gas is also higher for 2022, but it's taken a downturn lately. It's lower again today. Pippa Stevens is here to explain exactly why all this whipsaw action in natural gas. Pippa.
Hey, Michael, nat gas is closing out the year, not with a bang, but a whimper. The contract's falling to its lowest level since March today, with weather driving much of these declines. Last week's cool snap is proving to be short-lived, and forecasts are now calling for a warmer than expected in January, which will cut demand for gas heating. We've also seen record injections into storage in recent weeks, meaning that inventory is now back around the 5-year average for this time of year. Freeport's LNG Texas facility restart has also been pushed back yet again.
All right, Tesla flagging at the highs.
And it's now been offline since June.
Tesla flagging at the highs.
And what that means for industrial and commercial gas demand also playing a part in this recent weakness. Now, nat gas has lost a third of its value this quarter and is currently trading right around $4.43 per MMBTU, a far cry from the more than $10 it fetched back in August, but still in the green for the year, gaining 20%, and that's helped lift the S&P energy sector, which in addition to being the sole group in the green for 2022, is also posting its best year ever, Mike. A lot of volatility really across the entire energy space this year.
Oh, without a doubt. And of course, natural gas famously is an extreme version of that in general. Where does it leave us with regard to, a lot of the stories coming into the winter about what Europe was going to be facing? You mentioned LNG, one of those plants being maybe offline for a little while, reducing demand for Henry Hub gas. But are we, in decent shape for the winter at this point?
Well, we are right now with inventory levels back around their 5-year average, but so much of this has really just depended on the weather, and that's honestly kind of what saved Europe this fall, is that they had much warmer than forecast temperatures, and so their current facilities were able to keep up with demand, and they were able to send some gas into storage, and so they have healthy levels over there as well. But going forward, it's really anybody's guess about what happens, since this market is so precarious. We still have that price cap on Russian gas going into effect next year, and so there's still a lot of variables, and with the market,
All right, SPY still flagging.
we could see things whipsaw based on the coming temperatures.
Yeah.
Lucid.
Hopefully it
Big pop in Lucid.
Thank you very much.
It's up
Biden this week signing the $1.7 trillion
1.4%. Lucid up 1.4%.
TikTok on most government devices. We'll discuss what the crackdown means for other social media companies. That is next.
All right, so we've got almost 32 minutes, less than 32 minutes to go for the closing bell. TGX going for the high of the day. All right, Pinterest, that was one that Susie mentioned. Pinterest. Susie mentioning Pinterest earlier. Looking forward to get back to the top of the range, maybe 2650. TGTX is going. TGTX is going. Okay, it's breaking out new highs. TGTX. All right, there goes TGTX going. All right, TGTX is running. Okay, so TGTX looks good. High today. I just posted on Stock Twits. Tesla holding up well. Tesla is plus on the day, flat on the day. TGTX, nice runner. There goes TGTX, running now. Higher lows, higher highs. All right, there goes SPY.
Welcome back to Closing Bell. Time to reveal the second most searched ticker of the year on CNBC.com. To recap,
High tick alert plus 800.
Yield and the Dow all made the list. Number two is Apple. Like many names in the tech space, it is on pace for its worst year since 2008. Currently trading roughly 30% below its high, though it did hold up better than the rest of the FANG stocks. And 74% of analysts
Extreme high tick alert.
have a buy rating on Apple, the of course largest stock in the S&P 500. Sticking with tech, the pressure on TikTok heating up this week after President Biden signed a spending bill that includes a ban of the Chinese app on federal devices. So could a national ban of TikTok become a reality next year? Joining us now is Rohit Kulkarni from MKM Partners to talk about that. And Rohit, I know that one of your predictions for the year was that TikTok would likely be banned. Now, do you think this would take the form of an outright ban on the app, or would they force a
Thanks, Dollar.
company? And what does it mean for other social media companies, do you think?
Again, thanks for having me, Mike. With regards to predicting whether TikTok is banned in the US, I think it would be unpacked in several layers, in my opinion, if it were to go that way. They would probably need to go through a series of data scrutiny and data investigations around how they're storing.
Extreme high tickler.
TikTok will probably have to go back and forth between US government agencies.
All right, got a nice move here. SPY ripping higher.
I feel just the overall pressure on privacy and what TikTok's algorithms, which remain as a black box, is just going to grow.
All right, how much time do we have left? All right, we got more than 30 minutes. Less than 30 minutes.
The US-based social media names, Facebook and Snap in particular. So whether it actually gets banned or not, just the early signs of just the news getting tighter around TikTok would probably help with the sentiment and a little bit of engagement. And finally, with regards to revenue,
These idiots at the New York Stock Exchange making all this stupid noise. They're like 15.
for both those companies in the near term, as Facebook and Snap.
Got it. Now, more broadly,
These morons in the background. TGTX going for 12.
if you're looking to be opportunistic, I guess Amazon's been cut in half. Meta, Alphabet trading at their cheapest valuations ever. What looks in particular attractive for next year?
I like Amazon the most in the mega cap land, and also like Uber in the other large cap internet land. Amazon, I feel there is still a downside with regards to estimates in the first half. So probably the stock is going to be ranging.
High tickler plus 800.
90 days of 23. But beyond that, I feel once we are at a point where we see leverage flowing through the model.
All right, nice follow through. Nice rally. Nice rally there.
Some of its employees back in March of 22. So they have already anticipated cost cutting for almost 9 months. So come March of 23, we should start seeing leverage even in soft revenue days and months and quarters. So I like Amazon.
Here we go. Starting to move here.
Go into the recession, the end markets that they operate in, advertising, commerce, and cloud, they can gain market share, and that's why we feel Amazon is absolutely no-brainer if you're looking beyond, say, June of 23.
And for Uber, I mean, I guess there's probably a cyclical aspect to it, but that's not maybe the main driver. Why do you think that the company is finally going to be able to persuade investors the business model is really clicking here? Because that's been still a question.
Yeah, I think Uber, when you look back in 22, they're not getting the credit they deserve. I would put it that way. When we look across all the large caps across internet land, I think Uber is one company that has had very consistent upside to street estimates. They've consistently beaten estimates, although by small margins. Some of them are inorganic, some of them could be organic, but they have continued to grind higher and higher through what we saw through the COVID trough. So I think, and as we get into the next year, they have some organic growth drivers. They are going to be generating a lot of cash. So it is a show me story, and the valuation remains cheap so long as the numbers remain stable and they show the leverage, and they have a variable cost structure, so they can adjust very, very quickly in a nimble fashion. So I like Uber here. It is a show me story, very cheap valuation.
Pally, nice little move there on Pally.
All right, yeah. Well, cash flow has been on the horizon for a while. It seems like maybe it's closer. We'll see if we can get there. Rohit, thanks so much. I appreciate the time.
Thanks, Mike.
There goes Pally running end of day.
And here is where we stand in the markets. Market continues to narrow the losses just a bit. S&P 500 down 2/3 of 1%. It's just above that minus 20%.
High tickler plus 800.
All right, another move here. All right, nice follow through here.
Disney is on pace for its worst year since the Ford administration. We'll take a look at what went wrong and what to expect in 2023. Plus,
Pally going here. Lots of volume end of day. Pally. End of day volume is ramping up on Palisades. Palisade Bio. Volume's coming in here. End of day. Look at that volume. Nice. Nice volume. Let's see how this goes here in the day. See if we can't get back to 9 after the close. All right, let's see if we can't get a runner into the close.
We have a development on the FTX story. Founder Sam Bankman-Fried is likely to enter a not guilty plea at his hearing next week. That, according to the Wall Street Journal, citing a person familiar with the matter. Bankman-Fried was charged earlier this month with 8 counts of financial fraud, with the U.S. Attorney's Office for the Southern District of New York calling it one of the biggest financial frauds in history. And now, it's the moment you've been waiting for all hour, if not all year. We've been counting down the top search tickers in 2022 on CNBC.com. Now, so far, we've covered Amazon, the 10-year Treasury yield, the Dow, and Apple. I guess we'll need a drum roll. For the most searched name of the year, it is Tesla. And no surprise, really, given the retail interest, the barrage of headlines surrounding the stock and CEO Elon Musk. And Tesla is on pace for its worst year ever as a public company. It is underperforming other automakers like Ford and GM. Sharpest downturn in the stock happened around the time Elon Musk said he would buy Twitter and sold Tesla shares to fund the acquisition. And you see it down and lost 2/3 of its value over the course of 2022. After the break, the final minutes of trading before we put 2022 in the books when we take you inside the market zone.
All right, SPY's still going. Nice. Into the close. We've got 16 minutes to go for the closing bell. All right, nice rally into the close. Nice rally. Let's see. Tesla. Tesla popping. $1 billion to buy. There goes Lulu. Tesla, nice pop there. Tesla.
Trying to absorb what the Fed had to do, navigating a peak in inflation. Where does that leave you with regard to how the market is positioned entering next year?
Yeah, the good news is we burst 2 out of the 3 bubbles. We burst interest rates at 10-year Treasury at 162 made no sense. Bonds were at a bubble level. Growth stocks were at bubble levels at the beginning of the year. And you could actually argue we burst 3 out of 4 because we burst the crypto bubble as well. And bubbles are dangerous things.
Tesla continues 123. Let me see what the 124 is where all the volume is. 124. Tesla 124 is where all the offers are.
Extreme high took alert.
On the positive side, we've gotten rid of some excesses. The one thing that I missed was I didn't think the Fed was going to come out and try and cause a recession, and the market clearly thinks they are, and that's been very tough on cyclical stocks.
Right, it absolutely has, and so that is the big call into next year as to whether in fact cyclicals have perhaps.
Tesla 124 is where offers are.
First, Micron falling today after Argus Research downgraded the stock to a hold from a buy. The firm warning of potential deep operating losses ahead as weak demand for memory chips persists. The rest of the semi space also under some pressure today as tech more broadly sells off. Christina Partsinevelos joins us, and Christina, let's talk about the growing disconnect between inventory levels, user demand. This has been the overhang over the chips for some time.
Yeah, and it's part of the reason why you have so many analysts right now negative on Micron and other chip companies. Why is that? We know that we drove up demand. We bought electronics in 2020. Demand is down. Tie that with inflation, and you're left with
Extreme high took alert.
Inventory levels, which is why customers are telling companies like Micron, hey, I don't want to use your chips right now. Or I don't need to do business with you right now. I'm going to write off the inventory and let's hold off for a bit. And so that's the disconnect that we're seeing. Also part of the reason the average selling price for DRAM and NAND chips within Micron have dropped 20% quarter over quarter. So of course that's going to hit margins.
All right, nice move here on SPY.
Into next year. The other interesting things
particularly with Micron, is there are three actions that they're going to be taking. One, they want to cut capex, so that means lowering their spending for wafer fab equipment by 50% next year. So that's going to affect other chip equipment makers. The second thing is, cutting salary, possible layoffs. A lot of companies have talked about that. And the third, which is the most interesting within the tech world, is that Micron is looking at slowing down their tech node transitions. And that's not something you necessarily want to see within technology. The slowdown of innovation, especially when you're dealing with a commoditized product like Micron memory chips, when just a competitor
Lots of volume end of day.
and stealing market share.
Yeah, that
SPY.
is, all of them are tough decisions, I'm sure. And I guess, Micron, Charlie, has
SPY
recently emerged from that
on the move here.
status.
End of day.
Extreme high took alert. High took alert plus 800.
Down by half over the course of this year. It looked cheap at the highs because earnings estimates were overinflated. The earnings estimates have been cut back. It still looks, cosmetically cheap. Where would that bring you in terms of assessing whether there's true value here?
One of the things I'm going to try and emphasize in 2023 is that there
Wow, look at that move on McDonald's.
in bad industries. You can make money trading in a bad industry with bad economics, but long term you can't. And the semiconductor industry is just not a good industry. It's highly capital intensive. There's lots of technological obsolescence.
All right, McDonald's ripping higher. There goes SPY.
Build their own capabilities by subsidizing semiconductor stocks because they think it's strategically important for the country, and so you get way too much capital coming in a very
Big ripper here.
obviously all kinds of literally tens of
With 10 minutes to go. 10 minutes to go.
from industry producing supply at exactly
Extreme high took alert.
Well, and Christina, our government certainly falls into that category, doesn't it, with the CHIPS Act? And so we
DocuSign breaking higher.
investment cycle going on with reshoring. I suppose that's going to create kind of winners and losers, and who knows what it means for ultimately capacity down the road.
It means a completely fragmented market, even more so than it is now. And what about the focus on, are we in the United States really going to focus on advanced nodes? You have TSMC opening a plant here, but no, they're not going to create the most advanced chips in the United States. So there's going to be a divergence in terms of supply between the most advanced nodes and the lower lagging nodes that are often used in autos and stuff. And I still think that's going to be a major issue. But you just said it. Everybody around the world is investing money. This is going to take years before we see this another supply issue down the line with chips.
Yeah, interesting little moment for the industry, if nothing else. Christina, thank you. Online brokerages, Futu and Up FinTech.
High took alert plus 800.
Regulators accuse them of allowing
Extreme high took alert.
trades. Those two now banned from signing up new customers from mainland China. Let's get to Deirdre Bosep. And Dee, what does this tell us about Beijing's regulatory crackdown? You could also tell me if it's up or UP.
Actually, I'm not sure. I've been saying up. We should check in with David on that one. But what does it tell us about the regulatory crackdown? It tells us that it's not over. There may be some green shoots coming from China. You're an investor in China.
SPY, nice follow through. Look at the volume on SPY. Holy smokes.
However, this crackdown is here to stay. Remember, it first went after video games, ride sharing, any tech company with a lot of data. Now it's the online brokerages. You're looking right now at the share prices today of these two companies, Futu Holdings and Up FinTech, as I'm going to call it as well, crashing today. Up FinTech, now its market cap just over $500 million. Both issued statements saying that, surprise, surprise, like every company does, they will comply with regulators. Up FinTech said that 90% of their new clients are coming from outside of mainland China anyways. But the point
Extreme high took alert.
is in the Chinese market. And Beijing is very protective. Of course, they don't want any one company having too much control, too much data, especially when it comes to financial services. We saw what happened a few years ago with Ant Financial. So in a way, this shouldn't come as too much of a surprise.
All right, everything's looking good here with 8 minutes to go. 8 minutes to go for the closing bell. All right, looks a little better. SPY looks a little better.
Only down about 17% this year versus the NASDAQ, which is down more than 30%. However, take a longer view, say 2.5 years, and the KWEB has been the much riskier and lower return bet.
Yes, absolutely. It is kind of coming out of a much deeper hole than the U.S. tech stocks were. I guess, Charlie, you were talking about sort of the Chinese property bubble potentially being a risk out there. This is another reminder that the Chinese authorities seem not to want the public markets to really flourish in some sense. They don't want a lot of power built up, either foreign investors throwing capital in their companies or their own investors participating very much.
Yeah, I hate to keep being too long-term focused here, but this is just what we're seeing. She is just not the capitalist that Deng Xiaoping was. She is a communist who doesn't believe in foreign investment and is very, very suspicious of even Chinese stock ownership and wealth generation. And so the Chinese government has taken lots of anti-corporate steps in the last couple of years, and frankly, over the last 5 or 6 years. So, and that doesn't even mention the structural problems in when a lot of U.S. investors buy Chinese stocks, they're investing in the VIE structure where you don't really even legally own the stock at all. You own something that owns shares in a Chinese company. So as you can tell, I hate to be gloomy in the first two ideas that have come up, but I just don't believe in this sector for all the regulatory reasons.
Yeah, no, it's a tough thing to get around. And Dee, thank you very much. Appreciate that. Check out Disney, though, heading for its worst year since 1974. Put that into context. In 1974, Disney World's gates had only been open a few years, and a one-day ticket would run you just $5.25. The stock is also on track for its seventh straight quarter in the red, its longest losing streak ever. Let's bring in Julia Borston. And Julia, this, of course, comes off of a time when the market loved Disney during the pandemic because of what was happening on streaming and the fact that, the theme parks were going to roar back with the reopening. But what are the key challenges and opportunities that are ahead right now?
Well, I certainly have to say it's a very different landscape for Bob Iger running the company now than it was when he was running the company the last time around. Certainly in terms of the broader media landscape, so many challenges in terms of a contracting ad market, questions about streaming subscribers, whether or not we're going to see slowing growth amid growing competition, and subscribers wanting not to pay for so many services, although I do think that Disney has an advantage because it does have that kids content that so many parents can't live without. But this question of whether consumers are going to be switching over to the ad-supported version, which is something that they did just recently launch. So these broader questions about the streaming landscape, plus the ad revenue, but then of course don't forget about cord cutting and the paid TV business. That's all different pressures on the company. And I would say the opportunities are in the choices that Bob Iger has to make. He has some choices maybe about ESPN and ABC, Wells Fargo speculating just last week that these are assets that he might consider spinning off. I think that's probably less likely, but I do think he has a really interesting choice to make around the remainder of Hulu that Disney doesn't own, that is currently owned by CNBC's parent company, Comcast. So deciding what to do about that. And just remember, Mike, when it comes to these brands, Disney has the iconic brands, the ones that are still performing at the box office and getting people to sign up for the subscription service. So this is a company that could really benefit from that direct-to-consumer relationship that they've built.
Right. There's no doubt that most of its competitors would actually they would covet the actual IP resources and the ability to produce what needs to be produced to feed a streaming platform. And you mentioned, the ESPN spinoff idea seeming less likely. I mean, to me, that it doesn't make a lot of sense at this moment. It's hard to know what the market would actually reward in that environment. And also, ESPN still produces cash flow. It's still something that is an earning asset, and they have experience.
All right, so we've got 3 minutes to go for the last trading day of the year.
Sports rights over to the streaming app. But I think just to take a step back, though, and also talk about the parks, which is something that I haven't mentioned. Obviously, there are concerns about consumer spending, but the parks have been incredibly robust. These are assets that have been incredibly robust during other economic downturns, and there is a sense that this is something that Bob Iger understands are really a crown jewel and an opportunity to keep consumers really connected with the brand and think down the line about all the potential to make sure that you're targeting the people who've come to your parks with a different way in their Disney Plus experience. And really, again, using the parks plus Disney Plus to get that direct-to-consumer relationship stronger and make sure that those consumers spend, whether it's on taking a trip to the theme parks or on consumer products or buying movies to download. So I think really strategically figuring out how to exploit those relationships.
Yeah, absolutely. Franchises and cross-selling. And Charlie, is this the kind of stock that makes sense to look at this point, just being kind of so beat up and yet having that brand franchise that's probably...
Happy New Year, everyone. Enjoy your weekend off. We're closed on Monday. It's been a joy being here. Seriously, enjoy being here. Not every day. Not every day is fun. Some days are boring as hell. But it's always good to sit here and share knowledge with each other. I don't know everything. You don't know everything. But we do have a nice trading room with like-minded people. We don't have any a-holes in the room, which is a good thing. And next year, hopefully, we get out of this downtrend in the first quarter, if not sooner. Okay, so make sure you stay safe this weekend. We want to see you bright and early on Tuesday. Weekend video will be out on Monday, 2 or 3 o'clock, something like that. As usual. I'll be looking forward to the day off.
Very well positioned in electrical vehicles, trading for 8 times earnings. So the market thinks there's going to be a recession. When that happens, earnings will come down. But in the longer run, I still think we've got something of a coiled spring with a lot of demand for oil.
All right, SPY going here.
And growing demand for food around the world. So we're going to get to the other side of these recession concerns. And when we do, these cyclicals, I think, are very attractive.
Do you think we're in for several months, though, where people even
Less than a minute to go. Very nice move here. That's it. Hey, Frank. Thanks. Thanks, Frank.
I think the Fed wants to bring on, it's not a recession, certainly a downturn in the labor market, and it's very, if the Fed wants to cause a recession, they took out the money supply by almost 40%, and now they're taking it down, which is very dangerous. There really haven't been a lot of periods in which the Fed has shrunk the money supply.
All right, SPY's running.
Absolutely will cause a recession if they keep it up.
All right, folks. Thanks for everything. Stephen, thanks for showing up today. It's always good to see you in the trading room. Frank, good to see you. Frano, Prism, Susie, take care. Yoda, thanks for everything. Appreciate it, folks. Mondo, of course, thank you for all of your posts. David, Percy, thank you from Texas. Appreciate it. Captain Cautious. Cayman, take care. Be safe. Todd B. Michael Keeley, thanks for everything. Thank you, Mikey. Understand you went to see the Ohio State game. Happy New Year. Can't thank everyone enough for your participation. Ali, take care. Appreciate it. Russell, as always, we always appreciate your big trades. Thank you for your input during the week. Dollar is gone. I believe he's out of here. Thanks for everything. Buford, if you're listening, thanks. Anna, Alex, thanks. Robert, Kaplan, have a great weekend, guy. Thank you. Jamie, thanks for showing up today. I haven't seen you in a while. Take care. Champ, the new members, Champ, thank you. John G, KWS, thank you. NP28, thanks. Trader C, Minimax, take care. Lee Star, as always, thanks for everything. Easy, PS, all the Nicks. There's a bunch of Nicks in the trading room. Thanks for all of your posts. Had a great year, even though it was mostly a bearish tilt to the markets. We did trade accordingly. Fantair, thanks for showing up today and saying Happy New Year. Always appreciated. Cousin Vinny, thank you. Showing up. Schmuck. Appreciate it. Getting up every day. Grover, Brian, thank you. Todd, I think I said thank you. Had a great year. Looking forward. Terry Tipton, thank you for all your posts with the Gamma. Always appreciate it. Gamma Edge. Ed Chalupa, thanks for everything. Beagle, thanks for showing up. Brother Bill, always appreciated. Nick Toronto, Doug L, thank you. Thanks to everyone that participates in the trading room. And even if you don't participate, if you're just listening in most of the time during the day, always appreciated people taking time to check in, give us some ideas as well. Captain Cautious, thanks. All right, looks like I got just about everyone that was here today. Have a great weekend, everyone. Special room, special group of people. If you see Anton, tell him Happy New Year. Hope he's doing okay, Anton, if you're listening. We're thinking about you, buddy. All right, everyone. That looks like a wrap. I think I got everybody that was in here today. Take care. Have a great weekend. Remember, you got Uber and Lyft if you get too clocked and you need a break. See you on Tuesday. Ciao.